we will be looking to review regulations, weed out those which are outdated, and rationalize those which may be necessary. This will be consistent with our object of achieving optimum regulation and creating ease of doing business by reducing compliance burden and the cost of regulation. SEBI prescribes norms for issuers of securities to ensure that funds are raised without delay and deployed efficiently. Internally, SEBI is using technology, including artificial intelligence, to ensure that the fundraising documents are cleared as fast as possible without compromising on disclosures. Investor interest is secured at all times by having a disclosure-based regime in place. Recently, SEBI prescribed quantitative thresholds for determining materiality, as per which a listed entity is required to make disclosure of the events and information. The aim of having such materiality thresholds is to bring about information symmetry for investors. The market infrastructure institutions, namely the stock exchanges, the depositories, and the clearing corporations, act as the first level of regulators for issuers of securities as well as for intermediaries. The MIIs are entrusted with the responsibility of providing equal, unrestricted, transparent, and fair access to all market participants. In fact, they are the first line of defense to ensure investor protection and market integrity. In India, we have chosen a model that allows competition, public shareholding, and profits for MIIs, which fosters efficiency in operations, encourages innovation, and provides natural backups. Further, adequate safeguards have been put in place to ensure that commercial goals of MIIs do not compromise their primary role of serving public interest and to act as first-line regulator. This is essential to foster long-term confidence in the market's ecosystem and to ensure stability of our securities market. Towards this end, SEBI has ensured that MIIs are strengthened on the front of governance and technology. Let me illustrate with some examples. On the governance front, we have ensured that the governing board of the MIIs is equipped to ensure that public interest is not overshadowed by the operations of the MII. The public interest directors appointed by SEBI play this vital role. SEBI will continue to engage with the PIDs of MIIs collectively as well as individually to have a better understanding of the operations and risks within the MIIs. On the front of technology, we have taken initiatives to build redundancies and resilience in the IT infrastructure of MIIs. Faster restoration of critical systems in case of disaster is expected to significantly mitigate the loss to the investors. We have also upgraded our supervision of MIIs significantly over the past few years and intend to further invest in enhancing our systems, particularly in the area of technology. Going ahead, we have instituted independent external evaluation of the MIIs once every 3 years, which will supplement our own supervision. SEBI will continue to follow a robust and transparent consultative process when formulating any regulatory requirement, wherein all stakeholders are consulted at every stage. As a step towards demonstrating its strong commitment to stakeholder engagement and transparency, SEBI has institutionalized its practices into a regulation which lays down the procedure as to how regulations will be made and how amendments will be carried out. A provision of review of regulations has also been codified to ensure their relevance with changing market dynamics. How do we enforce regulations through supervision? SEBI has to enforce these regulations to deter misconduct on part of market participants This enforcement is carried out through a judicious mix of off-site supervision and on-site and thematic inspections. As part of off-site supervision, SEBI has developed a robust in-house alert system based on periodic reporting done by the intermediaries. Automated alerts are generated on the data to detect non-compliance with regulatory requirements, and appropriate action is taken. Off-site supervision enables SEBI to cover more intermediaries and is a move away from the earlier sample-based supervision. An additional benefit of such automated alerts is to reduce the gap in interpretation of applicable laws and regulations and provide complete clarity to intermediaries. This aids in reducing cost of compliance. Market intermediaries are also supervised through on-site and thematic inspections. Where applicable, these inspection visits are made along with teams from concerned MIs so as to reduce the compliance burden on intermediaries. While SEBI ensures that market participants are adequately supervised, egregious behavior of intermediaries with respect to client assets cannot be ruled out, but cannot be tolerated. SEBI has been regularly taking various initiatives towards protection of client assets, as asset safety is important for investors to have confidence in the markets. Another important aspect maintaining market integrity is to ensure that market participants are not only aware of their compliance requirements, but also know how to ensure compliance. Towards this end, Industry Standards Forum is a useful innovation through which practitioners in the market and industry associations come together to develop uniform compliance standards in consultation with SEBI. While SEBI will continue to enhance its supervision capabilities, it's desirable that market participants are also nudged towards voluntary compliance with regulations. Action on market misconduct. SEBI has embraced the use of latest technology and data analytics to detect market misconduct such as insider trading, front-running, price manipulation, and financial statement frauds. Trades in secondary market are under surveillance on a daily basis, and alert systems have been put in place to detect suspicious patterns of trading. Market intelligence in the form of investor complaints as well as posts on social media also form an important part of SEBI's surveillance mechanism. We are also regularly collaborating with other regulators and with law enforcement agencies for pooling of information in order to take more informed enforcement actions. SEBI's enforcement process has evolved over the years in line with changing market dynamic as well as with evolving jurisprudence in securities laws. A range of enforcement actions are available with SEBI, from warning to censure for technical procedural violations to debarment and disgorgement of illegal gains, cancellation of registration for serious violations. There are sufficient internal checks and balances to ensure that the right level of enforcement action is taken and that entities are given opportunities to take corrective steps for merely technical procedural violations. This ensures uniformity of action and does away with arbitrary enforcement actions on part of the regulator. SEBI is also empowered to pass interim ex parte directions in the interest of investors in certain cases. Such directions are passed to restrain entities from practices that are adversely impacting market integrity. SEBI has also taken steps to strengthen its investigation and inspection process by building capacity within internal teams and by relying on technology for obtaining data and analyzing the same. The improvement in strength of SEBI's investigation and enforcement process can be gauged from the fact that more entities are now filing for settlement rather than litigating the matter, and the settlement proportion has increased to 40%. We will further encourage this trend. The increasing proliferation and misleading content on stock markets on various social media platforms leads to a lot of gullible investors putting their savings into investments which do not meet their risk profile. SEBI has been monitoring social media platforms to identify such misleading content and has successfully worked with respective platforms to take down such content before the damage is widespread. Investor awareness and education. This is one pillar where a lot of emphasis still needs to be done. The markets are changing rapidly, and it has to be ensured that investors keep pace with this change. Towards this end, our role in building investor awareness and education is very crucial. We intend to work with the entire market ecosystem to launch a more comprehensive awareness program for investor awareness, including on the pernicious cyber frauds and risks. Resolution of investor grievances. SEBI has put in place a robust grievance redressal facilitation mechanism for investors. This mechanism, also known as SEBI Complaint Redressal System, which is called SCORES, has been recently revamped. The new SCORES has reduced the time taken to resolve grievances and also provides for a two-level review for effective redressal of grievances. Then, online dispute resolution, which is ODR system, utilizes processes such as mediation and arbitration. This has been put in place to resolve grievances. As on date, around 5,600 disputes have been resolved through ODR with a claim value of around 390 crore. Towards a new conflict of interest framework in SEBI. Well, trust and transparency are crucial not only for regulated entities but also for functioning of SEBI as well. As a step in this direction, the board has recently decided to constitute a high-level committee to undertake a comprehensive review of the provisions relating to conflict of interest for members and officials of the board and make recommendations for an appropriate framework for preventing, mitigating, and managing conflict of interest, including a recusal policy and disclosure requirements which cover public disclosures. In conclusion, I would say that in a dynamic and complex security market, maintaining market integrity is a continuing challenge. SEBI has successfully teamed up with the MIIs and market intermediaries to build a robust market integrity. SEBI's initiatives in this regard span a wide range: regulations, technology, supervision, surveillance, enforcement, investor awareness, and resolution of investor grievances. Going forward, we need to constantly update and innovate in all these areas, keeping in mind optimum yet effective regulatory stance. This can only be achieved through commitment and collaboration across various teams comprising members drawn from external stakeholders and officers of SEBI. Towards this end, we will march ahead. Once again, I thank Min for giving me an opportunity to share my views on this important subject. Thank you all.
Thank you so much, Mr. Pandey. So I'm going to request you to please take your seat and invite Ravi Krishnan, Editor-in-Chief, Mint, to take this conversation forward.
Good morning. Good morning, everyone. So, Mr. Pandey, there are 2-3 threads in your speech which I would like to take forward in this fireside chat. One is on this whole regulation versus development of the market, because at times, they seem to be, these two roles of SEBI, they seem to be in conflict with each other. So let me give you an example. We have seen a lot of action on the F&O front recently, and a whole lot of complex rules, technical, rules and regulations have been introduced. So maybe instead of doing that, do you think, say, having a threshold for retail investors to invest in F&O, would that have been an easier rule to implement?
You're right, any issue that we deal with has 2 points. Now, if you have a type 1 error or a type 2 error, are we, if we have not really regulating, we may be building systemic risk, and therefore that systemic risk may also not only harm people but also spill over to other sectors. And then we can also maybe making type 2 errors, sometimes trying to over-regulate, stifle innovation. So any regulator in any sector needs to balance these two sides. Now, where the balance lies is a question of judgment, and that also judgment comes from the way we are organized internally and externally. If we are very concentrated, if we are unaccountable, if we are, in our own world, then the possibility of errors on both sides are much larger. If we are engaged in a more proactive way, we are data-driven, we are able to look at the nuances, we can both have a balanced perspective on both avoid type A and type 1 and type 2 errors. So therefore, I would say that a balanced approach will do a lot for development of the market in a more progressive, in a more consistent way. And unnecessary volatility, which is arising from flip-flop, will be actually more harmful for development. Now, coming to your specific question on F&O. Now, you know that F&O itself is a complex market. So when you are, you're walking up the complexity chain, your regulations, although we would like to have very simple regulations, but we cannot have a sledgehammer approach or a very blunt approach. We need a surgeon's knife. We need to know exactly how, because otherwise, the innovations will be lost. So just to say the small investors, we have taken steps in this regard, as you know, looking at F&O reports where we found that more than 90% of small investors were losing. So obviously, I think there was not only an awareness element, what we think is also a more systemic issue. And these systemic issues need to be then worked upon, working with the stakeholders again, working with experts. We prepared a discussion paper, which is out in the domain. We have received about 800 comments, and we are looking into it. But the question is that there is some systemic improvements which need to do. And we simply can't be saying that only increasing the threshold is only an answer. Because we have to actually, because F&O is a very important thing. It's an important thing for, hedging risks, for price discovery, a orderly development of a F&O market, which has linkages with the cash market, but which does not have spillover in terms of, systemic deficiencies. That I think we need to plug, and that has been our effort.
Sir, it's just been a month since you have taken over, but in all your public speeches and press conferences, there has been one recurring theme that has come out, which is of reviewing redundant regulations and optimizing, regulation. Can you elaborate a little bit more on which are the areas exactly that you are looking at?
Well, first of all, I would say that a lot of ease of doing business also has happened of the last few years. So, like if you recall, there were delisting regulations, which was overhauled. There was takeover regulations, which was there. And these regulations were then drafted by an external committee headed by Justice. And then, we had also important thing on case of master circular approach where redundant provisions were taken. There was consolidation on the debt side and also the debt securities as well as on the, other securities which are redeemable. There, we had brought in a consolidated thing as well. But there are several where we will need to work on. And while I was talking to the associations last few days, I've been talking to various associations, I have asked them, and actually they have also come out with certain things where going forward, what should be our agenda. And there are several things that can still be done in terms of rationalization, in terms of removing redundancy, in case of combining things, and sometimes, combining things on across regulations also. For example, your advertisement code might be different for different regulations. whether it can be made consistent if the objective is to achieve the same thing. So I have asked them to identify all these points and then discuss within the various fora that we have. We have a primary committee, secondary committee, we have committees for different groups. Then we have industry standards forum. I think these are the very good instrumentalities through which we can work on detailing which are the regulations which have become outdated, which can be changed. Objective needs to be effective regulation. We are not really saying that we should not be really, as I said, that I elaborated, how important market integrity is. But how do we really achieve it? Through an effective yet optimum regulation. Because we must recognize that there is always a cost of regulation. For example, we had earlier, tried to, for example, said that done a lot of work for this merchant bankers and debenture trustees and custodians regulations. And we were sort of initially indicating a certain kind of a hive-off for the unregulated activities of these entities. Possibly we want to have a review to see whether hiving off may not be necessary and we can have other instruments to achieve the same thing. Because what the hiving off will do, it will also put an additional burden, creating more SPVs, more entities, and then if it increases the cost of business, ultimately that cost of business is also passed on to the clients. Eventually, the people who are investors, they will have to pay for it. Nobody is going to pay from their own pocket. The question is, are we reducing the cost of intermediation or are we increasing the cost of intermediation? So we must try and achieve, because we have to also unleash several things, and some of the innovations are very much possible once we start exploring with that approach.
In your speech, you had mentioned about cracking down on misleading information in social media. Well, influencers are one category, but sometimes even regulated entities make claims, which is very difficult for retail investors or the public to verify. And SEBI had created a performance validation committee to look into these claims about past performance. What is the status of that?
So, regulations have been changed, and you have the concerned CRA will be the sort of the PARVA agency for the performance validation, and the concerned exchange will be the data provider. And now that regulations have been altered, and the rest of the follow-up work is being done in order to further progress on the performance validation front.
When can we see a conclusion to this? When will we start getting regular information on this?
Well, I don't have the exact date for you because it is different entities, but certainly we are moving in that direction.
Okay. A related question to this is, the number of RAs, that's very low, woefully low in India. I mean, less than 1,000 for a country of our size. And there have been a number of suggestions for reforms, such as allowing individual RAs to charge advisory fees for giving a second opinion, allowing them to distribute funds to the client as long as client level segregation is maintained, etc. What is your view on that?
I think currently well, first of all, I think I admit that, there is number of RIAs are really very inadequate given the size of our country. So I think we have to look at this systemically, the issues of why in one says why the people are not coming forward to do, are there entry barriers are large enough, or are we facilitating? So that's one part of it. The second is also educating people whether are they prepared to pay for advice. Because I think to some extent, I think there's a lot of Indians like free ship, the free advice is, so sometimes, because ultimately these have to evolve as a paid businesses. We have RIA regulations, but I had a discussion with them lately. And I thought that, regulations still makes it tough for them to really, for example, we have said that they can't do the performance monitoring unless they come to the performance evaluation metrics, the validation route. Now they may have, 10 years, suppose they have a prior 10 years of experience, and they are prevented from just displaying it in any manner. So that is also a concern for them. Then how do I, how do I recognize that what work I have done, I'm just being put up to a new fellow as vis-a-vis the old one. So there are certain barriers even for the existing RIAs, which we can say. What happens is that we sometimes do have some egregious behavior. And because of that, I think we start really, if we react very, vehemently to those things on the side of regulations, then sometimes we make regulations much tougher than what it ought to be. So this balancing is something which we need to achieve in every regulation, where we do not, as I said, that in order to say that avoid type 1 error, we start making type 2 errors.
Okay. We are running out of time, but a couple of more questions. One of the striking things in your speech was when you said commercial goals of market intermediaries should not be in conflict with their regulatory, quasi-regulatory role also. So, I mean, with that in the background, I believe National Stock Exchange has written to SEBI recently asking about the no objection certificate from the regulator for its listing. Now, NSE filed its DRHP in 2016, almost 9 years, and there have been a lot of issues. But have they been sorted out? What is the status now of, where is the regulator vis-a-vis NSE's listing?
I think NSE is a very, as you said, a systemically important institution. In terms of market trades also, in terms of turnover, it's overwhelming institution. Before it goes public, it will need to be cleared off from different angles, which we really see. And some issues have been identified. Frankly, I have not really applied my mind to it yet. But what I am aware of is that there have been some issues which have been pending. As you know, litigation, etc., is one part. To what extent that can be settled through settlement process, and then we can move forward. The other part could be relating to, some of the governance issues, technology issues that might be there, certain, as I said, comfort that we might be asking and they would need to provide, and some of the governance issues that they need to be settled. So I hope that, of course, there is also a clearing corporation issue paper. This is put out in November for public consultations, and comments have been received. So I think all these issues, possibly the NSC and SEBI, they are in, discussion, in the sense of, I think some letters have gone and they have replied to that. We will have to then examine and sit and take it forward. So I think we should take it forward in the best interest of the market, not only its shareholders, but also the users of this very important institution.
Great. One final question from a retail investor point of view. These shares, unclaimed shares which are transferred to the IEPF, Investor Education and Protection Fund, many retail investors complain that they are stuck for years and they are unable to claim them later. Is SEBI doing something about that?
I think typically this IEPF is handled under Ministry of Corporate Affairs, but we are definitely in touch with each other as to how we can have this process do better, faster, because certainly there is a lot of, delays, and sometimes, the people have been waiting and so on. A certain capacity building also needs to be done in the IEPF on an urgent basis. But I think Ministry of Corporate Affairs is looking into it.
Right. Thank you, Mr. Pandey, for sharing your thoughts with us and taking time out on a Saturday. Ladies and gentlemen, Chairman of SEBI, Tuhin Kanta Pandey.
Thank you so much, Mr. Pandey. Ravi, may I request you to kindly present a token of our gratitude to Mr. Tuhin Kanta Pandey. Let's have another round of applause, ladies and gentlemen. Thank you very much. Thank you, sir. Thank you, Ravi. Well, stay glued to your seats because we are going to move into our first power panel of today. But before that, may I take this moment to thank our partners for the 8th edition of the Mint India Investment Summit, presented by JSA Advocates and Solicitors, our real estate partner, JLL, and our associate partners, GM Financials, Equirus Wealth, and Bajaj Finserv Asset Management. Thank you very much. Also, ladies and gentlemen, I want to remind you that an Introbot networking partner is waiting to be explored. So when you registered, you would have received a WhatsApp message from Mint India Investment Summit with a QR code. In case you can't locate that, there is a QR code at each table on the 10 card. Please scan that code, click on Join Now, and you will unlock a world of networking and collaborative possibilities today. You can choose from subcategories. That's how you can connect with like-minded individuals. We have strategic breaks throughout the day so that you can make the most of this networking platform and have conversations with people that share similar interests. So please make the most of it. All right, so for decades, India's capital story has been somewhat disconnected from local realities. But today, the Desi capital engine is roaring. Family offices, homegrown VCs, domestic institutions are backing founders with vision, and they're voting with their wallets. And in our next session, we will deep dive with stalwarts who've seen the domestic market curve long before it was a hockey stick. From regulatory tailwinds to trust in Bharat's entrepreneurs, it is time for us to chart the power of homegrown money. Moderating this conversation is Sneha Shah, Deputy Editor, Mint. And please put your hands together for our panelists, Sudhir Sethi, Founder and Chairman, Chirati Ventures India, Imran Jaffer, Managing Partner, Gaja Capital, and Vikram Raghani, Partner and Co-Chair, Corporate Practice, JSA Advocates and Solicitors. Ladies and gentlemen, round of applause for our first power panel of the day.
Well, good morning, everyone. Let's have a huge round of applause for our panelists because, we couldn't have asked for we couldn't have asked for a better panel. Mr. Sethi, Imran, they have been pioneers in raising domestic capital. For more than a decade and a half, they've been around raising fund after fund. So, let's have a huge round of applause for them. And of course, Vikram, who has been he's been on the transaction side and, helping these VCs and Ps consummate deals after deals. So let's hear it for Vikram as well. Okay, let me set some context. If we just go by the sheer number of, Category 1 AIF in India, you would be surprised there are more than 30,000 AIFs that have been registered with SEBI, of various sizes. And that speaks volumes about how the industry has come about in the last decade and a half. And to that, if Imran, you can take it up first and talk about, how has the growth been for the, domestic pool where, you've raised vintage after vintage. What has the changes been in last 1 decade?
So pretty substantial, actually, Sneha. So a lot of you would have looked at the AUM of mutual funds, which is 76 lakh crores. You can see the wealth AUM at 67 lakh crores. Even AIFs are now 12 lakh crores. Number of DMATs and so on. I think those statistics are known to everyone. But broadly speaking, if you look at the financialization of savings, the financialization of savings has been a story since 1991 at least. right? So it's moved from physical assets of real estate and gold, and it's finding its way from bank deposits to public markets and now to AIFs. And this story is playing out, roughly speaking. The AUMs of a lot of these asset classes that I spoke about are growing at 2 to 3 times the real GDP growth of the country. And I'd say in the last decade, you're right, domestic institutions and domestic capital has stepped up. So you can see, the share of DIIs in public markets. Today, SIPs, as you know, are 23,000 crores a month, which is 4 times the last decadal average of FPI inflows, right? So DIIs have really stepped up. But at the end of the day, why is that happening? That's happening because of a secular trend of financialization of savings. And second, frankly, we should celebrate our entrepreneurs that are creating these opportunities through risk-taking. And it was very fitting, I think, that your second day started with the best institutions in the world. I mean, you could compare them to the US SEC and argue that they are actually one of the best confidence-building institutions. So I'd say entrepreneurship, institutions, and finally the wealth creation on the back of GDP growth has created this. And in many ways, supply is creating demand because we now have products that consumers can trust or investors can trust. That is creating a virtuous cycle for local smart money to come in.
Right. Local smart money, and clearly the UHNIs and the family offices have come of age. Mr. Sethi, if you can, come in and, backstage we were talking about how, you've been instrumental in garnering this entire family offices, the money flow into the AIFs. So what has your experience been, and how do you see this entire asset class growing?
So thank you for inviting me here. Great to be on the panel with friends. I think, and I'll sort of reserve my comments purely for the private markets as such, because that's what we do for a living. I think we're very excited with, India is today in the private markets, which is private equity, VC, direct investments in private companies, at a very pivotal and a very good position right now. And I think the approach being taken with the positive environment created through regulatory affairs, through SEBI, through other organizations in the country and the regulations is we're at a good position, let's do more. I think that's the very positive thing which is today happening. And let me sort of outline the 2 or 3 things which are behind the private market success of AIFs. The first one is it is massively getting scaled. And I think the opportunity here in the next 5 years is perhaps 2 to 3x more. Why is it getting scaled? There is a very sound flow of entrepreneurs that is increasing day by day. Very high quality entrepreneurs, number one. I think the other thing is historically, if you look at new companies being formed, and that's very important. What does private market do? Private market enables new companies to be formed which have never existed before. Or similar companies may have existed, but there is a new business model, there is a new technology, there's a new product, there's a new go-to-market. And as such, out of our own companies, if I see, which is 60 odd now current companies which are active, the revenue has reached 3 billion. It's scaled. These are VC funded companies who have scaled. Okay. Now, that's the opportunity. Many of these have gone public. Many are going to go public. So effectively, the supply chain to the public markets has increased over the past, I would say, 10 years. And that is going to, again, to my mind, in the next 5 years, you will see nothing less than 20, 30, 40 companies a year, small and big, coming up every year. So there is a supply chain which is instrumental in this. There is a history of success. Of course, there are companies who have not succeeded. Now, looking at this, what are the types of capital flowing in from India? One, as you rightly mentioned, is family offices. Family offices have 2 trends to it. One, there is a very large trend of mid to larger family offices now institutionalizing. very fundamental. You'll find many family offices now having CIOs, which as recent as maybe 3-4 years back, I did not find. And I think that's a very good trend overall. As they institutionalize from intuition investing, many of these family offices are going to science-based investing, thesis-based investing, and so on and so forth. That depth is very important because that's mature capital, which is now increasing. I think there is also a very high degree of interest in smaller investors, and I have to be very careful that we don't, this is private markets. The illiquidity here is much higher, significantly higher than public markets. We have to be very careful that retail, the true sense of retail does not happen here because these are illiquid assets and they have to be understood as such. But there is interest, and I think the best way to do that is to say many of these smaller investors can come into funds rather than direct. The interest has been through direct so far. I think the larger pools of capital should look at direct because that's larger pools of capital which are needed by larger companies. But the smaller companies, the series seed and series A's, I think is meant for funds because they de-risk the overall investors in the country. So family offices going larger, HNI is getting larger, and the second trend is, of course, as I mentioned, many new funds coming into the picture. These funds are formed by Indian GPs. That's the rise of the Indian GP based here. Not only in seed and Series A, there the numbers are higher, but the private equity funds or Indian GPs we have sitting here as such, they are making a mark in the market space and rubbing shoulders with foreign capital. I must add that foreign capital still is majority as far as Indian private equity and VC is concerned. But if I look at public markets where, domestic capital is rubbing shoulder to shoulder with international capital, I think that day, I hope is not far away, but it needs a lot of work to be done. The third thing, which is a very good trend, is institutions are increasingly participating in PE/VC AIFs.
Well, this is beyond our control, I guess.
Yeah, that's a vote of confidence, I presume. So, SIDBI, SRI, the State Bank of India, you find insurance firms. I think these institutions' participation has given confidence because when they invest, there is a very sound due diligence process, and their pools of capital which they invest in either VCs or some of the larger funds is pretty large. So they can act as anchor. So for many years, there was no Indian anchor in VC and private equity funds. I think in the last 3 to 4 years, we are finding Indian anchors, especially for the smaller funds, which is a very big game changer because looking at them, smaller investors get into a confidence mode. And by the way, even international investors get into a confidence mode because Indian capital taking risk is a vote of confidence for foreigners to come in and say, hey, you know what, there must be something which I'm missing overall. And the last trend, which is very, very important here, is capital recycling and regeneration. There is, if you look at the last, I would say, 3 years as we've done, there are a lot of secondary funds which have come into the country. Who are they buying out? They're buying out existing investors. Many of them are Indian capital pools, either in the growth funds or in the seed and VC funds. Now that's very, very important. That I would say was a very slow process. Exits were itself was a very slow process. We ourselves have returned 900 million to our investors in the last 15 years. But that's a number which we had to be worked upon. But most of that was sold to international investors, right? Now that's very important because when international investors come into secondaries, those companies are mature, diligence is done, and a large pool of that or some pool of that comes to domestic investors getting the earnings, the multiples, and recycling back some of that capital back into the private equity and VC market. So I would say these are the 4 trends which are very strong at this moment, and I do see this trend not stopping as such.
Right. It's interesting that Mr. Sudhi spoke about, foreign capital and Indian capital working, shoulder to shoulder in terms of the public market. But when it comes to private market, Vikram, what has your experience been? How is the local capital, the domestic DIIs and the AIF industry really, complementary to the FDI?
So I think, like Mr. Sethi said, right, the domestic capital and the deployment and the increase in the check sizes in the domestic market is in some sense a vote of confidence that the foreign investors are looking at. I think in a very positive way, the domestic pool of capital has made our capital markets resistant to global changes, global political issues. And therefore, earlier we used to speak about exit of FIIs. Now we speak about exit of FIIs, but all those inflows being substituted by the domestic market. So that has kept our capital markets very strong. In fact, in the last couple of years, our capital markets have outperformed most markets globally. What that does is it allows, it facilitates exits. Exits is a big, is a huge area of focus for foreign investors. And when they see sort of exits with huge returns in the capital markets in India, that incentivizes them to put in more money. While domestic capital has really grown manifold, I don't think we can substitute domestic capital fully, right? So we need both foreign capital and domestic capital. And in some sense, the sort of increase in deployment of domestic capital in India has therefore incentivized foreign capital as well. So that's really had a complementary effect where both are now, functioning in tandem. Yeah.
Right. And Vikram, will stay with you. And how has, that really impacted deal making? Because you are a transactional lawyer. Yeah. You're right there, you're advising funds, you're advising companies. Yeah. So, you are very much the most essential part of deal making. How has that impacted deal making? Are you seeing any changes where, the prices, valuation, has it impacted valuation given that there's more competition chasing those fewer deals? What are the changes that you're seeing?
Yeah, absolutely. So I think the first point there is that domestic funds and domestic investors are now in a position to write bigger checks. And therefore, whilst buyout deals earlier were dominated by foreign investors, we are now beginning to see that domestic investors are also looking at buyout deals. Now, when a domestic fund or an investor is putting in money, there is a regulatory arbitrage as well. There are certain shortcomings with foreign investors that do not apply to domestic investors. So our economy, our exchange control laws are still quite restrictive when it comes to foreign capital. There are pricing controls, there are restrictions on assured returns, there are lock-ins which hamper exit and so on and so forth. These limitations don't apply to domestic investors. I think that regulatory arbitrage plays pretty well as far as domestic investors are concerned. You are able to structure your exits better. You are able to, do quasi-equity instruments. You are able to get some security. You are able to, you're not constrained by pricing mechanisms and hence able to structure your deals better. So that arbitrage has worked in favor of domestic funds. That's point number one. As HNIs and family offices are able to put in more and more money, you now find that they're able to partner with foreign funds as well. So we've done a lot of deals where, let's say, a foreign investor is putting in a sizable amount, a majority, but the balance is partnered with a domestic fund. So we are increasingly seeing foreign investors and domestic pools of capital partnering together. This is all the more in areas where foreign investment is restricted. So for example, pharma. There have been several large deals in pharma where foreign investors and domestic investors have gotten together simply because foreign investors are not able to acquire 100%. And the third area that I would like to sort of point out here is that domestic pool of capital has really incentivized the startup sector. A few years back, startups were looking to re-domicile outside India with the objective of raising capital there. But now with more and more domestic capital available here, and with our capital markets outperforming most markets globally, we are seeing that a lot of these startups are re-domiciling back in India, bringing their businesses under India, and then therefore eventually looking to list. So I think these are the sort of positive impacts or positive consequences of the growth in the domestic money. Yeah.
Right. Talking about the flip side of increasing competition, Imran, do you see, because there are so many funds, competing for the same deal, I'm sure there are instances where, you're competing with your foreign, peers. Has that changed the market where, there's so much money chasing few deals?
Yeah, so first of all, for all the celebration of domestic capital, we must acknowledge that it's 10% of the overall market. So we've grown from 4% to 10% in a short period of time, and I'll be willing to bet that in the next decade we'll be at least a third, right, on a larger scale. So there's substantial growth. So that's point number one. Second, of course, we see competition, but foreign capital tends to come with much larger funds and therefore larger check sizes. So you tend to see them more dominant in, let's say, the $50 million, $100 million check size plus environment. In the 25 to 50 where we play, and I don't know, Sudhir, if that's your experience as well, at the earlier stages, of course, you have some foreign capital, but in the middle, in our experience, it's relatively less, but there is competition. So family offices are stepping up. Early stage venture capital funds have follow-on funds that sometimes compete. We see larger funds that do larger checks. They come early in certain sectors like software, automation, AI, etc. So it's always, I haven't seen an environment in the last 20 years when competitive intensity wasn't an issue to deal with.
Yeah, because we're seeing multi-stage funds getting raised. So I think the mandate is also very flexible these days, even for growth funds, where, they can go in very early and then lap it up with, in subsequent rounds. So in that sense, Mr. Sethi, the very early stage where, you catch them young. We have seen a lot of domestic capital getting raised, seed funds. In that sense, that's one space which is dominated by the domestic capital. What has the experience been with the local capital is ready to do, because early stage is the most risky one, right?
So I just want to pick up the last point Mr. Imran made. The fact that the exuberance in mathematical terms is 10 to 15% of domestic capital is 10 to 15% is an important point. I think the real question we as an industry have to ask ourselves is, if the gradient of growth has been 30 degrees, can we make it 60 degrees in the next 10 years? By the way, that's critical. Now, of course, to your question, has the seed been dominated by domestic capital? The answer is yes. It also means that domestic capital has a higher potential, higher appetite for risk.
Exactly.
That's very interesting. Out of our portfolio value, 60% value creation is in those companies where no foreign VC has come in. It's a very important, and that's for us. I do not know the other parts of the industry in terms of mathematics, but I think this is an important point as such. So the real question is that if domestic capital has to come in more, right, what's the criteria for that? I think the first criteria is very simple: performance. There's no question about it. Performance in IRR terms, performance in capital return terms. The larger firms, who've been around for, let's say, 10 plus years, have started to return DPI in a very, very big manner as such. That is crucial. It's very exciting to do investing. It's a very tough job to do divesting, right? Very tough job. I've seen many people who are excited about investing. The moment you say do an exit, it's like, really? Are you asking me to do an exit? That's like, why are you asking me to do an investing? In professional, I'm saying. Firms are today, who have been around for 10 years, we've been around for 18 years, I think we've had to develop, and please add to that, develop a culture of exit, right? There is a movement from a culture of investing to a culture of exit as such. And trust me, culture of exit, secondaries. When your fund is doing end of life, what do? It's a different world out there. You have 1 year to exit, 1 year in fund of life exit. What do? Number of M&As in the country. Are Indian companies buying Indian companies or not? Is IPO a big issue? How do you take a company to public? I think that is a very, very big thing. Of course, I think the risk patterns in the early stage are higher. We have to think about how to get more capital there. Up to the mid stage, I would say natural tendency for Indian capital to come to larger funds would be better, for the simple reason that the risk to reward ratio or risk to safety ratio is somewhat better. The risk is higher in seed and Series A. Now I will take back to what was done by the industry to promote software industry. There were STPIs. There were certain benefits which came in at some point of time. To encourage manufacturing, there is PLIs. I would even encourage our industry to think about saying, what is to be done to catalyze the domestic flow of growth, especially to the early stage, because the risk patterns are higher. On similar lines, when we thought about how software industry grew and in the early 10 years or so, or PLIs in the system as such, my sense is something of that sort may be a trigger, because very clearly the industry is growing. There is no question about it. The question is, can we take it 3x in the next 10 years or maybe lower?
Sneha, I just want to follow up. So these are excellent points, because these two things, which is exits and performance. Uday Kotak is going to speak later this evening. And if you speak to experienced bankers, they say, look, lending is about collections. They're very clear. Lending is about collecting, right?
Absolutely.
And if you translate that into our business, investing is about DPI. It's about exit. So you're bang on, Sudhir. And that's, by the way, the big headline. The silver lining of India's private equity venture capital story over the last 20 years is the exit track record over the last 5 years. I think that's been the game changer.
Right.
The second point I want to make is on performance. I want to build the case that it's very important that funds benchmark themselves to global dollar returns. The fact of the matter is that US has been a spectacular market, both in public markets that returned 25% CAGR over the last 2 years, 25% in dollar terms, okay? And private markets, even if you adjust for leverage, which we are not allowed in India, has been spectacular. Right. So if you want to raise capital from sophisticated institutions in India, ultra HNIs, remember the awareness now. You have sophisticated family offices who have global portfolios, and they are looking at dollar returns.
Right.
So it's not enough to celebrate your rupee returns anymore. You need to deliver DPI, and you need to cross a certain benchmark in dollar terms. And I think that's healthy. We saw that in IT and pharma. We've got a $250 billion IT services industry because it was, we were trained on working with Fortune 500, Fortune 1000 companies. So I think that's very healthy in our industry.
Right. And with this culture of exits that they talk about, we've seen a lot of, money getting recycled, where family offices have come back, HNIs have come back with larger checks. So Vikram, if you can talk about, we've also seen the ecosystem really develop, the regulatory changes that have come about to really support this entire, channeling of, UHNIs, HNI money into this asset class. So how have you seen the regulatory change over the last 10 years?
Yeah. So I think from a regulatory standpoint, the changes have been very supportive of domestic money coming into some of these private sectors. But I think more can be done. So for example, in AIFs, you have a minimum check size of 1 crore. For angel funds, it's 25 lakhs, right? So maybe some reforms in that area which can mobilize more savings into private investments, right? I think the SEBI chairman also spoke about that some time back. I think shift in savings into, into the non-conventional sectors, away from real estate and gold and all of that. But most of that is in the public markets, in mutual funds. Even that is roughly, I think, 3.5–4% of total household savings, right? So maybe some reforms there which can move these savings into the private markets. That's one change that would be welcome. The other is, domestic money can also, at least from large corporates, be effectively used and deployed and invested outside India. Currently, there are some restrictions and limitations there. Companies can't invest beyond a certain net percentage of their net worth outside. AIFs are restricted from investing more than 25% of their corpus outside. So if those can, there can be some flexibility there. It will further help, in investing domestic money outside.
Right.
Can I just add to that?
Yeah, sure.
The trigger points I mentioned on the software industry and the electronic industry, there are two, and I'm sticking myself to private markets right now. One is to get the 2 to 10 crore investor to 15 crores. That may seem 50%, but it's important. But let's take care of the fact that there is a large number of family offices who can write checks at 100 crores and 50 crores and 200 and 300 crores. We've seen that ourselves. We've been backed by local capital to the extent of 4,500 crores in the last 10 years.
Right.
Okay? That's about 40% of our total capital raised. Now, if I look at that, the larger pools of capital obviously will be larger chunks and not the smaller chunks. I think it's interesting to think about it, that is there a trigger required for somebody who invests from family offices or institutions at, let's say, 100, 200, 300 crores into funds or direct? I'll stick to funds for a little minute because I think the tendency to go to direct is very easy overall. And what is that trigger? What is that trigger? If I take the two examples of software industry and manufacturing PLIs, let me, for a lack of any other word, call it capital PLI. Okay? Can we think of those trigger points which are important? Just to give you an example, we did a little bit of homework pre-COVID, and the top 5 IT companies at that point of time in a 5-year period had spent on share buybacks and dividends over $30 billion in 5 years. Okay? I'm not saying that should not happen. All I'm saying is there is a huge amount of capital lying in reserves in corporates. Now, is that being capitalized into, let's say, growth patterns or M&A? I would have thought it would. But I think it's important to think where these pools of capital are and how can we mobilize through triggers which will grow 3x in 5 years, right? Assuming that there is an absorption capacity in the industry, which I truly believe there is an absorption capital in the industry.
Right. One last question to Imran. How far are we from $1 billion, domestic fund? When do we see that happening?
The short answer is I'll be very surprised if it doesn't happen in the next 7 years.
Okay.
But I'll tell you how. And Sudhir mentioned a few ideas. If you just take the ultra high net worth pool of capital, there are estimates of $2 trillion by 27. If you assume a 40% savings rate and their allocation to AIFs or alternatives go from 7 to 8% to 15%, that's $100+ billion waiting, looking for ideas.
Right.
Right? I'm not even counting insurance companies, pension funds, corporates. I'll be very surprised if you don't have that in the next 5 to 7 years. But there is a cautionary message also.
Okay.
We must not, as an industry, get caught into the vanity metrics of AUM.
Right.
We must remember that we are fiduciaries first. And so the point of, generating risk-adjusted returns that are globally benchmarked, to be truly the custodian of investors, big or small, I think is the most important growing up that the industry needs to do. I'm not saying we're not doing it, but that will then earn the industry the right to do what all of us are saying should be the path from 10% to 30 to 40% of the industry.
Right.
Can I change that question?
Okay.
I think the right question is, for a VC,
Right.
I think the growth funds have possibly achieved that. when is a VC going to return $1 billion from one of its funds?
Right.
Then the $1 billion fund is an easy task, right? Because when you raise $300 million, right, you have to return, if you take a 3x net in dollar terms, or 3.5 Gres, you have to return $1 billion. Trust me, it is a science to do that, right? And if that is done, and to my mind, I don't think it's far away for maybe a few of the Indian VCs and certainly for the international VCs from India.
Right. So I think we've run out of time, and it was such a fantastic, discussion. To sum it up, they are the fiduciaries of investors, and we are not far from seeing billion-dollar funds being raised in India by local investors. So on that note, please let's have a huge round of applause for our panelists. Thank you so much for making time and speaking to us.
Thank you to our panelists. Sneha, thank you so much for moderating that conversation. Please present a token of our appreciation to our panelists. And ladies and gentlemen, stay glued to your seats, because up next we have a fireside chat. Thank you very much, Imran, Vikram, and Sudhir. Thank you so much. Yes, another round of applause is in order, don't you think? Thank you, gentlemen. Picture this. The FIIs are pulling out like swimmers spotting clouds, but India's retail investors are diving in head first, possibly. Who's reading the market right? Who's betting on India's long game? Devina Mehra, an investor who has consistently zigged while the world zagged, joins us to decode this new age tug of war, along with Sanjay Bhattacharya, managing partner, Fortuna Capital. They're here to answer questions like, should India Inc.'s growth rest on the shoulders of the masses? Or is this the beginning of a smarter, more resilient retail wave? Before we invite them on stage, I want to once again remind you that our official hashtag for the event is hashtag MintIIS2025. Please feel free to share your thoughts, your opinions, your key takeaways, and don't forget to post those selfies as well so that we know where we can find them. In conversation with our speakers will be Deepti Sharma, Senior Correspondent, Mint. Give us a couple of seconds while we turn the stage around. Okay, we are good to go. Please join me in welcoming on stage with a huge round of applause Devina Mehra, Sanjay Bhattacharya, and Deepti Sharma.
Thanks for setting the context so well. To begin with, there's a growing apprehension about a slowdown in capex and earnings growth. On top of that, there's relentless selling by FIIs. Plus, recessionary concerns by the US is also a worry. So we have two market maestros with us today, and we are pleased to have them here, so that they can help us decode the market dynamics today. Thanks for making time. Thank you, Devina ma'am. Thank you, Sanjoy sir. To begin with, the FIIs have been offloading in the secondary market. Yet, they've made substantial anchor investments in the IPOs. So does it mean that they are temporarily fleeing India and staying invested in India in the long run? What are the factors at play? Do you want to go first, Devina ma'am?
So I think this is surprising. I can't fathom why they would do such a thing, because IPOs typically tend to be more pricey, and they have much less trading history. They have much less sort of clarity in terms of how those businesses will evolve and so on. And typically the IPO investor is at a huge handicap to an investor who is investing in an established company with a long track record. And I would not describe FIIs as fleeing this country. I think there's a lot of hyperbole about, the brave, wonderful domestic retail investor and the domestic institution and the bad, villainous FII. I just think we need to have more diversity in terms of the people who invest in this country because, diversity of opinion, heterogeneity is what really leads to great markets, healthy markets. So for me, I don't know the answer to the question that you asked, but I would say that we need to move beyond this us versus them approach. I don't think it's productive for anybody. And I think people are entitled to sell when they think, markets are expensive, when there are risks that they don't want to take on, when they feel anxious about, what is changing at the margin. So I don't think selling is a crime and buying is an act of confidence if you're an investor. You just need to behave rationally.
And I would like to really question the question itself, that why do we want to spend time and energy trying to focus on what FIIs are doing and what they will do? For a large part of my career, they were my clients, and this is a disparate group of institutions. And also, if you look at from their point of view, for example, 2010 to 2020, the Indian market barely gave any return at all in dollar terms. So, but the more fundamental question is that what is the reasoning behind this question? And the reasoning is that if FIIs sell, the market will go down. If FIIs buy, the market goes up. That's why we spend time and energy analyzing this question. But does that hold in the first place? So I have, in my book also, I've written a chapter that it takes me back to my school days when my maths teacher used to say that, every step that you're writing in solving anything, does the first step actually imply the second, and does the second imply the third? So, if you look at the long term, yes, this time it so happened that the FIIs sold and the market also fell. But if you look at long-term data, there is no correlation. And I have been there from the beginning. In fact, the reason I started this business was because the market was open to FIIs in Dr. Manmohan Singh's, I think, 92 budget. And let's look at the data right at the beginning. The FIIs really started investing in India from 1994. So at that time, no Indian mutual fund existed. There wasn't retail participation to anywhere this kind of scale. So you would think these new billions of dollars coming into India will completely drive up the market. But what happened? 1994 to 2003 is the only 9-year period in India's history when the net return from the index was zero over 9 years. So obviously that didn't move the needle. So that's why, and even on a month-to-month basis in the beginning, we used to track it, that how much impact does it have on the markets, and there was none. In fact, in the beginning, FIIs were always net buyers every month. And there was 1 month when they turned net sellers. I think it was November 98 or November 99. And that month, the market went up. So it's, I think, a fool's errand in the first place to try to second guess what they will do. I don't think it's worth spending a lot of time and energy trying to do that. So this might be net just decisions made on the margin by certain funds, which has resulted in this thing that they've invested more in IPOs than in public markets. And I agree with Sanjoy that typically the risk is higher in the IPOs, and the knowledge you have is less. And especially in this bull run, the pricing also went completely haywire.
Devina ma'am, just to understand a little more, Do you think FII selling will continue for a long time, considering that right now it's absorbed by the DII and retail inflows?
So that's the whole point, Deepthi. I'm saying that there's no point trying to guess what they will do, because that, I mean, the implicit in that question is that if FIIs sell, the market falls, and FII buy, the market goes up, which doesn't hold. So let's focus on what we want to do in the markets rather than trying to guess what somebody else will do in the markets. What is the rational thing to do in the markets? That's the question.
Sanjoy sir, any views?
I'm completely in agreement with you. Nothing to add.
With market corrections underway, we are seeing bursts of buying activity intermittently. Also, with the recessionary fear in the US, there are veterans who are favoring Indian equities at this point in time. So, what's your perspective on that?
So, first of all, many times narratives follow what is happening in the markets. Like if you're talking that India is doing better, but I mean, just a couple of months ago, there was all this ho-halla about that consumption is slowing. But consumption actually never did slow in this financial year. The consumption slowdown happened in 23-24, which I think in the last Mint, the same conference I had spoken about, that consumption growth was at a 21-year low. But at that time, nobody focused on it. Because the markets were doing well. When markets started to falter, you said it is because of consumption. But if you really look at the data, this year private consumption in the GDP, if you look at the estimates, is supposed to accelerate from about 4% to 7.5%. As far as the US is concerned, I mean, there is obviously, uncertainty has gone through the roof with Mr. Trump coming in, which is what I had expected and written about in November when he won, that there is little predictability to what will happen. I mean, all the people who are saying that this will happen to currency market, that will happen to stock market and bond market, I mean, what are they smoking? Because you don't know what the guy will do in the first place, so how are you so confident of second order and third order effects, and which is what you are seeing now playing out in real time. And compounded, if you had to compound uncertainty, couldn't have done better than marry Trump to Musk. But as of now, US is not close to a recession. But of course, consumer confidence is faltering because no one likes uncertainty, that every day you don't know what will happen. So my concerns are not so much to do with US recession. My concerns actually, if you talk the global issues, are more to do with the fact that you have changed all the assumptions that we had taken for granted for a good 80 years. So Trump has taken a wrecking ball to multilateral anything, WTO, WHO, NATO, UN, World Bank, everything he has a problem with. Saying EU was set up to con the US and so on. So suddenly, yesterday I read this news report where EU says, told its citizens that stockpile essentials for 72 hours in case of any war or any geopolitical upheaval. Who would have thought even 3 months ago that something like this could happen? So those are more my concerns. I don't think US is exactly going into a recession immediately or anything like that.
It's what Devina said, I think, that, basically investors hate uncertainty. And right now is a very uncertain period. The reason I think to be careful now is that there simply isn't a margin of safety. Markets are pretty reasonably valued, at least in India. So also in the US, by the way. In the US, they're just a bit off their lifetime highs. And I've often heard this argument trotted out that the Indian market has fallen 10% or 15%, and now we are at average. Earlier it was 1 sigma above. Common sense would suggest that markets can go to -1 sigma. If they ruled at +1 and +1.5 sigma for so long, why not -1 sigma? And that -1 sigma typically tends to happen when people don't know how to respond to what they see as bad news. So I think this is a time to be careful. And if, as I've always said, I love a good crisis. So if markets fall significantly from here, Yeah, sure. This country isn't going to change negatively in the next 5, 7, 10 years. So if prices are in your favor because of a meaningful drop in, share prices, yeah, then it would be a great time to invest. But the moment clearly to dive headlong into markets is not now.
You said that the value, you think that Indian market is reasonably valued. Does that mean that India Inc. is not facing any challenges structurally?
This word always confuses me. Structurally, it's a new word in the lexicon of investors. I thought investing was pretty damn simple without so much, hoopla about structural, non-structural, cyclical, seasonal. I think all countries face structural challenges simply because the future is uncertain. I'll give you a simple example. I'm not trying to be, facile or, take this lightly. But what will AI do to how companies function in the next 10 years? I don't know whether people have clear answers, but I think it will make an impact. And I think, the way certain industries function and the way in which they earn their profits today will change dramatically. So, yeah, I think the economic environment, the business environment in India is a positive environment. That's not to say that we don't have some problems which we need to get around. And whether they are structural or not, I've never understood, but we do have problems. There are not too many problems, but there are definitely problems. And one, I think, which many people have spoken about is credit growth in the Indian banking system. Because at the end of the day, growth requires resources, financial resources, and a large part of that resources comes from credit growth from various different places. And to that extent, that's one of the things that certainly we face at the moment. So, yeah, we do have some structural problem, but it's not the end of the world. It's not as if, we're going to fade and go away. No.
I'd like to add something to this, which is that often when we are talking countries, we mix up economies and markets, which are actually two completely different things. I mean, US may not have a clear and present danger of recession immediately, but are the US markets, how they are going to perform is a totally different question. And remember, US has been a huge outperformer in the globe for the last 10, 12 years. And for a time, I had been watching that sometime it would change. And it still looked, maybe that time is some time away, but Trump's coming has really, to my mind, hastening the end of the outperformance of the US market, probably. I mean, one is watching, but that hypothesis is becoming stronger. And also, I mean, in terms of the disconnect between the economy and the markets, I cannot give a better example than China, where the Chinese market made it high in 2007. And thereafter, now the GDP has gone up nearly 7 times without the market decisively taking out that high. So it can be to that extent, the disconnect can be so much. For India, just one other data point, that 2010 to 20 was a very low return period for the Indian market. We think that equity markets in India have given 15-16%, which is the long-term average. But decade to decade, deviation has been very high. So, of course, 1980s decade was 21%, then 14, then 17, and the 10 to 20 decade was only some 8.5, 8.7, 8.8%, which was barely above fixed deposit rates, because remember those days fixed deposit rates were around 8%. So that's what created the room for that bull market that we have seen. And I mean, my own advice is that whatever is your equity allocation, it is not time to really sit out of the market, but may not be in exactly where you are invested today. So that's the other point, that a stock or a strategy which is down 40%, 50%, 70% might still be a sell. So you don't have to make it back in the same stocks, because this is also the nature of markets, that especially after mad bull runs where everything did well, that after the fall, when the next rise comes, it may not be the same stocks at all. So, that would be that. to be in a steadier portfolio. But sitting out of the market right now, that wouldn't be my advice. On the other hand, I do see that there are problems on the economic front. The biggest one being that are you missing the bus on your demographic dividend? That's the biggest one. That demographic dividend we all think means having a lot of people of working age, which we do have, but we are not able to find jobs for those people. So demographic dividend is the percentage of people in working age into those that are employed into the productivity. So we are like faltering big time on the second one, which is getting employment for people. But as I said, markets and economies don't have a one-to-one correlation on a real-time basis.
Devina ma'am, we are nearly 4 years into the PLI schemes and the China plus one narrative. And the GDP, manufacturing share in the India's GDP remains stuck at more or less the same level. So, do you think that's a big concern for markets?
Again, markets, not all of your markets is manufacturing in the first place. And manufacturing in the economy includes a lot of unlisted business. But what you are saying was, again, last year also I had highlighted this concern that it is not just stagnated, it has come down. So manufacturing as a percentage of GDP last year was about 13.5. Somebody on social media told me it's 12.5. I haven't checked that number yet. But even that 13.5, last time it was this low, can you guess when that was? It was in 1969. So after 50 years, you have manufacturing as that smaller portion of GDP. And we were at 17.5 for, I think, from about 2008 to 14, 15. Barring 1 year, we were at 17.5. So, I mean, and my question with a lot of incentive schemes, and PLI being an example of that, is that we do not always align the objectives and the incentives. So what were we trying to achieve with this PLI scheme? If it was employment, and this I've written about also, that you were giving these huge chunky subsidies to, let's say, a semiconductor maker who's going to employ 4,000 or 5,000 people. So was that the best use of that money? And just as we had this corporate tax cut a few years ago, and if you look at the high corporate tax paying companies, they are what? They are banks, they are PSUs, they are MNCs, usually in FMCG, and that kind of thing. None of them is going to put that tax saving into CapEx. So what were you trying to achieve? Were you trying to achieve investment? Were you trying to achieve employment? For both of that incentive didn't work. So I think there's an issue with thinking through what we are trying to achieve through incentives, and which is why the incentives are, I mean, we thought incentive PLI was supposed to increase, manufacturing was supposed to increase employment, but probably that was not targeted properly enough. That's my take.
Any thoughts, Sanjay sir?
I think two things. Well, the one thing that Devina said is very relevant. You know, we seem to have forgotten Adam Smith in this country. So it would help policymakers if they remembered what Adam Smith said. Just because other countries make semiconductors doesn't mean we have to make them. That's point number one. Point number two, all nodes count the same. So how does it matter? Whether you make it from manufacturing, or you make it from services, or you make it from agriculture. Because I think the interesting thing is it has to add up to 100. That gross number doesn't change. So manufacturing's loss is someone else's gain. So figure out where it's gone and see if you have opportunities there. You don't have to fret about, the total can never be 110. That's the only thing I can tell you. Once that idea is deeply embedded in your head, I don't think these issues count too much. All nodes count the same. Too much macro thinking in investing is destructive. You just need to figure out 2 or 3 things: interest rates, inflation, money supply. Beyond that, it's certainly beyond my pay grade. And I'd venture to add, it's beyond the pay grade of 99.9% of investors, not just mine.
What about the art of selling? You've often emphasized on that. So, I mean, when is the right time for an investor to sell? Some sell too early, for the others it's late.
It's purely, I think, a combination of a couple of things. One, your ability to understand yourself. So I think most investors, especially when they start out, are overwhelmed by greed. They just think, they haven't heard the story of Jack and the Beanstalk, obviously. So for them, the beanstalk grows all the way to heaven. But sadly, it doesn't. So that's point one. The second thing about selling is, I think, you've got to recognize the nature, the history of how companies have traded. It's an important indicator. If you look at stock market history, not just in India, but if you look at stock market history across the world and for similar businesses, it'll give you tremendous clues. I mean, if you look at the Nifty 50 in America in the mid-60s, it tells you a lot about how companies, when there's excessive enthusiasm, how they get valued. Second thing, I think, about selling, which people typically tend to disregard, is you own a business. The business has a certain value. You're a fractional owner. Would you pay 100%? Suppose you weren't a fractional owner. Suppose magically you woke up in the morning and God said, I'm sending you a check. Amount unknown. You just put the amount yourself. Would you own 100% of that company that you own? And feel happy and sleep well at night? And if the answer is no, then you've got to ask yourself, what am I doing? Why am I not thinking about selling this company? It's as simple as that. Actually, investing is not a business that attracts people with high IQs. Buffett has said this. You're lucky if you go beyond 110. With no offense to Devina, it certainly applies to me. Devina's credentials academically are outstanding. I mean, truly, truly outstanding. So it doesn't apply to her. But for the vast majority of people in the Indian stock market, you won't find IQs beyond 110. And that's not disparaging. Just keep it simple. If it's supremely expensive and out of whack with how such businesses trade around the world, sell. And selling is not an act of infidelity. You can buy something again with it. You got to keep your wits about you. You got to get less greedy. You got to remember, what history tells you. And most importantly, not have, morality get into selling. If you mix up morality and selling, you have a serious problem.
In fact, let me add to that. Instead of morality, I'd say that don't fall in love with stocks. And I actually had this conversation with a fund manager who used to be a client back then. I said, don't fall in love with your stocks. And he looked up like this and said, "Pyar to ho hi jata hai." So don't do that. So love is for your family and friends. Don't fall in love with stocks. And as I said, you don't have to make it up in the same stock. And I totally agree with Sanjoy that you should look at what happens globally, but it's not easy for everybody to do it. I remember about 15 years ago going around to all the fund houses explaining that this is the trajectory of how telecom businesses are valued around the world and how the PE is reduced, because telecom is a business which has a natural limit to how much the subscriber base can be, because it cannot grow infinitely. It is not like other goods where you can keep saying the growth will continue. This is a finite number of people. And therefore, that trajectory all around the world had followed that, but nobody wanted to listen.
Actually, sorry to interrupt.
Yeah.
But in India, people would not believe you. You know why? I see so many people in our own business with 3 mobile phones.
Yeah, but
so
that's
you think it can grow to infinity, actually, when you see these guys.
Okay. And for selling, my very simple formula is that when you buy something, I'm saying that for the lay person, is that if you buy something at 50, don't tell yourself that I'll sell when it is 100 or 150, because that's the way you'll miss out on multi baggers, but always put a stop loss and put a trailing stop loss. So let us, for the sake of argument, suppose you put a 25% stop loss. It doesn't mean that if you buy something at 50, the stop loss forever is at 37.5. If it goes to 100, comes down to 80, you don't sell. Goes to 150, 200, don't sell. But from 200, it comes down to 150, 25% down from the high, then you sell. I mean, that's a simplistic formula, but for people who can't do anything much more than that, it's a reasonable formula to follow. Of course, you know, as a professional, you might do other things and you might sometimes sell something because you have better opportunities and so on. But the point is to, as far as possible, to let your winners run and limit your losses. I mean, that's the basic principle. And this is the way to operationalize that principle. But the thing is that don't say that, okay, jab market girega, stock girega, then I'll think about what to do. Because at that time you will freeze. So you have to put all this discipline in place to start with. I always say the best thing you can do for your portfolio when making an investment is tell yourself, I may be making a mistake. Because I can tell you a reasonable percentage of your investments are going to go wrong. They are not going to do what you thought they would do because, as Sanjoy said, you don't know the future. And investing is about the future. So if you, so you always have to imagine that the outcomes will not be and may not be the way you are imagining themselves that to be today.
Can I add one thing? Sure. Because it's quite interesting. Again, taking a cue from Devina. See, this is an area where, I mean, if you bat at 55%, in other words, if 55% of your decisions are right, you will be like Don Bradman. Most people don't realize that. Right. The professional fund managers bat at about 51.5. Superheroes are at 52.5. Most of us are at about 48. I am at about 45. So the important thing for those of us who are below 50, and this is another thing I'd like to add, don't overtrade. You're just enhancing the chances of going wrong. Think long and hard before you invest. Think about what you're buying. You own a business, but don't do this like as if you're visiting, you know, the gaming table, the casinos every morning. That's not investing. We love to call that investing. That is not investing. Put in the effort. You won't have to worry so much about selling if you put in the effort before buying. Just figure out what you want to own, how well you understand it, the amount of, you know, the clarity that you have about how things, nothing is certain, but about how things are likely to shape. And then, most importantly, and it was implicit in what she said, have patience. Nothing happens overnight. So, I think a lot of, you know, this idea that Buffett had, only 20 stocks in a lifetime. I know none of us will ever do it, but it's a damn
he has not done it.
No, he hasn't done it, that's true.
I mean, he sells 85% of what he buys within 2 years, majority within 6 months, so he has not done it. I mean, and he says that in 70 years of my investing, only 10 or 12 decisions have made all the money. Yes.
Which is true for all of us.
Yes.
I don't think there's a single
but you do not know in advance. I mean, sometimes people tell me that, okay, you identified HDFC Bank in 1996 or Amazon in 2001. Now tell us today's Amazon or HDFC Bank that I can buy for my baby and leave for 25 years. I said, nobody knows. Anybody who tells you they have this crystal ball on what a stock is going to do for 20 years is fooling you. Because no one in the world has had anything like that kind of track record where even 30% of their picks turned out to be multi-baggers. I mean, Rakesh Jhunjhunwala made all his money in CRISIL, Lupin, Titan. Did he know at the beginning? I mean, every time you would meet him, he would be talking of different stocks. He didn't know in the beginning that these would be the stocks, and these companies themselves went through so many ups and downs. I was reading this book on Titan called The Tanish Story, and so many times that jewelry business was on the verge of getting shut down because, you know, they made so many strategic errors along the way or something changed in the regulations. So, you know, no one has this crystal ball. So you always have to buy a portfolio of stocks chosen carefully, and 25, 30 stocks you buy across sectors. Even then, you know, 6 will turn out to be total duds. Some will give you reasonable returns, and if you are lucky, maybe 2 or 3 will be multi-baggers. So that's the ratio.
I think Devina is in a charitable mood. If you have only 6 duds, you're really smart.
That's what I said, please.
Yeah. So, the other thing about, selling, which I think is very important, which people don't get, is you should only sell again when you have a clear idea in your head about two things: opportunity cost. Because when you sell, you're raising money and you have to know what you're going to do with that money and how you're going to deploy it going forward. So opportunity cost of selling is very, very important. If you don't have something better to deploy it in, and you own what you think is a really solid business, you can also wind up selling too early, as I've done in my life. And I was reminded of it when Devina spoke of HDFC Bank. I bought it in 95 and sold it in 95. Because I'd made 100% in 95. And look where that's got me. So, it's not, selling also has that element of thinking about what do I do, what's the opportunity cost. And the second thing about selling, which I think is, don't mix up selling with paying tax. This is a wonderfully Indian habit. People in India just have a total anathema to paying tax of any kind. If you have that, you will make serious mistakes with selling. I know lots and lots of people in this audience who won't put up their hand because they want to be dishonest, who would have sold before March 31st for tax losses or tax gains. You can harvest anything under the sun. You're not going to get a damn out of it. There are going to be no fruits and no joy. So please harvest when, you're going to get significant returns from it. In fact, tax harvesting creates tremendous psychological anomalies which other smart people can, take advantage of. So this idea that paying taxes is not a good thing also affects selling tremendously. And don't do it. That's a very easy one to control. Sell because it's right to sell in your head, not because you're trying to get smart.
Actually, a question that your discussion brings me to ask you, how important is diversification, considering within equity and across asset classes?
Can I'll finish this in two sentences. And my response is very trite, because millions of guys have said it before me, wiser people, far wiser than me. I heard a friend of mine say, diversification is the only free lunch in investing. And there's a semblance of sense in this one. Diversification in a situation where you don't know what's coming at you going forward just gives you that extra sort of cover. If you own, all 5 stocks in one business and something bad happens to that business, when you wake up tomorrow morning, you can be crushed. Yeah? The second thing about diversification is, again, go back to history. And there are 1 or 2 exceptions, but look at the history of the concentrated investors. The guys who owned only 6, 7 stocks. I don't want to name people because they're much smarter than me, and I don't want to therefore seem that I'm, hindsight is always 20/20, so I don't want to do that. But there's a very famous Indian investor in the US. So with public money, he had a portfolio which owned just 7 and 8 stocks in his funds. And he went absolutely belly up in 2008. And he is supposed to be one of the great gods of investing today. Visits India often and dispenses wisdom on Indian stocks often, and he participates in chats like this often. So diversification for most of us with below 110 IQs is a great thing.
So, diversification, you mentioned all of that. Then, one is across asset classes. You must always invest across asset classes. People tell me, I'm 25, I'm in a good job. Should I put 100% in equity? No, you should never put 100% in equity. So have equity, fixed income, gold, real estate you might anyway have because you own your home. I'm not a big votary of investing in real estate. And then diversify across geographies. Again, don't put all your money in India. I always give this number that when I started working, the dollar was 12 rupees. In the course of less than a career, we have a 90% depreciation. So don't forget that part, that you cannot make a 20, 30-year financial goal plan and forget this statistic. So have that within equity, again, diversify across sectors. As Sanjoy said, that if you have 6 stocks in one sector, it is as good as holding one stock. So always diversify across sectors. And what diversification does, it is like tossing a coin. Investing is a game of luck and skill. Everything in life actually is a game of luck and skill. I can think of only chess, which is a game of skill alone. But if you toss a coin 10 times, you might get 8 heads or 9 heads. If you toss it 100 times, you'll be close to 50-50. So what diversification does is that if you buy a higher number of stocks, your final results are more predictable in the sense they will be closer to your skill level. You're reducing the luck element, you're increasing the skill element. That is what diversification does. It is not the magic that 50 stocks are better than 15 stocks, but that's the part that diversification does. But always consciously think through your asset allocation. And I always say in Google Maps, you don't just put the destination, you put the starting point. So first know where currently you are invested. What are all your assets and what are the loans against? So look at that and then think consciously about where you actually should be or want to be. And equity should be as a class, not I'm saying you have to hold the same stocks, but equity as a class should be money typically you do not need for 8 to 10 years. For what you need in that time frame, it should be in other assets.
One trivial addition, if I may, I know we've run out of time, but it's something that's very important in the current context, particularly in equity mutual funds. Nowadays I'm completely sort of amazed at the skill that Indian equity mutual fund managers have, because their portfolios have 283 stocks. There's a small cap fund, and one of the best performing small cap funds, by the way. Not to take away from that guy. I mean, his track record has been phenomenal in the last, the average mutual fund has 75, 80 stocks. Now, the one thing about diversification, anything good in life, it can be taken to excess. And when you own such large number of stocks, you actually lose some of the benefits of diversification because there are what are called cancelling out effects. The gains in, let's say XYZ will cancel out what you did in PQR. Second thing is very difficult to keep track of 85 stocks. It's unlikely that your 85th idea is as good as your first or second or third or fourth idea in terms of how much you thought about it. So diversification taken to excess is like my love for food. Taken to excess, it shows up.
So, that's why we use a system, because, I agree with you that you, as a person, you cannot keep track of that much, and that's why you need a system to do that. So that's why we switched. I actually started the PMS only after we had the system.
We can open the floor for questions. I think then that's a wrap. Thank you for making time.
Thank you very much for having us.
Let's have a huge round of applause for Devina Mehra, Founder, Chairperson, Managing Director, First Global, and Sanjay Bhattacharya, Managing Partner, Fortuna Capital. Deepti, please present a token of our gratitude to both of our panelists. A conversation that all of us were so tuned into. Thank you very much. Coming up next is a fireside chat that you don't want to miss. So stay glued to your seats, ladies and gentlemen. Thank you so much. Thank you, Deepti. Unicorns may be born from ideas, but they survive through scale, strategy, and of course, a fair share of chaos management. What happens after the $1 billion valuation confetti settles? These founders didn't just build unicorns, but they built them to last. In a world where bit scaling often meets burnouts, here's how Kar Dekho and Infra.Market are rewriting the rule book with Bharat First solutions, real profitability, and also a vision that doesn't fade with market cycles. Very shortly, we will be joined by them. Meanwhile, I'm going to invite you once again to please join us onto our social media platform conversations. Continue to share your thoughts and your take on what's being discussed on this stage. And when you do that, don't forget to use hashtag MintIIS2025. And on that note, time to call upon our speakers after the next 10 seconds. Harsh there doing a good job and making sure everybody is taken care of. Thank you so much, Harsh. Okay, here we go. Amit Jain, co-founder and CEO, Kardeko Group, and Souvik Sen Gupta, co-founder and CEO, Infra.Market, in conversation with Sneha Shah, deputy editor, Mint. Let's have a big round of applause, everybody. Come on. Over to you, Sneha.
Thank you, everyone, and thank you, Amit and Souvik, for agreeing to do this. You guys are the rare breed, like they call, you're the unicorn founders. Unicorn founders are those who have built companies that are valued more than $1 billion, and in the startup ecosystem, they're celebrities. So, we wanted to get a sense of, just to set the context of this fireside, a lot is being talked about, building unicorns. But what does it take to build a unicorn? How was it? The journey, I'm sure, was very difficult. It was through pivots. It was through changes to the initial idea. We would want to listen to all of that. And to begin with, Amit, if you can talk about how difficult was it to find the TAM? And, how difficult was it to really get the first 100 crore in revenues?
So when we started, honestly, I did not have any idea what TAM even means. Now I can say TAM and all, but when I started, it was about a problem that we faced while buying a car, and that was what we were trying to solve for, frankly. So I had to go to many used car dealers to find inventory. I had to go to many new car dealers, and I could not get the information. So I thought, why this is so difficult to kind of do. In those days, you had magazines which would have, articles which would come once a month, or on the red light, they will give a magazine which had used car listings. So that was a way, one could kind of get to the inventory or know the offers or know the specs of new car. I think that need ignited us to build a website which would cater to people like us. And honestly, I'll be candid, at that point, I did not know what is the addressable market. As we went into the journey, there were many people who were looking for similar information, and they started hitting our site. And we started seeing a traffic surge. By 2010-11, we were the most visited auto site. And that's when we realized we were sitting on something larger than what we thought. It was not built with the TAM thing, but now the TAM thing comes. Our biggest challenge was that industry was primarily offline. TAM was always there because to calculate TAM, it's simple how much money is being spent on marketing. And let's say if you're helping OEMs or dealers sell more cars, you're actually going to eat up from the marketing budget. So to calculate the TAM, we just had to see how much typically a OEM spends on marketing. And these were available because some companies were public. So we kind of guesstimated 2.5% of total GMV sold is kind of TAM for us. The bigger challenge was how much can we convert digital. And luckily for it was not us converting it to digital, it was Google, it was Facebook. Multiple players together were trying to get the offline spend to online. That kind of helped because there was a synergy of many players together. Though it was very difficult to sell the first lead pack, I personally went to many dealers to pitch this idea and was turned down. Online कौन आता है? कहाँ से customer तो हमारे दुकान पे आएंगे, online थोड़ी आएंगे. And then we sold first pack after many meetings. I personally sold it for peanut prices. But the dealers saw value. And I think if you create a good product and people see value in it, they start adopting to it. And technology makes a lot of stuff measurable.
So we were in our early journey, we were able to make money through advertising. So luckily for us, Google Ads was something that you could plug in without actually building a sales team. So that was the first thing we put on a site, Google Ads, and then we had a direct sales team to sell ads to OEMs, and then direct team to sell to dealers. This kind of helped us scale in the first few years to a decent revenue, and this probably got us to, let's say, 100 crore kind of a mark. It took us a longer time, frankly. It took us 8 years to reach first 100 crores. And it was bootstrapped company, so we never raised funds till 2014 is when we were actually funded. So as a bootstrapped company, we had kind of hit the 100 crore scale without actually utilizing any cash, and it was profitable every year. So big thing was that it's okay to go slow, build it with a very strong foundation is what I realized in hindsight, because since we did not have money, we had to build a strategy to get traffic free of cost. And I think in constraints, a lot of innovation happened on that front. So that's what kind of helped us to reach 100. But from 100, going to the next level was the other question that you had, ki 100 ke aage kya? So to reach 100 was not easy. It took us time, but was a strong, solid, profitable foundation and business. But from 100, like this year, we'll probably be doing around 2,800 crores. So there's a thing that I realized that you will be able to penetrate a market by a certain percentage. So let's say digital spend agar 100 rupees hai, so you'll penetrate 20, 30, but it will be split amongst many players. When you can foresee that you'll be stagnated by market now, because a market agar 10% grow kar raha hai, to aapka bhi revenue 10% grow kar jayega. Aapne penetration pura kar liya hai. So I thought ki yahan to matlab, the cap will come soon and it won't be very large. So what we thought is what we can do with the same customer, because we already had these online car buyers, we already had dealers whom we were serving. And then we started looking at adjacent problems, and that's when pivots happened. So we entered the finance marketplace, we entered the insurance marketplace. That's how Insurance Echo got formed. So we helped dealers sell insurance to the customers who were buying used cars from them. And 50% cars are not insured. So we said, we'll build a technology which can do the insurance in 10 minutes, and they used to do it in 10 days. Because we had an evaluation engine, we could value the car, we had digital pipes to issue insurance. So that's what we did. And then we expanded this idea to every pin code. Now we have around 200,000 agents who sell insurance for us on our platform. But the thought process was very, very simple, how we can capture adjacency. And every time we went into adjacency, there was a new TAM that opened up. And that new TAM that was opening up was basically helping us, grow. Last 10-year growth rate would have been around 70% CAGR. And last point I would say is, there is a lot of power in compounding. So you can go slow, but you'll have to seed ideas that will compound later. So you may not get immediate gain, and a lot of time founders spend on penetrating more market, but remember there's a certain percentage you can capture. Let's say if you're a skincare brand, you launched 3 products, you have captured the market geographically, let's say you expanded. But let's say if you want to grow more, you'll have to introduce more adjacent lines. So maybe I'm also mentor to a company called Minimalist, which recently got sold to HUL. They started with 3-4 products, retinol and all. But then they went into shampoos, which suddenly increased the TAM. So every founder should look at what is the expansion of TAM one can do. And you should do that expansion, in my view, when predictably you're going to hit the ceiling of the market share you can penetrate here. Right. That's how I would put it.
That's very interesting. And a clear contrast was infra markets growth. Shouvik, you guys decided to enter a B2B market where it was crowded by the incumbents. What was the conviction, when you began with a B2B company, and how did the first 100 crore come about? How did you, really explore your TAM?
I think the TAM was pretty clear from the industry size. So we started a building material platform, and our vision when we started, me and Aditya, the co-founder, was to build out a one-stop solution around building materials, right? And what was unique to India at that time is India's majority building material companies were single product companies. And at that time, we started with the vision that we'll create a one-stop platform around building materials, where people were primarily catering to construction companies, real estate companies, and now we've diversified into retailers and more B2C, but the vision at the initial was more towards B2B. And we will enable them to buy multi-products that they require for their construction. The TAM was self-evident. I mean, there were so many listed building material companies. It's a very well-researched sector. The market size is pretty well documented. I think the TAM was, I think the discussion point was around whether a single company or a platform can actually sell multiple products to the same customer on building materials, because no one was doing it. What I'll say is 2016 when we started, there was a lot of pessimism around whether a single company with a multi-brand approach can sell you concrete to paint, foundation to finish, all categories. That has changed drastically today. We have listed companies in India today who are into cement, paint, and now are getting into cables. We have listed companies in India who are building a platform around beautiful homes. So I think what we started in 2016, that we can provide a foundation to finish solution around building materials, has sort of got vindicated in how the industry is moving today. TAM was never a problem, scale was never a problem in this industry. We picked categories where globally there were companies where there was a lot of development or there was a lot of adoption in those categories, but India was lagging behind. I'll give you a simple example. India, 75% of cement sold in India is dry cement and 25% is wet cement today. When we started, it was perhaps around 15% wet cement, 85% dry cement. So I think the way we looked at it, at least at that time in the market, globally it was a complete opposite. Globally, in developed markets, 75% was wet cement or concrete. The only reason India wasn't adopting it was India had very low labor cost, which meant that you could buy dry cement and mix at site. India in tier 2, tier 3 was not too vertical. So you could use dry cement and build, and it took time to build projects. It was a very clear evidence that eventually wet cement was growing at a CAGR of double the CAGR of cement, dry cement. Very evident that India was going to move from dry to wet. Today, that adoption is still ongoing. But when we started, we were one of the early entrants in wet cement without a cement brand. Today, we are the second largest manufacturer of wet cement in the country. I think the way we looked at it was, we picked categories where there were less incumbents, but globally the categories had advanced. We picked AAC blocks over bricks. We are the largest manufacturer of AAC blocks in the country today. We picked categories where incumbents were not present, where within that category, the brand penetration was as low as mid-20s. So we knew there was a large fragmented market. And those were key sort of decision-making points into entering categories. So first point is global adoption, and India is lagging behind. Second would be where there were less incumbents and less brand penetration. And third most critical thing was it had to come into our overall vision of providing solutions around building construction ecosystem. So if you were supplying to a construction project and you supplied concrete, and the next product you supplied is blocks for the walls, and the next supply would be tiles for flooring, the idea was to build adjacency so that as the project sort of developed for my clients, I could keep supporting them through the entire life cycle of the project. And so I don't think revenue was ever a problem.
So when did you hit your first 100? How soon?
4 years. It took us almost. We started in 2016. We were bootstrapped till 2019. I think we touched 100 crores in FY20, financial year 20. So it took us 4 to 5 years to hit the first 100 crores.
Right. Yeah. And you said that, you entered categories where, there weren't many incumbents.
Yes.
Right. But then it was a capital intensive category where you were trying to build those products, unlike Amit, where he was trying to, sell an inventory. Right. So how did you, really manage? You said you were bootstrapped till 2019, because access to capital before 2020 was really difficult.
We built how every entrepreneur in India who is not a startup builds. We mortgaged everything. We mortgaged our parents' house. I think Aditya mortgaged his in-laws' house. We did it. I mean, that's how we build businesses, right? I didn't know the term VC when I started in 2016. We built this out of Bombay, first of all. So we didn't have the privilege of being close to coffee shops where VCs lurk. But I only started understanding that VCs exist and B2B exists. B2B investments exist in 2019-20 when we approached. But apart from that, I put in my savings, my co-founder put in his, we mortgaged our parents' house, raised debt capital. We would be one of the few solo-called startups which raised debt before we raised equity. Right? And we built this business. For us, the business had to get us salary homes. We didn't have any luxury of an equity for the first 4 years. So we had to ensure that every rupee we sell, we take home what we need to take home. So we built it like that.
Right. Amit, to your point where, you were extremely profitable company for the first 10 years, you had your eye on the ball when it came to building the company in a very tight environment. And contrast to that, we see startups being, that are funded in the ZIRP environment, the zero interest rate environment of 2021, where, growing at a faster pace was more important than, keeping your eye on profitability. Of course, now again, we are back to, talking about, but how difficult was it to maintain that balance between growth and profitability where, of course, as a founder, you want to be out there and, open, say, 100 centers, but then your P&L doesn't really support that.
I think it's a fine balance that you have to strike. Growth and burns or investments, as you may call it, come hand in hand, and you'll have to choose your path. And for us, we basically wanted to grow, but we did not want to grow 10x in a single year because the nature of a business is different. But certain spaces you will have to grow. Like if you're in quick commerce, you'll need order density. There's no other way to get the unit economics right until you have in a one pin code a large density of orders. So you'll have to there is no right or wrong answer here. I think basis the line of business, basis the context of business, you'll have to choose your path. We chose a path which definitely made us grow 70% CAGR for last 10 years. And we also were able to optimize on unit economics at the same time. And in our industry, we could find that sweet spot. Some industries may have much larger burn to get there. But look, finally, every business is made to finally eventually give profits. And that's something that is non-compromisable. You may have capital cycles of, easy cash available. You may have capital cycles going off. But in all fairness, eventually whoever is investing wants some return on the money. And that will only come once you turn it profitable. It may be later that you turn it profitable, but that has to be the case. Which means that in steady state, your model has to throw back cash. And the way we measure it is like, it starts with CM1 negative. Let's say you're funding the product to sell. Then once you are able to, kind of recover the COGS, you're CM1 positive. Then you are manpower positive. You're recovering the manpower cost involved to sell the product, CM2 positive. And finally, your tech fixed cost, CM4 level. So you have to basically see that at scale, the profitability per unit is going to come and the scale addressable market is large enough so that you can recover the fixed cost of technology management you're putting and then get profits. I think if that model is on paper there and you're showing trajectory that quarter over quarter, you're showing the trajectory and all CMs flowing down, it's very visible that you're getting there. I think you'll have people who will invest in the scale up plan also. But fundamentally, you'll have to definitely make sure that eventually it should make money and there is a trajectory that you're demonstrating to get there.
Right. Shovik, there's often this dilemma in a founder's mind on build versus buy, where and we have seen that infra market has gone in and done some inorganic acquisitions. So how did you really decide on, because a few categories you incubated and you did it yourself, and then RDC, you go ahead and buy an RDC concrete company. So how did you arrive at that?
So I think every acquisition that we've done, the decision has been primarily, it's not one thumb rule decision on whether we build or buy. It's very unique to that particular acquisition. When we started, we were more asset light. We used capacity already done. We leased them in and we basically manufactured on our own and sold products to the customers. Then we decided that we need to own manufacturing. RDC was into concrete business and they were a manufacturer. They had manufacturing capability that we did not have at that time. And we thought it was important to acquire that asset. I think it's not build versus buy. It's about which capabilities you can build yourself and how easy or tough it is for build, and compared to some capabilities that we want to acquire and bolt on. Eventually, there have to be synergy benefits. For us, we've done 3 large acquisitions. One is RDC, which we acquired because we wanted to do manufacturing capabilities. We've acquired one paint company because we wanted to acquire a brand in the retail segment and we wanted to sort of scale it up. And we acquired tiles companies, one tiles company because again, we already had a brand, but we again wanted to backward integrate our own manufacturing. So there were 3 different decision-making points on 3 different acquisitions. We continue to believe that the right acquisition can be extremely transformative. And we have been acquisitive in nature and inorganics have spurred our growth. Again, we will not buy something where we have own capability to build. But if something is easier to buy, I think it's the right decision we feel it was the right decision for us to go ahead with it. RDC has been extremely successful for us. It's been 4 years since we acquired. We acquired it in 21. The company has grown. We acquired from a private equity fund. The company has grown 4x since we acquired it. Extremely capable management. We've hardly made a change. We've just pushed the growth pedal. And kudos to them for what they've achieved. But it's been an extremely successful acquisition.
Right. And founders are often married to their initial ideas, how difficult it is to, say, pivot to, drop a line of business or, plug in a leaky hole. Have you had to revisit any of your plans, Amit, in your journey?
Yeah, look, finally, founders are very optimistic by definition. कि सब कुछ चलेगा, जो भी करेंगे will turn gold. And I've had to shut down many businesses, I'll be candid. And it's not like that we know everything, we also learn every time we fail. And even at late stage like this, you end up failing. ऐसा नहीं है कि अभी भी जो खेल करते हैं वो अच्छा हो जाता है. We started used car retail where we had to, buy a car, refurb it and put it in our own showroom and sell it. For which we are a digital platform already and we were backward integrating the process of buying and trying to extract more margin pool. And we honestly miserably failed. We could not find a profit pool. A dealer probably does a better job in managing his economics versus what we could do. And per car we were losing money and I could not see a sight of profitability. And even if I could see 20 things had to go right, and I would probably make a % out there. And supply was not particularly in our control because it's a fragmented supply. Unlike developed markets where leasing companies provide a lot of supply. So we did shut down businesses. We lost decent money before we shut it down. But I never have allowed, good money to chase bad money. So it's okay to, kind of live with the fact that this didn't work out and you had learnings because every founder who fails honestly learns a lot. And in our company, in fact, we welcome people who might have tried our idea and would have failed because I think they are more learned than anybody else, I would meet otherwise. So failing is a constant process in my view. I still learn every time we try something new. Second thing I think I've realized in my life is founders are so optimistic that they start doing 10 things at the same time. So I started accessories, I started tires, I started roadside assistance, anything and everything that one could think of in the space, I started parallelly. And a year and a half later, I realized in everything we did a very mediocre job because I was personally stretched very thin across all these projects. And with little focus, you don't build anything great. You build mediocre solutions. So it's better not to pick up, be too optimistic about everything. And I believed I've hired a great team, it will happen. Founders have to put in their, time and effort to make anything successful or invest inorganically in a company where you have a founder who's really extremely good. So the learning I've had is that don't do too many things at the same time, have management focus, value the time the most because that's the only limited currency. Money you can still raise, but you cannot raise time. So just value that the most as an asset.
Right. Shouvik, what are the white spaces that you're excited about, in your line of businesses?
No, we continue to be excited about some of the products that where we are leadership. I think it's not a very attractive topic to discuss on, but concrete I think is one of the, you will see a lot of development in categories like wet cement in the next decade or so. You will see multiple companies come out of this space. The next generation of building material companies will be built around categories where we are not expecting today. I think concrete and walling products are some of those categories which are white spaces where no one's looking at them. India is today technologically backward in the sense of the products that we are using, and we see that development coming over the next decade. I think we are very excited overall over our B2C segments. We are focusing very strongly on categories which get us to people's homes, whether that's tiles, whether that's paint. We really believe that we want to eventually build out a building material brand and not merely a platform, but eventually be a brand around building material people trust. For that, B2C is a very important category for us, and that is also a white space we are very focused on.
Right. Amit, what are the white spaces you are excited about?
Look, in our category, we find white spaces basis what a car buyer can do. So car buyer takes loan, we started loans. Car buyer does insurance every year, we started insurance. What we realized was these people who buy car insurance are also the same guys who buy health and life insurance. So we expanded into health and life. So our white spaces are typically linked to the 5% India that has affordability capacity, and are we present at the touch points where we are interacting with them at the time of event. Like if he's in a car buying process, he'll take a loan. And that's when he's on a platform. And then that's when he goes to the dealer, and I know which dealer is, gonna cut the loan. So my white spaces are backward integrating into things like, for example, let's say if we have built very large distribution of loans, can we make our own NBFC which can, lend digitally by providing a experience that is 10x better than any incumbent bank? Things like those will become our white spaces as we move in the journey. But common thing that I've used always is, can the technology create a leverage? Which means, can technology make the experience for the end consumer, which may be dealer, B2B, or the end consumer, B2C, 10x better? If it can, then there is something you're disrupting. Or you have a right to win. Let's say you have the customer and the knowledge about customer transaction, which otherwise is very difficult to collect by marketing. So you have a CAC advantage, you have a ecosystem advantage of knowing players already. And if you can build something on top, I think that's when magic happens. So practically, our white spaces are exactly around. We have also been evaluating aftermarket, like we know who are the car buyers, can we help them in maintaining the cars. One white space we realized was, mobility. Anybody who's buying a car will eventually also go on a vacation where he may want to do a self-drive rental. It's very popular in developed markets, Hertz and all. So we invested in a company which does, self-drive car rentals called Rev. So we believe the same car buyer, same profile will also move into mobility, which is rented mobility. It could be leasing also eventually through this asset. So we're looking at different forms of mobility. So instead of thinking as car buying, we are saying let's go up. We are a mobility platform. We can help buy, we can help lease, we can have lease, can be of two types, short-term, long-term. So we're just expanding a TAM in a way, frankly, through these pivots.
Right. When you started, Amit, you were a category creator, right? Because, this category did not exist. And then come these, challengers who are armed with more capital. How do you really fight? Because the market is sort of getting crowded when it comes to,
No, I think you don't fight the competition, you just perform better every day is how I put it. We don't discuss competition in our meetings, frankly. We do discuss in the boardrooms the competitive landscape, but in our day-to-day, we are more bothered about are we becoming better every day. And if we are doing that continuously as a self-critical, self-evaluating mode, I think that works better. Obviously, if competition has launched something that is definitely better than you get inspired. But just blind copies typically don't work, is my view. And second, you'll have to be very connected to your ground team, because most of the ideas I've realized come from your ground teams. Because when you're sitting too far from the real customer in so many different layered team structure, you really don't hear the great ideas, because great ideas are given by consumers to our field teams. So I still read a lot of my feedback that comes on the site, for example. I think that's a way to keep updated and build a better product. Just keep on building a better product, better experience. I think that's how I view it.
Right. And both your companies are IPO bound, so I know that I can't ask you much, but what's the expectation, growth expectation going forward, getting into?
I think the industry is going through a lot of growth, and we've sort of we've grown multifold in the last few years. I think more than growth, what we are currently focused on is, we've always been profitable. I think we're focusing on better profitability and better cash flows. the industry, I think there's enough opportunity for all to grow. The industry is changing. A lot of the large incumbents are now moving towards platform approach, whether it's large companies who are building multi-product and going towards adjacencies. So the industry is going through change. We are trying to adapt. We are also, while we were one of the first to start, but we now see a lot of companies now going that way. I think we have to adapt to that change. Growth has never been a very big concern for us, considering the kind of spend India does on construction every year, the way real estate construction is going to overcome in the next few years, considering the booking of the past few years. It's about profitable growth, high quality revenue that we are focused on. We have great leadership, and I think at the moment, that's the focus area for us, is to ensure that our profitability numbers are at par with the best in the industry. That's what we'll continue to focus on.
Right. I think we have time to take a couple of audience questions. Yeah.
Good afternoon. This is Pravesh from Tata Capital Decarbonization Fund. So we are looking to invest in companies on the private equity side. So I just wanted to know, the question is to both of you, that during your fundraise journey, how did you iron out differences around valuation with the investors? How challenging it was? Because I find that quite, difficult and this times of the market, sometimes young founders, kind of want the moon in terms of.
I know this sounds cliche, but you don't really care about valuations a lot once you understand that the value of the founder in a company is unlike traditional companies, or even, is not determined by the percentage of holding you have, but the value you create for the organization. I think once you get that out of the way, I think founders are not scared about the valuation, they are scared about the dilution. We are young founders, we are building for the first time. Most of us don't come from business backgrounds. And when we are first raising, I think the first thing that scares us is I'm giving away a large percentage of my business away to an investor who is investing in hundreds of companies. And I'll have to explain every decision to them, and will they give as much time to the business as I give? Will they understand from everything from my point of view? I think once we understand that investors are in the business of investing and not in the business of running businesses, and they will continue to support founders no matter what their percentage holding in the business. You could have a single digit holding, but so long as you create value for your organization, you will continue to be valued by the board. I think once as a founder you get that clarity from your investors, then valuations are just some benchmarks along the journey. So long as you have control on what you're trying to do, what you're trying to build, I don't think we really care about valuation and dilution, to be honest. That's my take on this.
I echo Sauvik's thoughts. In addition, I think founders should not be too worried about valuation, it's about value creation. Most important point is I've actually taken at times lower valuation than what was being offered by the best investor. Best valuation I rejected, just for the fact that I thought, where will I get more value from the investor? So you always don't choose valuations, you also choose value that investor brings on table. Keeping the board compact is a very good idea, because then decision making is faster. So if you don't give too many seats out, it helps you in a longer run, frankly, in decision making. You have a lot of control as a founder on how you run the show, because you have to align much lesser people. Secondly, I think keep on refreshing the cap table after, let's say, 10 years, people will have a rollover period. So the guy will have decision making capability basis that he needs to exit now. And somebody who is coming in now will invest for next 5-10 years. So you'll have to also think of refreshing the cap table, because every investor may have a different goal, and his advice or his inputs to the board may be function of which stage he entered and which stage he needs to exit.
Right. Thank you. Anyone else? Yeah, gentleman over there. That would be the last question.
Hello, Souvik. This is a question to you. 2017, we saw one company which was into your segment called as Shankara Builders. And it was a, I guess, watershed moment for Indian capital market. We got our Home Depot, that was celebrated kind of company. But if we closely look at last 7-8 years, the company did not perform in that way. So, Any key learnings, like such a big giant didn't perform so long?
I would like to comment on a specific company, to be honest. All I'll say is, and we've studied obviously most competitors or most incumbents. Again, we did not start out as a platform where, okay, so companies you're referring to primarily distribute products. 70% of what we sell today is our own brand. We are structured as a house of brands where we bought out brands eventually because we did not want to only sell other people's brands. We started as a 100% distribution business to today a 70% private label own brand business. And out of that, almost 30% I manufacture myself. The reason we went that way to have our own brand existence is India values brands. India pays a premium to building material brands because India values the trust that goes with the brand. Today we see cement companies advertise in cricket tournaments. Nowhere in the globe that happens. You don't see a global cement company advertise in a football World Cup. And you look at a cricket match in India, out of 40 brands, 20 will be building material brands or home decor brands. Why do the people do this? Because the B2C presence that you get, the consumer values a well-known cement brand also. If your contractor is buying an unknown cement brand, you will tell them, I don't know this brand. The reason India does this because India is inherently slightly low trust, where they would like to know the brand. So I think in India, building a pure play distribution business in the space, like you mentioned Home Depot, right? Their distribution is more than their own brand. Building a pure play distribution business is risky and has a lower margin profile because the consumer loyalty sticks is to the brand and not to the platform. The consumer wants the brand. If you want a particular paint brand or you want a particular cement brand, you want that brand. So if tomorrow the brand pulls out of my platform, I lose the customer. The customer doesn't keep coming to my platform for the same thing. So I think in India, at least in building materials, it's important to own the brand, and that's a journey. That's a decision we took. We sort of from 2016 when we started to today, we very clearly focused on building own brand in each category, with the thought process that to eventually own the customer, you need to own the brand. That's something different that we have done.
On that note, we'll end this discussion, and I hope that their insights are going to inspire a lot of founders and help them in building unicorns like they did. So thank you so much, Shouvik and Amit, for taking time out and speaking to us.
Thank you so much, Sneha. Sneha, please present a token of our appreciation to our amazing panelists. Ladies and gentlemen, a big round of applause is in order for our fantastic panelists. Some incredible insights coming up there. Thank you. Thank you so much. Thank you, gentlemen. Thank you, Sneha. Well, this is where we break for lunch, and when we come back to our seats, we'll be hitting cruising altitude. At 2 p.m. sharp, we begin with the next segment of Mint India Investment Summit. See you all on the other side of the break. We are going to kick off with our very first panel/fireside chat. You are at the 8th edition of the Mint India Investment Summit, and I know, segment 1 of day 2 has been absolutely terrific. What even excites me more is the buzz outside during lunchtime. So many of you walked up to me and said, we're so thrilled to listen to the speakers that are going to follow. A lot of you even walked up to me and assured me that, Zina, we don't need any kind of energizer because your panelists are all absolutely rocking. So, well, that just makes my life easier and yours too. I hope you had a lovely lunch. I hope you had a fair balance of the ghee, the oil, and the sugar. And I usually say sit back, relax, enjoy the show. I won't say that. Come to the edge of your seats and be prepared to talk about the future of D2C brands. Can platform models survive? Customer acquisition costs are rising, marketplaces are flexing, profitability is the new vibe. Can D2C brands go the distance without handing over the reins to aggregators or platforms? Comes the grind, and also come our next speakers who are here to discuss what is it going to take for D2C darlings into long-term category leaders. Let's welcome Deep Bajaj, co-founder Sirona Hygiene, and Swati Kulkarni, director Fireside Ventures. Talking to them on this subject is Ranjini Raghavan, editor, Deals and Startups, Mint. And just to do a quick vibe check, Ranjini, and make sure we're all vibing on the same page, can I request you all to put your hands together in a round of applause, at least 10 claps, so that you activate.
Yes, that's a
get
great
into
idea.
the alpha zone. All right,
especially for
Ranjini.
post-lunch sessions.
Yes, all yours.
But we have brilliant speakers, so I'm sure it'll be extremely enriching and entertaining for you all. To set the context, D2C brands as such really took off after COVID, where we saw many of them scale to a fairly platform-like level. But there have been several challenges as well. Many of them have stagnated, many of them have failed as well. And to discuss this subject on the future of D2C brands, we have two eminent panelists. Deep Bajaj, he has scaled brands, he has sold them to platforms, and then he has acquired them back as well. And Swati Kulkarni, an investor from Fireside, which pretty much invests only in the consumer sector, especially in D2C brands. So thank you so much, both of you, for coming here. Deep, I thought we'd start with you. If you can, tell us about your experience with Sirona, how it started, how you scaled it, and then sold it to Good Glam, and then what happened?
So starting was fairly clear, that there were women in the country who were facing a lot of hygiene-related issues, which were unaddressed. So we started with this product called Pee Buddy. Pee Buddy was India's first stand-in pee device for women. And that led to entry into other neglected areas like in menstrual hygiene as well. There were challenges like the whole country was only talking about pads, while to be able to perform best, there are pads, tampons, liners, menstrual cups, other products as well, which were missing. There were a lot of period-related issues that nobody was solving, like for period pain, there was only a hot water bottle of painkillers, nothing for rashes, nothing for disposal. So all that is what Sirona started solving. Luckily for us, marketplaces, with Amazon, Flipkart, Nyka's, getting to scale and connect the brands with the consumer, we were able to solve our distribution problem, and brands started to do well online. We were doing that till about 2021 when Good Glam came in, and we decided to get into a strategic partnership with a vision to take the brand offline and global. That happened till about last year. And then the opportunity opened for us to acquire the brand back, and I just acquired it back.
And
so that
you
was
have
the
a plan to scale it further now?
Yeah, now the journey forward is we believe that there are still many unaddressed issues, right from puberty to menopause, which we would like to solve with unique products. And the idea is to use whatever are the right channels today. When I started, it was more about saying go to marketplaces, then D2C own website became the norm. Now it's quick commerce. So yeah, whatever it takes.
Yeah, we'll come to quick commerce, but before that, Swati, how are you looking at this entire segment? Because a lot of these brands, D2C brands, operate in segments which the legacy companies don't have time to work on or innovate in. And so what are investors looking for when they are investing in this segment?
What we look for is, we see it from a lens of saying that what is the consumer insight that the brand has, right? What is the problem that the brand is trying to solve for? And like you said that, we think digitally scaling the brands to a certain level is probably the right way to build a brand initially. Get to know your consumer, get to know what is the product market fit. But the key, I would say, Ranjini, is that, we want that consumer insight. Without that, I don't think there is a brand, which will exist without that. So that's what we as investors look for.
And are there particular sectors within D2C where you think the action is very hot this year?
Yeah, so we think that there are multiple sectors. In fact, we go very deep into thesis areas. We have like 30 thesis areas, across food and beverage, across beauty and personal care, health. And we see it from two lenses. One is the macro trend, and then we get into saying that what is the consumer cohort, right? Like, what is a Gen Z looking for? What is a millennial looking for? And also there is a lens of saying India 1, India 2 and India 3, like what are the brands building for? So these are the few of, basically it's a triangulation of all these things that, that a brand should have, and what is that pain point that a brand is solving for is what we look for. And we do a lot of consumer inciting work, to understand what is the from a consumer point of view, is that brand really solving for any problem?
One of the things that consumers have really voted for over the last 1 year especially is the quick commerce channel, which has seen D2C brands just take off and gain, perhaps to an extent, even loyalty, customer loyalty, which many D2C companies struggle with, at least initially. How has that changed the world for both of you, if you can tell our audience?
Yeah, sure. I think we see quick commerce as a channel which will really scale some of the product categories. Let's say like food and beverage, which was not, lending itself well to e-commerce, where AOVs were lower, fulfillment costs were higher, but quick commerce has changed that game. So we think food and beverages is a category which we will see a significant unlock in terms of quick commerce. Even beauty and personal care, effectively it's a behavior that is mimicking a GT general trade, right? And we are saying we would probably send a WhatsApp list to your grocer and say that ye deliver kar dena, and now we are just using our app to do it. So what is also happening is we are seeing that companies have to evolve their supply chain very differently to address quick commerce. So that is very important, right? You could have probably you could have earlier only a central warehouse, but now you need to have different multiple warehouses to cater to the cities. Swiggy is present in like 100 plus cities, for example. So you need to be available, supply chain wise. So there are, I would say, like categories like snacking, like Deep was mentioning, categories like ice cream, you are seeing now multiple brands coming up in that category.
Other than food, in personal care, which is your terrain, how has that changed?
Well, I think it's a behavior. They are, to me, I look them as, like Swati very rightly said, it's the general trade solve for us. Earlier to be able to say that I can solve if you need a period pain patch, can I deliver it in 10 minutes? It's like really wowing the customer. Today, quick commerce has made that a possibility, and that consumer behavior has already shifted. But it's one of the channels for us. And I think because that behavior has changed, it is, as of now, for the next 2 to 3 years, a very critical channel for all D2C brands to focus on, especially if you're in a low average order value category. Because earlier to deliver a 70-80 rupee product or a 100 rupee product from Amazon and Flipkart did not just make commercial sense. So at a unit economics level, it was not possible. Like she mentioned, if you were into ice creams or yogurts or confectionaries, those categories were impossible to survive. So for many categories, it's a blessing. For many categories, it's a blessing for all the categories, but especially for newer categories, it's great. For guys with higher average order value and who want to really, engage with consumers on a regular level, who want higher repeats, I think own website would continue to play an important part in CAC, in acquiring the newer customers.
At what stage, say quick commerce, you scale to a certain extent, at what stage should D2C brands think about offline? Because that's become a do or die for them, if otherwise, to prevent stagnation of revenues. So,
yeah, so we have, playbooks for each of our brands saying that which are the categories, when should you think of going offline? How should you go offline? So I would say that, probably at that 100 crore scale, you should consciously think of going offline. We don't think yet, like you should bombard the GT channel with your products, but start small, probably, try it out in a city, try it on a certain cluster, see what is working. Because scaling online versus scaling offline is completely a different ballgame. You will need to be sharper in terms of your SKUs. You can't have long tail products on your shelf because that will imply that, your products will come back. So it is very important to have your supply chain right. It is very important to understand what is really selling, because in e-commerce or quick commerce, you can just keep listing products and that it doesn't cost much. But for the retailer, it costs his shelf space. So have those sharp product category focus, have sharp SKU focus, and then you can go offline. Start going offline from 100 crores. And then as you scale, obviously you will learn, you will make mistakes, so that by the time you are scaled to a 500 crore, then you will not make those mistakes because you would have already made mistakes when you're smaller, I would say.
Yeah. And offline obviously is a clear way to scale. Many brands tried the Thrasio model to scale as well, and that clearly may have been overstated, as we now know. Deep, I thought you might have some experience in that segment. If you want to talk about that or the broader Thrasio segment, what may work or what hasn't worked, definitely.
So see, Thrasio model is where, you're selling online, and let's say you're a marketplace seller and you acquire a lot of other brands, assuming that you will be able to, because you're already selling one brand well, profitably, you have a supply chain, you have the teams in place, you'll be able to replicate it on others. So that's essentially the Thrasio model for the ones who didn't know. What has worked and what hasn't worked? What hasn't worked is, you need to be absolutely on top of your entire supply chain game. If you yourself haven't championed it yet and you put another product and another product, it's like foster parenting, You need to raise the first child well first. Ensure for the second child you have enough money in your pocket to be able to supply for the needs that one child individually has, so that you don't become unfair to it. And that unfortunately happened in a lot of companies who acquired many brands together, while maybe the parent brand of theirs needed far more care. And I think the ones who will do well in future will also be the ones who are able to articulate it well, that this is where the child is right now, this is where the brand is right now, these are the needs for the next 12 months. And independent of whether we have one brand, two brands, three brands, we will be able to do this A to Z for each brand. Some of the things, you can benefit maybe, a little bit in supply chain operation, the same teams can manage, but brand, for example, as a function, NPD, for example, as a function, have to be very, very brand specific, which is where I think some of them went wrong. They thought, the brand stories are already created, while these were all brands in infancy,
So it was more of an execution problem, and of course they took too little time to allow it to play out. They tried to rush it. So does that mean that if you allow people enough time, it could potentially work?
See, I would say statistics for M&A is not great, right? Like 70% of the M&As fail. So it is very critical to acquire and integrate brands first, right? Like Deep was mentioning, like do the first acquisition well, integrate it well, and then you can probably, once you've perfected this, probably then you can do a roll-up model. Having said that, there are companies which have not succeeded, in building this. May not be so much in India, but there is a company called as ISS, which is into facility management. Their whole model in Denmark is to buy and then scale, right? And they have succeeded extremely well. So it is about how well you integrate your first, second, third acquisition, and then you can have a playbook saying that, okay, I'll keep acquiring. The only other company I can think of probably who has done decently well is Global Miis. They have done a good job at execution. Also, very important to understand what product categories you're acquiring. You can't have disparate product categories, then you'll not be able to realize synergies, whether supply chain or whether distribution synergies. So I think it's a mix of a lot of factors that go into making an acquisition successful.
I also feel don't try to retrofit it. Just because an opportunity is available, don't acquire it. I think the question to ask is, does it fit well with our thesis? Is this something that we had to anyways build, but we are getting it and we are paying the higher price right now for the cost of learning? Correct? But yeah, just because it's available and the math's working.
And the founder also may not have the expertise to operate in that new category. Yeah. Another emerging theme of the last 2 years for D2C segment at least has been the fair bit of consolidation that has happened with companies like HUL. D2C brands were competing against the likes of HUL. HUL has sort of, acquired Minimalist at least was the big deal of last year. How do you expect this? Do you anticipate this trend going forward?
At least I think that this trend will continue going forward, because what the large incumbents struggle from is innovation. They are not comfortable taking that first initial bet saying that let me launch this product, let me launch this brand, it's okay if I fail. I don't think the skin in the game for a brand manager is really high, right? So I would say that for them the strategy probably will continue to be to acquire brands which will scale in a different product proposition compared to what their existing brands are. Like in case of Minimalist, like in case of Marico acquiring Beardo or Plix, they have done a good job at scaling. And again, it comes back to the same thing as to does it fit, what are the synergies you can derive, like can you get that brand to scale offline? Because most of these large companies probably have a very good offline team, but they struggle with the online bit. So, and some of these, new age companies are very strong in online. So they have scaled at a particular scale and then they need to go offline to become larger. And that is a perfect match, I think, for some of these large companies like HUL. They've acquired Oziva as well, right? So it makes sense for them to wait, see that there is consumer love for that product, for that brand, and then acquire and scale it significantly in offline.
Once they do acquire, once say a company does acquire, does the brand retain the characteristics of being D2C? What made it, hit that level of success? Is it a tricky question for both of you? Actually, in your experience, have people managed to, because sometimes they don't, like it becomes an old legacy brand. That's where I'm coming from.
See, I think it is very important to retain the brand ethos, right? Otherwise, the whole purpose of acquiring then gets defeated. While I think jury is still to be out, at least in India, on how well these brands have scaled under these large companies. But globally, you have seen decent, examples where they have acquired and they have scaled those brands as well. I don't see why that will not happen in India. Like, for example, Minimalist it was like a 500 crore brand when they acquired, and I'm sure now if they put it into offline with all their offline mind, they will be able to scale Minimalist. Similarly, like I said, Marico has done a great job with Beardo, with Plix, right? They have managed to scale the brand to a good level and retaining the brand ethos that they acquired them for.
At what level should a D2C brand think about exiting? Like, is 500 something? Deep will have a good answer for that.
No, I don't have a good answer for this. I think you should look at exiting when you, as a founder, feel that the value that you're adding now is just incremental. And when the brand, like in our case, we were of course, trending at about 150 odd crores. But within the online, whichever game we knew well, we were topping it, right? Like we were good in marketplaces, we were selling it profitably, but there was only so much growth, and quick commerce hadn't come in by then. The opportunity came in where now from 150 to 500 crores or to 1,000 crores, the brand could be built offline. So we took it. And so for every brand, I think the minute the founder, or the time the founder knows that, this is the max that we can go within this. So either you do fundraise or you look for a partner with whom you can grow it. But the idea is not exit. The idea is to say that the brand needs to grow to the next level. Correct? So, yeah.
So do you think with quick commerce, the 150 threshold could become like 500 or 1,000?
Yeah, it can become 1,000 now. Because, okay, so there was marketplace was doing, let's say, one part of the puzzle. And then there was general trade. Quick commerce essentially is general trade. Today, I don't need to go and appoint 500 distributors all over the country. I can talk to Zepto, Blinkit, Swiggy, and these guys are doing just that. Dark store is your neighborhood kirana store. Right?
Isn't it expensive though for D2C brands, the quick commerce channel?
Honestly, for me personally, I think it's cheaper.
Okay.
It's like, general trade in the traditional sense for FMCG is like playing a test match. We as D2C brands, are used to T20 format, so that game has different skill sets, different, I would say, the resources required are very, very different. The tracking mechanisms are extremely different to how we track online. So for me right now, I think it's become cheaper because now I have the site, if there are about, just for discussion, if there are 1,500 dark stores, at the dark store level, I know which product of mine is moving, which day, is the weekend sale high, is the weekday sale high, and the pilferage is very low. Which is what the Maricos and HULs and Daburs of the world have championed over centuries and decades. They've put systems in place where they have the site on the last point of sale, which is what quick commerce is giving us.
Right. One, you wanted to add
I just wanted to add, even we think that, quick commerce as a channel is probably easier to scale. Profitably also compared to GT. Also, don't forget for GT, there's an additional sales cost, right? The manpower cost involved for servicing a GT is quite high, which is not there for quick commerce.
So quick commerce actually works out to be cheaper in that sense.
Yeah.
It's more efficient. Like, you would otherwise need, let's say if you have to launch a soap and you want to make it available, and let's say it can be made available at 50,000 outlets in 10 cities. Every city you need, the CNF, then you need distributors. Distributors serve only these many number of shops. So for Calcutta to cover, let's say 10,000 shops, you need 50 distributors. So I need now for 50 distributors, I need somebody who can service them. So ASM and NSMs, and then the sales officer who will go to each and every store. So like she said, it's a cost. It's a very, very different animal. So it's more economical and it's more efficient.
Right. One subject I wanted to sort of pick your brains on is the overcrowding categories within quick commerce. I mean, within D2C brands, essentially, there's so many of them. How do they build customer loyalty? Is that a challenge? At what level how should they think about breaking out within that segment?
See, I think, yes, there are few segments where there is overcrowding. One definitely is BPC, and the other probably to some extent is also fashion, where we are seeing fragmentation. The brand loyalty is a challenge, but again, goes back to my earlier point as to what is that consumer insight that you have, because of which it makes consumers keep coming back to your brand. Like, for example, I'll tell you, we thought that BPC was a really crowded category, but we recently invested in this brand called as Moxie, which is for textured hair. I think it's an insight that probably nobody had in the market, right? Saying that 70% of India's women have textured hair. So there is no products that cater to that textured hair. And they are scaling extremely well. In 9 months, they have around 30 crores of revenue. So it's all about getting that right consumer insight and making the consumer come back to your brand. That is the key. Obviously, there will be some consumers who will be like fickle, but what is that core consumer you are targeting and how large that consumer set is? I think that will be the key to being a standout brand.
I want to pause here for a minute to see if we have audience questions. Yes, ma'am.
Hi, I'm Lalita. My question is for you, Deep. I think it's an amazing cause that you're on, so congratulations. What I would like to know from you is the majority of customer base, according to you, for you, comes from tier 1 cities or the tier 2, tier 3? Where do you think the majority lies?
Well, ma'am, I think it's spread. COVID has made the country, so many people went back to their hometown. So if I say that, I'm only talking to tier 1, it'll be unfair. I think we talk to a mindset. We talk to a consumer who's now today aware of the problem that she's facing and she's seeking a solution. And she could be anywhere in the country. It's a very interesting mix. Like till about a couple of years ago, we were still getting almost 60% of our sales from tier 2 towns. But if I say it's tier 2 towns, it could be because people had moved back. Today, it's a very normal 50-50, I would say, is the mix.
But how important is the awareness and the mindset also that matters in this category?
Very important. It's a taboo category. And I think that's how, and it works to our advantage because we are shameless about talking about it. So that's what is changing it for us. Talking about it is the only way we can normalize the taboo that exists in the category. That's why some of the initiatives like the vending machines, like the period tracker in multiple languages available on WhatsApp, some of the things that we are doing to ensure that she has the right tools available right on her phone. So yes.
Thank you.
Soumya has a question. Who has a question? Here.
Hi, my name is Soumya. I have a question for both of you. Much of the growth in D2C brands, both pre and during the pandemic, was heavily built on advertising on Meta and just spending a lot of marketing budget on that ad inventory. But clearly, the return on investments there have been slowly tapering off. So my question is, in the next, say, 5 years, where do you see marketing spends for D2C brands grow? Do you think it'll get more splintered, or do you see another major channel taking over Meta's current dominance in this space?
I think for us, it's about just retention. I think that's become the name of the game. It's very easy to, acquire customers if you have money today. But I think the name of the game would be how well do you retain? And I think next 5 years, the guys who are able to create a very, very strong playbook around retention across platforms are the ones who will win. The rules for retaining customers on marketplaces versus on Meta versus offline are very different. So I think the ones who do this better are the ones who will get it. What do you think?
Yeah, I completely agree with Deep. Like, you can acquire a consumer once, but then, what is your retention rate will be the key. And also, I think probably how soon do you move from performance marketing to brand marketing, where your brand becomes stronger, then you don't need to spend as much on performance marketing. I think that will be the key as to how the brands will do that.
Okay. Yes. Soumya, if you can just hand the mic.
Just a connecting question to what she asked. In the consumer sector, we are seeing that there's a lot of premiumization happening. So a lot of marketplaces are throwing out brands which are doing lower AOVs and trying to get more premiumized. Everyone is talking. But the moment you move up the ladder to it, and from that perspective, your marketing spends, your marketing strategies will not be that relevant to it, because you don't see the same segment, being targeted with that sort of. So the point to extend is how would these marketing strategies be reframed on this when you move up the ladder? Do you want to take that?
Yeah, maybe I'll give a shot. So, look, I think the consumers which are there in, everybody is aspirational, I would say, and premiumization is a theme that we at Fireside are also very excited about. And we think that marketing strategies can be different. You can target those consumers differently through a Meta or a Google. Like, for example, we have a company called as the Sleep Company, one of our portfolio companies, which does really premium mattresses, right? A few years ago, if you had asked us, we didn't even know it could be so large. What they have done well is they have done YouTube well. They have done, Facebook, and especially Google, they have done extremely well, Google Ads. So I feel that every segment probably will have consumers, and how you segment those consumers, what is the messaging that you give in each of the ads that you are playing on Meta or Google will be a key to capture that consumer set.
That lady over there has a question, the last question. We'll give it to her.
Hi. So I have a question for both of you. Since we are talking about premiumization, there was a large white space of mass premium, that we found, and that's how D2C brands started building. When we look at the market today, there is a lot of space for building for this underserved premium segment. And then there is also a challenge where brands struggle to kind of reach tier 2 plus. So how much does pricing and purchasing power of the tier 2 plus customers become a constraint in deepening the distribution or the presence of these brands? Because we have an aspirational brand, our pricing is mass premium, while the premium segment definitely has a lot of scope. What about deepening the brand presence to tier 2 plus geographies?
I don't know. I think premiumization is everybody wants to go to the next level. So it's happening across the strata, So what you have to see is for which strata are you able to solve the problem and communicate it well that they are willing to pay you a premium for the product. And so yeah, I think maybe I didn't get the question correct, but I believe that it's about saying that for every category, is there depth? Yes, because there is buying power in India 1, 2, and 3 everywhere, and all of them need a better bang for their buck. The question is how well are you able to communicate it, and how sharp are you in saying that I'm today asking for a premium because this is the problem that I solved for you. What do you think?
Yeah, look, I agree with Deep, and I also think that, especially for India 1 and India 2, right, there's no dearth of channels where you can reach these consumers, right, whether through e-commerce or even like quick commerce we were talking about. Having present in 100 cities, these quick commerce channels, I think there is enough depth, and for people, to buy these products through any of these channels, should be, your product should be available and they can access it. The only challenge will be India 3, where probably, but I don't think there are enough brands building also for India 3, because the challenge there is more access rather than brands or aspirations.
We'll conclude on that note. Please allow me, applaud our panelists for such a wonderful conversation. Thanks to both of you, and thanks to our audience as well.
Thank you, Ranjini. Ranjini, please present a token of our appreciation to our wonderful panelists.
Thank you so much. Both of them.
Let's hear it for them once again, ladies and gentlemen.
Photo.
Something really exciting is around the corner. But before that, let's talk about the fact that economic growth, of course, exists to improve the lives of the people of a country. But are we really doing it right? Even as India has become one of the largest economies in the world, the fact remains that our per capita income, our standards of living lag the current group of developed countries and economies. The country's stated target of $30 trillion GDP size and per capita income of $18,000 by 2047, when we complete 100 years of independence and being a modern nation. But to achieve that objective, the country foremost needs to be equitable in terms of opportunity. Every Indian, be it rural or urban, must have the opportunity to earn an income that is way higher than today. And that will need a series of actions in practicality from every sphere, be it skilling or be it infrastructure, that is specifically geared towards increasing the quantum of the income of the workforce. The Mint Leadership Dialogues, in partnership with JSA, has attempted to go very deep into these challenges, facing this objective through deep discussions with more than 40 leaders in some of the biggest companies. We had these conversations in 5 separate closed-door roundtables, we aimed to find ways to tailor policies, investments, and even cultures that will propel us towards higher incomes. In fact, while I'm talking to you about it, I want to quickly show you a video that is a sneak peek into what went around. Let's watch. The findings and, the crux of this conversation as well comes in the form of the Mint Leadership Dialogue book that you all are going to receive. Right now, as you can see, our ushers are presenting a book to you. This one is your copy, yours to take home. Please give it a good read so that you can find some incredible insights that came out of all of these many conversations that we've had around the country. Okay, fasten your seatbelts, everyone. We're diving straight into the stratosphere. Let's talk about moonshots. Not just a shining term that Silicon Valley likes to throw, but it's could be the real, the audacious, the world-changing, ringing word. Because ideas, well, they don't just disrupt industries. They even create and birth new ones. So here's really the billion-dollar question: that are Indian VCs backing bold debts? Or are we still stuck swiping right on safer, copy-paste kind of plays? But before we, romanticize moonshots entirely, we have so many questions to ask about various factors. And we were wondering, how do we get all of these questions answered in the most interesting way? And that's why, as you can see, the stage is being set up right now so that we can debate, not dictate, so that we can listen, not just label. We are looking for more than just hot takes this afternoon. And to deliver that, we are going to be joined by two brilliant minds who come with two opposing lenses. So let the sparks fly as we open the Mint debate titled VCs in India Don't Invest in Moonshots. Okay, the question is bold, and let's see who is going to shoot for the stars. So we have T.N. Hari, Executive Chairman, Steer World, who is debating for, and Ritesh Banglani, partner, Stellaris Venture Partners, is debating against, and to ensure that the debate goes smoothly. Right, Alokesh? We have Alokesh Bhattacharya, Deputy Managing Editor at Mint, and we are expecting a fiery debate here, everybody. So let's fire up and put our hands together. Welcome, gentlemen. It is the Mint debate, the very sought after. And Alokesh, over to you.
Thank you very much, Zinia. So, A lot of people have always had this saying that, where's the Google from India? Where's the Meta from India? Where are the big ideas? Where are the big people? We are just followers. We come out with a cab app that was already there somewhere else. We come out with an e-commerce app which was already there somewhere else. We come out with all sorts of ideas that were all there somewhere else, right? What about our ideas? Are we doing anything at all that's original? Or are our VCs, like Ritesh, investing in moonshot ideas, ideas that are original, innovative, that can become really big? Are we? That is the point of our whole debate today. And I have for the motion T.N. Hari, who's chairman of Steer World. T.N. Hari is a top of the line executive who has taken 5 companies to great places, including selling off for great valuations. He now runs a company that invests and works through multiple areas, especially in material science, right? As well as certain other deep technology areas. We have Ritesh, who is against the motion. He believes that VCs do invest in moonshot ideas. Ritesh is a star investor himself, and he has invested in multiple companies. He has a huge portfolio. And let's see what they have to say. But before we start with the 2 gentlemen here, let me start with you. VCs in India don't invest in moonshot ideas. All who say yes, raise your hands. Those who agree. Wow, that's only about 10-15%. And they do invest in moonshot ideas. How many agree? That's more.
I guess we can end the debate now. We can take the next half an hour free.
Not bad. So that takes me back to where Kunal Bhel was saying yesterday, that when they started at that time, there was hardly anything, but now there are 1.5 lakh registered, startups, and there is a whole new world before them. There's Wi-Fi, there's 5G and all that, and there's so many people who have internet on their phones, and there is practically nothing that you cannot do. All right. So let us start. I will first invite our 2 speakers to give their opening comments. Don't reveal all your cards right now, just your opening thoughts. So we'll start with Hari, who's for the motion. Just to remind you all, the motion is VCs in India don't invest in moonshot ideas. Hari.
So the central argument of my opening remarks is that VCs in India have not been taking sufficient risk in investing in ideas or companies that can potentially change the game for the country or for the humanity at large. I think they've just been content investing in ideas and companies that merely tweak business models to deliver endless conveniences at your fingertips and your doorstep. I think, the VC world in India particularly has been abysmally lowering the standards of what it means to be even a tech company, or even what it means to be technology. Calling a company that, employs 100,000 underpaid, overworked gig workers to deliver Medu Vada and toothpaste at your home as a food tech company is pretty shocking. When we hear of food tech, most sensible people would think of formulations of food, coming up with interesting formulations, nutritious stuff, coming up with, food that can help solve the anemia problems of the women in India or undernourished children in rural areas. But calling, a company that delivers food as a food tech company is pretty ridiculous and lowering the standards. And this is not just true in food tech, it's true everywhere. It's like calling a company that gives loans, to people that banks did not possibly give loans and considered subprime and not worthy of servicing, using an app to give them loans, and claiming that they have some amazing algorithms in which they can evaluate creditworthiness in a fraction of a second, I think is again lowering the standards. It doesn't stop at food tech and fintech. It goes on to property tech. It goes on to ed tech. We can go on and on. I think we need to raise the standards completely on this. And I think when it comes to food tech, calling companies that deliver food as food tech really is a cruel joke. It's an insult, and it's, in fact, I would think actually, demeaning the problems that we really are facing, making a mockery of the real problems that the country is facing. And I'm not for a moment saying that we don't need to solve these problems. These problems certainly need to be solved. But today the debate is not whether that we need to solve those problems or not. The debate is whether VCs in India are investing in moonshot ideas or not. And investing in moonshot ideas does not mean burning endless capital in making contrived solutions and contrived problems seem real, or, even chasing problems with imaginary, I would say, network effect. So this is my opening argument, and after the debate progresses, maybe I'll share some real examples, real stories, and build on this argument.
You look forward to the real examples. Cruel joke, food tech being called food. Ritesh, your opening comments.
So when I came for this debate, I was hoping for an Arnab Goswami kind of a debate. And Hari has...
You won't get that at Mint.
Hari has fired the opening salvo already. So I'm looking forward to it. So my central argument is that, my assertion is that Indian VCs not only fund moonshot ideas, but they take a disproportionate amount of risk in doing so and end up losing more money than our peers in other geographies. And in support of this, I would like to present the following arguments. What is a moonshot game-changing idea depends on the needs of the market and the existing capabilities in an economy. The right measure of a big investment idea is impact. Economic impact, social impact, and cultural impact. And cool technology doesn't a moonshot idea make. I believe, and I will substantiate this shortly, that Indian VCs are investing in the highest impact ideas that they come across. We are also investing aggressively in deep technology areas, space tech, semiconductors, energy, robotics, biotech, all of the things that Hari did not mention in his opening remarks. Also, however, deep tech investments cannot happen in a vacuum. You need talent, you need patient capital, you need enabling policy provisions, you need a larger risk-taking ability in the entrepreneurs. You cannot get a baby in 1 month by getting 9 women pregnant. So it'll take time. We are on it, and we will continue to invest in moonshot ideas.
Thank you very much. Market impact does not necessarily mean moonshot ideas. No, Hari? So let us hear you. Can you bring in some data, some examples, and just elaborate on your position?
So let me just give you a real life example. So I advise a growth stage VC fund. They were looking at investing in a fintech company. And what they told me, that why don't you just go out, meet the founders, the founding team, and figure out whether they're solving a real problem and whether they can build an organization and scale the business. So I met the founding team and the founders, and they had 2 amazing metrics, and which were really best in class in the industry. One was customer acquisition cost was extremely low, delinquency rate was very low. So I was very curious as to how come they were achieving these metrics. Every single conversation with every individual in the team, they were saying that we have a very strong analytics platform. We are able to evaluate the credit worthiness of the people who borrow from us, which makes it, the customer acquisition cost low and delinquency rates low. Didn't seem very convincing to me because I've always been suspicious of any of these, and I always dive a little deeper. So the head of analytics was talking about this. So I asked him, I understand statistics fairly well. It's a hobby of mine. In college, I studied that very well. So I asked him a lot of questions in terms of, just tell me more specifics in terms of what exactly do you do? How does the algorithm work? What are the parameters? How is it built? What's the logic? And do you even understand, for example, multivariate analysis? When I went down a little deep, I found he was completely out of his depths. He had no clue. And then when I talked to everybody else, everybody was just parroting this phrase. But nobody had an idea how the algorithms worked. I was still very curious as to how these guys are getting these 2 amazing metrics. And as I tried to understand this, the Kung Fu Panda moment happened to me, which is that I was looking for a magic recipe and there was no magic recipe. The only magic recipe was that every single team member were aligned on one amazing thing, and that is their target segment. The target segment to whom they were lending money was just below the credit worthiness of those the banks were lending. They were not chasing mindless growth. Everybody was convinced that that's the only target segment we have to attack. And they were not wanting to, in chasing growth, going below the target segment. So the clarity on the target segment and the fact that word of mouth would deliver growth was resulting in these two metrics. And then as I was walking away in the evening, I just was curious. So I asked them, why the hell did you keep telling me that it was analytics when the reality was that your target market was very carefully chosen and you executed well? The response was very interesting. Everybody, in one tone said, this is what the VCs love to hear. They love jargon, they don't understand anything, and hence that's what we tell everybody who comes. And we thought you represent a VC and we told you the same story, but you didn't seem to believe us. So this is a real example. And I just want to build on this a little bit, which is that, all VCs in India have been funding ideas with DACT, which is that they've been riding at the intersection of Aadhaar, broadband, and the smartphone. A recipe that has been created by Ambani, Nilekani, and Jobs. And using that intersection, they've been building on DACT, which is discoverability, accessibility, connectivity, and transactability. Every single startup is solving for this problem, which is you can discover your customers, you can access your customers, you can connect, you can make small transactions. Who is solving the problem of, India's, we are drowning in plastic waste, multi-layer plastic waste. Who is finding answers? How to dispose of this plastic waste, how to create sustainable materials. If we want to make in India, how do we create technologies that can give us an edge over China? We need advanced manufacturing technologies. Who the hell is thinking of advanced manufacturing? Tech does not mean information technology. And tech does not mean the silly information technology. Even good technology is really good information technology. When I was in my early days of my career, the IT boom was taking off, which is the services boom. And at that point of time, the stock market somehow loved the word information technology. So every Tom, Dick, and Harry company was suffixing somehow information technology just to the names, just to boost the stock markets. So every, segment in India today is using the word tech as a suffix. It's food tech, it's property tech. You want to buy and sell houses, it becomes property tech. Tomorrow Indigo Airlines, which uses some kind of an AI to service customers or develops an app for booking tickets, is an aviation tech company, not an airline company. If VCs were funding airlines, they would call them aviation tech companies. So I think, we just need to cut out the hype a little bit and create some real, tech companies, real moonshots. Otherwise, we'll just be spending time in these forums and we'll never be another China. We will be talking of, building wrappers and building services. This is what our aspiration is, which is, Narayan Murthy says, we should not build LLMs because they're expensive. We should build wrappers and services. That's how a person who's built reputation around providing low-cost services would think. Should we leave the future of India's tech to such people who build low-cost services to help us imagine what real technology is? So hey, let me pause here.
VCs don't know anything. Sounded to me like a little unfair. I mean, even though I'm supposed to be an impartial moderator over here, but considering that you guys have really taken the startup ecosystem, maybe the person who spoke with you, Hari, was a little, too distraught over something. But okay, your counter arguments to what Hari has said.
So that was an impassioned speech, Hari. Thank you. I will pose a question to the audience. On the example that Hari gave, which was that of a lending company, a fintech, whether or not it's really tech. How many of you here believe that the biggest listed fintech company in India, Paytm, is a moonshot idea? Nobody thinks Paytm is a moonshot idea? I will give a story of my own to help demonstrate why it is a moonshot idea and why it delivers impact that is not to be scoffed at. So a few months ago, less than 6 months ago, I was in a very small tehsil town in Karnataka called Gundlupet. This is, literally the entire town is one street. And we had gone there to diligence a fintech company. And I went and spoke to one shopkeeper. In tiny Gundlupet in Karnataka, that shopkeeper was doing 70% of his revenue from UPI alone. He didn't call it UPI, he called it scanner. He said he does 70% of his monthly cash receipts via scanner. Obviously, it is companies like Paytm that are enabling the scanner. It is those guys who have printed the QR codes and stuck in front of his shop. But the impact on that person's well-being has been immeasurable. I think Hari scoffed at the fact that a segment that was previously impossible to lend to has become creditworthy now. That, I think, is you are changing the life of that person, the cost of capital. When he needs to invest in inventory, how does he get the money? Any ideas? Before pre-Paytm, how did he get the money to invest in inventory? He borrowed from a local money lender at 3% a month, right? After Paytm, because now 70% of his income becomes documented, you can prove that he is actually getting that revenue in the shop, he becomes eligible for actual formal business loans. Guess what rate those loans are at? It's not 3% a month, it is less than 1% a month, compounded. That means that he has more money to deploy in his business. He has that money at a cheaper cost, and he's not at the mercy of a money lender who is really a loan shark who will attach his property if he doesn't pay back the loan. But this has this sticking of the QR code has other impact beyond creditworthiness. Think about tax compliance. 70% of his income is now in white. He's paying GST on that income. He's paying income tax to the government on that income. That has increased the government's indirect and direct tax collections both. Imagine what impact this has on his ability to invest. Pre-Paytm, where would this guy invest? If he has some extra cash, he would himself become a money lender, right? That is the only real way you had to invest, because all his income was in cash. And those are risky loans, those are risky investments. Now that guy has the ability to invest in mutual funds like you and me, right? Don't you think that is a massive impact? I think it is actually insulting to that shopkeeper to say that this is not a real innovation. That became possible because someone who's on a different bank, holding a different card, and holding a different app is able to transact with someone else who is on a totally different platform. That is what Paytm has done. And Paytm, in my mind, has been the moonshotest of moonshot ideas. Before I conclude, I'll give you just one more example from the same business, Paytm. Before Paytm came into being and before UPI in general came into being, how many of you here take app-based autos? Rapido, Uber Auto, Ola Auto, anyone? Lots of us take. The bill for an app-based auto on an average in India is about 80 rupees. This is actual data. Pre-UPI, how did you pay 80 rupees? You could not, because the cost of transaction on a Visa card itself, the minimum cost of transaction is about 40 rupees. So if 40 out of your 80 rupees was going in transaction costs alone, the business model of autos, the demand and supply matching that Rapido and Uber Auto and Ola Auto do, could not have succeeded without Paytm. Now, imagine the impact on all the auto drivers. Imagine the impact on us as consumers. That is real impact. That is not something to be scoffed at in my mind.
Right. So I'll ask you one question before I move to the next sort of segment of this debate, which is UPI, right? And the QR code, which is talking about. Would you call that a moonshot idea? Because that is something that is not there anywhere else.
UPI is absolutely a moonshot idea, but it's not a VC moonshot idea. It's a digital public infrastructure that Nandan Nilekani dreamt of in his book, Reimagining India. It was made into a reality because the government of the day invited him to implement it on the ground, and everybody is riding on that and calling that a moonshot idea. Paytm is a moonshot idea? No way. UPI? Absolutely yes.
All right. You have a counter to that? Or should we move to the next
How many... All banks are on UPI. Let's have a show of hands. How many of you use your bank's UPI app? Your bank's
UPI app. Not PhonePe,
not
Paytm.
Google Pay, not independent UPI.
How many use
ICICI Bank,
HDFC
Bank, Axis Bank, those UPI apps. Maybe a handful, 10 or so people. How many of you use PhonePe, Google Pay, Paytm? There's your answer. Whether it is...
Google Pay is not a VC funded, India VC funded. We're talking of India VC funds.
Okay, let's rest the UPI debate for now. What I'm going to do next is to...
Absolutely.
Saving of time and the fact that I don't need to keep any paisa in my wallet, right? So, that is also there. So the next segment is I'm going to let these two gentlemen at their throats, which is, of course, not literally, but metaphorically, right? So they will ask each other some questions. Let's start with Hari. Your question to Ritesh, and then Ritesh will ask you a counter.
I mean, okay, in a debate you have a point of view, but it's not fair to ask the other person questions. But then I think you made it part of this format. So probably let me just ask you this question, Ritesh. Ritesh and I, by the way, have worked together in the past. We are good friends as well. So let me ask you, Ritesh, many of these, lending money, to the tier 3 people who had never had access to credit in the past, wonderful. I have no doubt about that. It's a good intervention. All I'm saying is that, they are not in the tech business. Calling it a fintech is, to me, very awkward because they are just a bank who's just lending to a different customer segment. And they're lending to a good new customer segment is all great. But saying that they have some amazing apps that can help them in a fraction of a second to figure out credit, all this is bullshit, So let's just be honest about what kind of a business you're building, and it's a good business to build. The question to you is, what are some of the biggest problems confronting India at this point of time? We have to become the next China. We need to become a manufacturing hub. We need to develop advanced manufacturing technologies. Otherwise, Make in India is never going to happen, right? We have climate-related problems, plastics disposal problems, sustainable materials. 50% of women in India suffer from anemia, but they can't take iron medications because iron medications in the current form are not bioavailable. How can we make bioavailable iron forms? So who is going to fund these ideas? Why are they not being funded? Why are we chasing, whatever has worked in the West? Why are we chasing those? If you claim that you're building for India, why are we not solving these problems?
I think it's a fundamental question that everybody sort of has in this country.
So I'll do the Arnab debate thing, Hari, which is that I will first answer the question that you did not ask, but respond to a statement that you made, and then I'll come to the question that you did ask. So I'll give you an example from our own portfolio. We have a company called Propelled. It is exactly the sort of company that you disdain, Hari. They are a lender. They are an education lender. They lend to students to pursue higher education. India is a unique country where neither, for the most part, the state doesn't fund higher education, and nor can you easily get a bank loan for higher education. And as a result, people who cannot afford to pay the high fees end up not going to college. It's usually not a problem that people in this room have, but you go literally just one level down in the economic strata, and this is a very real problem. Your child wants to do a BTech degree, but it costs 20 lakhs over 4 years. You don't have 20 lakhs, your child doesn't do the BTech, right? And you mentioned that a company like this is not a tech company. I would argue that it is very much a tech company, because there's a reason banks don't lend to that student. The reason banks don't lend to that student is they have no idea which of those students will actually get a job after their degree and which of those don't, right? Because there's no data. What Propel does is it collects data from all the alumni of the institute going back 20 years. And then it processes that data to make good assumptions on, or good predictions on, who is likely to get a job out of 100 students that enroll and who isn't, which institutes students actually get jobs, and which institute students don't get jobs. As a result, where previously 0 people were getting that loan, today about 70 out of the 100 people that enroll into those tier 2, tier 3 universities actually get the loans. That is life-changing. And that is not possible without technology. You can sit in a bank and believe that it is trivial. It is absolutely non-trivial. Because how do you even collect data at scale? So it is not about, yes, if I had an infinite number of people in the bank, I could go sit there and try to assess every application and assess whether each child is going to get a job or not. But it is impossible to do at scale without technology. Today, that company has more than 1,000 crores they give more than 1,000 crores of loans every year. And to me, that is pretty game-changing. It is absolutely technology and absolutely nothing to disdain. Now I'll come to the question that you did ask and try and answer that very, very in brief. So I think I don't think you can rank order the problems to solve in a very facile manner. You can't say that until all of hunger is solved in this country, we will not send satellites into space. Because otherwise we will only try to solve the basic problems and never actually graduate to solving the problems that matter to somebody else. Probably hunger is not a problem for all of us, but that doesn't mean that the problems we do have, our problems are related to education, related to jobs, related to loans, related to even credit cards. These are our real problems, and I don't think we can trivialize those problems because we don't have a good iron delivery vehicle in rural areas. So we absolutely need to solve those problems, but I have an objection against believing that there's a hierarchy of problems, that till we solve the iron problem, we should not even attack the fintech problem.
Your question now for Hari.
My question is, Hari, do you believe that Indian VCs are investing in areas that you consider game-changing deep tech? Let's take some examples from the broad areas that you gave, whether it is energy or robotics or space tech or semiconductors. Do you believe that Indian VCs are investing in those areas?
I'm not very sure, but my sense is that there is a beginning happening in this area as well. So space tech, for example, I can see VCs beginning to invest in some of these areas. But it's a early, I would say very early stage. And at this point of time, let me just say that 1 or 2 swallows don't make a summer. At this point of time, the big problems of India are being addressed more by corporations and companies rather than companies that are being funded by venture capital, which is really supposed to, invest in risky ideas. I can see, for example, Adani, Reliance focusing on biofuels. Biofuels is India's biggest thrust. We are so dependent on imported oil. The country is held to ransom because we are spending so much money on imported oil. We have to find an answer. Who's finding an answer? Not the VCs. It's some of these big companies that are doing groundbreaking research to figure out what are the ways in which we can convert agri-waste, not agro crops, into biofuels. So my view is that there is a beginning, but VCs don't naturally invest in moonshot ideas. For them, it's valuations, playing this game of valuations, chasing what has worked in the Western world, having a solid herd mentality on what works, what does not work, is still the investment thesis for them.
You have a counter to that?
I do. First of all, I'd like...
You shouldn't be in that profession.
Absolutely.
He will have a counter to that. And you also get a chance to counter his answer to your question.
Absolutely.
And we don't have much time, so keep them short.
Yeah, so just a quick comment on biofuels. I don't know if all of you know that most biofuels in India are not actually generated from waste. They are generated from actual sugarcane crops. And
not true
you tell
at
me,
all. I understand the space deeply. So completely untrue. I understand the space absolutely deeply. I can spend an hour on it giving a speech.
The amount of ethanol in our fuel. Yeah, no, absolutely. Ethanol doping in our fuel is, I think, a direct subsidy to sugarcane farmers, which are a political vote bank. And but anyway, so, a lot, when we say biofuels, there's a lot that goes behind the scenes in biofuels. But I'd like to give some data. I actually got this data. There is Indian deep tech funding last year was $1.2 billion. In 2021, by comparison, that was $480 million. There has been a 3x increase in 3 years in Indian deep tech funding. I'll give some examples of...
Okay, make them quick. We don't have much time.
Yeah, very randomly. Agnikul is a rocket launching company, $61 million invested by Indian VCs. Pixel Space is a satellite constellation company, $100 million invested by Indian VCs. Log9 Materials is a battery technology company, $100 million invested. Grey Orange is a robotics company, $545 million invested. And lastly, I'll give a small example of a bioscience company, Bugworks, $43 million invested by Indian VCs.
Okay.
So I believe that where we see opportunity, we are investing.
Last counter from you. You also run a lot of innovation within your organization, right?
Yes,
So tell us about
yeah. So my last and closing comment will be that I think we need to raise our ambition. We need to raise our imagination. You know, my belief is that a lot of the ideas that are currently being funded are not worthy of funding. There need not be a hierarchy of problems. We don't have to solve world hunger before we solve payments problem. I absolutely agree. But who is going to solve the important problems of this country? Who is going to invest in deep tech? While we think of creating services and wrappers because we don't want to invest in LLM, China walks away with DeepSeek. So I think we need to be far more ambitious. As a nation, as leaders, we need to get far better role models. Otherwise, the kind of people who are, you know, putting imagination in our minds are all substandard. We need to raise it significantly.
We are actually out of time, but since you raised your hand before the time up came, you can still ask a question, but it will be the only one. Who are you asking?
Mr. Hari.
You're asking Hari.
Yeah.
Who are you? Introduce yourself.
I'm Ankit. I'm a part of Deloitte. I have a fundamental query.
Yeah.
So why are VC investments considered to be riskier investments? Why do we, put all VC investment that they should be riskier investment? Aren't VCs supposed to secure their money first before investing, right?
Good question. Hari.
Yes, absolutely. Everybody should look at returns for their investments, but there are different categories of capital. A bank, for example, also wants to make money. A venture capital fund, a private equity fund, everybody wants to make money. But the strategy that each of them chooses to make money is different. A bank is far more conservative. They look for collateral. For example, a venture capital fund will invest by their nature, by the very definition of that concept, in more risky ventures. And that's how they have chosen to be.
Okay, you don't get to ask a follow-up question, but you obviously have an answer to that also.
Yes. Yes, I wish it was so. I wish our money was safe, but it is not. I'll give you some metrics. In the general startup ecosystem, about 98% of startups fail. Right? This is actual data that I have personally collected from 10 years of VC investing. 98% of all startups fail. Of all the VC invested startups, 80% of those startups still fail. Right? So we are putting our money behind companies where we lose money 80% of the times. I think that's pretty risky in my view. Right? I think if we took any more risk, anyway we are not making any money. We will, the capital flow will completely stop if we took more risk than 80% loss of capital.
Okay, before we start, with a bloodbath here on stage, we'll have to end this discussion. How many people now believe that VCs in India don't invest in moonshot ideas? Can we have a show of hands? Oh my God, it has gone up. The count has gone up. All right. And they invest in moonshot ideas. How many? That is still the majority, but thoda sa idhar-udhar ho gaya hai. So the debate still, of course, has had an impact. Wonderful. I hope you both shake hands, become friends, and invest. You should invest in his companies, right? And thank you very much.
Let's hear it for Ritesh and T and Hari. And Alokesh, please present them with a token of our gratitude on behalf of Mint. Gentlemen, please step forward. Thank you so much, sir. Thank you very much. And Alokesh, thank you. Please come together for a group photograph quickly. All right, after that fiery debate, let's turn the stage around and also the mood in the room. If India is on the fast track to becoming a $10 trillion economy, then it also needs more than just rocket fuel, don't you think so? It needs a smooth runway. And that runway is lined with contracts, with compliances, and inevitably a few conflicts as well. But when the stakes are high and the money is serious, Disputes are not if, but when. Which brings us to the real question, which is how quickly can we resolve them without bringing the whole deal to a screeching halt? Welcome to the panel, which will begin very, very shortly, that dives very deep into the unglamorous but the absolutely inevitable and the critical part of doing business. It's called dispute resolution. Think of it as the plumbing of our economic engine. You don't necessarily see it, but if it does break down, then chaos strikes. In a country where court cases can outlive CEOs, alternate dispute resolution, ADR, as we all know of it, has emerged as the saner, the faster, and the far more business-friendly option. Add to that the shifting sands of regulation, a policy ecosystem that's racing to catch up with the speed of deals that are happening every single day in this country, and we've got ourselves a conversation that is long, long overdue. So we have with us today the legal eagles, is what I call them. They're not just here to interpret the fine print that they write and they shape and they defend, but they're here really to talk to us about that point where law meets strategy and policy meets practice. And now that the stage is set, please join me in welcoming them on stage. Deepak Acharya, Group General Counsel and Chief Legal Officer, Aditya Birla Group. Varghese Thomas, Partner, JSA Advocates and Solicitors. Madhav Uppaluri, General Counsel, Tata Motors Limited. And our moderator for this conversation, Devina Sen Gupta, Deputy Editor, Mint. Welcome, gentlemen. Let's welcome them with a warm round of applause, everybody. All yours.
Good afternoon, everyone, and thank you to Hari and Ritesh. It felt like a courtroom right here. And in today's session with these legal experts, what my main point is understanding is our court cases are so long drawn that the whole tariq pe tariq is actually, we see it in practice in corporate sector all the time. I mean, judges come, judges go, companies get dissolved, but the court case continues. And with that, I wanted to start first with Madhav. Hi. Madhav, this is a crib that, for example, in 2025 fiscal, India Inc. has spent more than 60,000 crore estimated on legal costs. We often don't understand that a case in a court is not just about a particular judgment, but has a larger impact on economy, on livelihoods. If you could help us understand the cost of judicial delays and the legalese, please.
Good afternoon, everyone. Thank you for that question, and also I think very, very important, because lawyers, judges are all so busy in sorting out a lot of cases that a cost-benefit ratio of the cases that have got decided, nobody does that or spends time. So it's a very important topic for all of us to reflect as to what is it costing us. I think before I go to that, look, India, the system, the legal system is pretty robust in terms of having the best of the best doctrines, the best of the best laws. If I was to just talk about, say, the public interest litigation, right, that has definitely brought about a lot of advantages to this country. Likewise, there are other legislations which have changed to a large extent the fabric of this country. The problem is where the judges have an intersection of not just the law, but political pressure, societal compulsions. So they try and strike a balance. And in pursuit of that, I think there's a lot of delay that takes place in each of the case because there are multiple stakeholders involved, and to set that balance with everybody, I think that leads to a lot of delays. Now, what's the dollar number in terms of what has the delay cost? Each case has its own spend in that sense. But I'll tell you what is the biggest cost.
Right.
The biggest cost of delay is erosion of faith. I think that cannot be quantified because once justice delayed is justice denied. Once that delay has, for an investor, he has lost the confidence to say, do I want to arbitrate in India? Do I want to run a court case in India? The game is lost.
It's very important, because rarely is it gets called out. The kind of pressure that even judges face, the societal and the political pressure, and thank you for calling it out. Deepak, help us understand one thing, In 1617, there was this whole hoopla that India is going to be the arbitration hub. Come to India, get your global dispute solved, come here. We are nowhere there. It's like utopia right now. Why are we not there? What is the challenge we are facing?
Yeah. So first of all, thank you for having me here. It's a great opportunity to share my personal thoughts with you all. So very good question, Devina, that why are we not there where our vision was that we want to be the arbitration hub of the world, whereas some of the other countries like Singapore started much later and Dubai even much later, and they are much ahead of us today in terms of arbitration hub and resolving disputes and international disputes that too. So I would give two key reasons why this is not happening. And the first and foremost, I think, is a cultural issue in our judiciary that we have. Our judiciary is much more interventionist. They intervene in every given matter, and therefore you see most of the arbitration awards which are supposed to be final are not final at all. Actually, they are challenged. They are challenged every now and then. And when matter goes to court, we all know, as we heard from my colleague here, that it takes a lot of time to resolve those disputes. So why does businesses want commercial arbitration? They want commercial arbitration because they want to keep the issue confidential, A, and they want to resolve it quickly. And both of these get impacted if the matter goes to court ultimately. So I would say first is obviously cultural issue that we have. And the second is, our own policies are, flip-flop. One right arm of the government would say that we would want to make India as an arbitration hub, but the other arm of the government would say that no dispute involving the, government undertaking should be arbitrated. They should always go to court. So there is, difference of opinion or not the right and harmonized policies that we have in India that allows us to, become the hub of arbitration.
So there's perennial, like if a decision is made, you have to understand before it gets implemented, again somebody else backtracks. A lot of time is wasted, which in turn has a larger impact, right? Verghese, help us with this problem that we face is we have the NCLTs, we have the appellate courts, we have, of course, the high courts, the Supreme Court. But in many benches, we see there is a gap. There aren't enough judges. And the judges that we have often may not understand the financial aspect of things. They're great judges, but when I talk about business, do you see that as a challenge?
Thanks, Devina. I think the answer is self-evident, absolutely. Just to give you a little statistic, the judge-to-population ratio, 1 million population ratio in India, is 25 to 1 million. In the US, it is 150 to a million. Right?
25 judges to 1 million Indians?
Correct. And
versus?
150 to a million in the US.
Okay.
So I think the answer in terms of statistic is pretty evident that we are woefully short when it comes to judicial and quasi-judicial members. The second, so that's the issue of vacancy, which all of us are well aware of. Second is that attracting the right talent to the bench, whether it is quasi-judicial or judicial, is a huge challenge. Because on the one hand, you have litigation, which obviously, I'm a part of of the litigation family. That it is an enormous gestation period before which you see the rewards. Very often, ultimately the judges and quasi-judicial members that are appointed, it's pure economics in the sense that the remuneration that they receive when they're on the bench, particularly quasi-judicial, is sort of very below par. So to attract the right talent is a huge challenge. Now, how does this all fit in? It fits into a situation where today, at the NCLT, for example, there is no incentive to finish the matter. The incentive is to finish by lunchtime so that you can, have the rest of the day a little more relaxed. Correct? And we see this repeatedly. You'll have a roster of 65 matters for the day, and by lunchtime it's over because only about 3 of them have actually been heard and 57 of them a date has been given. Correct? So obviously there's a huge cost, and my colleagues here on the corporate side will tell you that the enormous frustration of a matter which is pending, not resolved, paying adjournment fees, etc., is massive. So undoubtedly there's a cost, and we really have to look for solutions around it.
Right. The number is still sinking in. And again, Madhav, you have a team of 40, 50 with you. Why do we always go for arbitration? Things like mediation, why doesn't it work? Why can't those avenues work for India Inc.? Why does it always have to be a long-run lawsuit?
Well, I think mediation got its legitimate sanctity, if I was to say, very recently by a legislation called the Mediation Act. But mediation is, has been for a very long period of time, and it continues to be. If you go to rural India, etc., and you see, mediation is like a tick in the box. There's nothing, it's toothless, if I was to just use that expression. It's a mindset issue. There's nothing which forces me there's nothing that is binding. If it is not binding, why would I want to waste my time? I may as well waste my time, doing arbitration. So mediation in that sense has still not picked up, while there is now a legislation, there is full impetus to kind of scale it up. But I think it'll take its own time. Mediation, we are still not there. But I think the segment, while we are trying to now promote mediation, I think nobody is learning from the lessons of arbitration, right? The lessons from arbitration.
Right.
When you have mediation, there has to be discipline. There has to be some kind of a binding which will enable a mediation to kind of get enforced at some point of time.
Like it works in the London courts, where it has a binding impact, the UK courts?
Sorry?
Mediation, the way it works in the UK courts?
Yes,
it has a binding impact,
absolutely.
right? So you are penalized.
I think we have to go into that mature phase, hopefully soon. Then we can talk more about mediation.
Right. So in the UK courts, you will be penalized if you do not accept a particular order and you keep dilly-dallying on it. Right?
Well, in terms of, I wouldn't know what the regime in the UK is, but the enforceability is what I'm trying to emphasize on.
Right.
Right? Mediation or arbitration, the key factor is if we are spending our time on mediation, it better be enforceable.
Right. Deepak.
So actually, Devina, you were alluding to courts in UK, and I can tell you that courts in every major litigation that UK court has seen, before actually going to trial, the judge would always ask parties to mediate and try and resolve those issues out of the court. And if the parties are unreasonable in dealing with the mediation, then they will actually end up paying the cost of litigation if they lose. So there are consequences if you don't accept mediation or don't really act rightfully in the mediation. What happens in India is that there are no consequences. And because there are no consequences, people and the parties don't take this very seriously.
Right.
And that's why it goes on and lingers on and on.
I'll just add another point, which
Sure,
is,
Varghese.
again, the biggest litigant in our country that everybody knows is the state, correct? 50% of cases involve the state in one way or the other. Now, expecting the state to mediate and settle is an anathema, correct? It's simply impossible. Is any officer going to say that we will settle the matter? On the contrary, I think everybody knows it's an open secret that you're encouraged to file a case and get a court to decide the matter rather than a commercial decision being made, correct? So, that is another significant factor as to why mediation, is troubled. Because when you have the state involved, the state simply cannot mediate.
Right. Actually, Varghese, I was going to come to you. There's also something called the online dispute resolution. That really hasn't taken off much in India, right? I'm hoping it has, but it hasn't.
So online dispute resolution actually has two aspects to it. And there are actually two different kinds of online, when you say online dispute resolution. One is where the dispute is almost on a sort of faceless basis, real time is settled, correct? So for example, you take what SEBI has. SEBI has an ODR platform, investor grievances, etc., which has worked quite well. In fact, the first one back in the day was eBay. You have transactions where a customer is dissatisfied with a service or a product. There was an ODR facility for them to be able to resolve it, which was enormously successful. So that sort of ODR, I think in patches has been quite successful. The second aspect of ODR is a facilitation for real life arbitration itself, correct? So it is digital filing of documents, transcription services, the manner in which evidence can be recorded, e-filings, etc. Now that is where in India we are struggling, because it goes back to the points that both these gentlemen were saying, that who are the arbitrators today who are appointed, correct? Invariably, arbitrators are those who have had a lengthy service in the judiciary and go back. For them to get accustomed to this ODR facility of digital filings, being able to access, I don't want to give you some anecdotal stories because you will just completely lose faith in the arbitration if I do that. But that is where the struggle is, to be able to adapt technology into this. And the answer to that is then to be able to have a good institutional arbitration, correct? So where the institute is able to provide this, which is why SIAC in Singapore has been enormously successful.
Which, again, Deepak, when Varghese talks about need for good institutions, my immediate question is basically you also need experts. Mediation experts, arbitration experts. In our earlier discussion, we were discussing that, we're all great with being generalists. But to bring in specialists, that would be a big challenge for you all, right?
So, I wouldn't say a big challenge because we don't have a dearth of expertise in India so as to, not get the right level of expertise. Issue in India is mainly coming out because majority of our litigations are actually, and if you look at the commercial side of the litigation, majority of the litigations are actually coming in from the government, as pointed out earlier. And because it is coming up from the government side, it requires a very different mindset to handle those litigations. And mostly, you would see this in other litigations as well, but more with the government. You see, in countries outside of India, you will see, people go to litigation because they want to resolve an issue. In India, people go to litigation because they don't want to resolve the issue. They want the issue to be kept in a deep freeze.
Is that the mindset you're talking about?
Correct, exactly. And therefore, people would want to enter into a litigation knowing very well that next 25 years now I can, keep this aside and do other things on my own. Right. So that is the issue that we face, is to really, do we want to resolve the litigation, or we are actually going to the courts to not resolve the litigation and keep it aside.
So going to court would be a short way of putting a massive spanner in a deal.
Exactly.
Right?
Exactly.
Madhav, arbitration laws, okay? If I could ask you how you would want some changes in the arbitration laws, you know, wishful thinking, but...
Yeah, see, I think the key, but before I go to your question, I just wanted to supplement what Mr. Varghese mentioned about ODR. I think for the spread of ODR to take place, I think the biggest challenge is digital infrastructure itself and digital literacy. I think these are the two big challenges that we will have to say we will proliferate ODR across India. That will really require enormous amount of capacity building. Infrastructure, digital infrastructure needs to be provided. People, even today, many of, especially the judges or the arbitrators, they struggle when they come for arbitration hearings. You see sometimes they struggle with technology. So I think there's a lot of investment that is required on those factors. But coming back to your question on, sorry, what was your question?
Arbitration laws.
Arbitration laws. Arbitration laws, I think, most importantly, all of us, whoever have sat through arbitrations, is on the enforcement part. I think I'll really want it to, if we can do something legislatively in terms of going back and, because you get an arbitral award, you have to just sit on that award for 3 months as starters, because the other side may object to that arbitral award. And then you're wondering, what do I do in those 3 months with that arbitral award? And then the last minute, possibly somebody can challenge that, or when you put it up for execution, it's not so easy. So I think would want to completely rehaul that process or that procedure of enforcement. I think that is what I would call out.
What are some of the longest cases that you have seen? You don't have to give me the name of the company, we'll figure it out. But the longest case that you've seen, it's still on because of these kind of spanners.
So, taking the point that Madhav has said, there is a very famous saying, and it is recorded in many judgments, that in India, the litigant's troubles begin after the judgment is passed.
Right.
Because to execute a judgment, I can tell you, is virtually impossible in our country. Now, I'll give you an example of the Daiichi. Right? Daiichi has got this close to $1 billion arbitration award that it got passed against Ranbaxy promoters, which award now I think is close to 8-10 years it held. And that matter is listed for execution in the Delhi High Court very often. And you will be shocked as to how much they've actually recovered. And we're talking about a corporate who's able to spend time and money with top senior counsel to go after it. So let alone in any other matter where you can't afford those costs, correct? So execution in our country, sadly, is a nightmare. So if you ask me the question, what are the longest cases I've seen, you will find that any case which has been filed in the last 25 years, if it has gone all the way, I can tell you it is still pending in the execution stage because it is impossible to execute.
Yeah, so in my personal experience, I have seen a matter which was going on and on and on and on, and we got a resolution at the end of 22 years of the court case, and thereafter our struggle started with the execution of the order. So, one good lesson I think that we learned at that time was that before we start any commercial litigation, one has to actually see what is the ability of the counterparty to pay you if you ultimately win in a litigation. And oftentimes you will see that the counterparty has arranged their affairs in a way that even after you win, you will lose out. So it's a challenge that one has to always keep in mind.
So always do a SWOT analysis of the opposition before you start playing your own game, basically. I know we typically do it at the end of the session, but I just wanted to take a 2-minute break and ask the audience, if there's any question, you would want to ask the team of lawyers out here, something on the lawsuits that you all have experienced, not experienced, you're in the midst of filing, anything on corporate law, mergers and acquisition, before we go back to our questions.
It's all free.
I think they all have a great team of legal experts of their own.
I guess we need to charge. That's the only time they come to us for advice.
Okay, coming back to you, Verghese, is we spoke about the judiciary, we spoke about ODR, we spoke about the problems that you are facing as far as arbitration is concerned. When it comes to M&A deals, okay, we've had a slew of IPOs. We have M&A deals. Where are you seeing that one point which is constantly becoming like a massive spanner in the M&A deals? Do you see a particular issue where investors are like, won't touch? Won't touch because of the lawsuits, because of the regulation, won't touch.
So I'm not an M&A lawyer, but a disputes litigation lawyer. So I'll go by some of the references that my colleagues would refer to me at the time of due diligence. I think, so let's take a case such as the spectrum litigation which is going on in relation to telecom companies, right? And I'm linking it to an M&A in the sense that though these are all IBC cases, eventually it is acquiring these telecom companies itself. The whole issue of spectrum is stuck before various courts, NCLAT at certain levels, Supreme Court at a certain level, because there's this whole question of, is it an asset of the state? Can it be part of the IBC? Can it be transferred? Do you need to clear all the dues of the past before it can be transferred, etc.? So I think when it comes to disputed matters, if there are matters which go to the heart of the business itself, correct? That can be a big spanner. Or for example, if there's an unsettled position of law on, say, the taxability of a certain aspect or GST dues, all of those can be sort of huge challenges, I would imagine, in M&A. But I should ask these gentlemen who deal with M&A much more than I do.
Deepak, telecom.
So I think one of the things that we, again, when I say we, it means my previous all employments. I'm not referring to Aditya Birla Group as such. But most of the buyers would want to actually look at M&A transaction. They would want to be sure about the asset that they are acquiring. If there are issues with the assets that they are acquiring, whether it is a regulatory problem, as was mentioned, or the quality of the asset that you are likely to get at the end of the day is not going to be useful to you as a business person, then obviously that is something that nobody would touch. So a due diligence on the quality of what you are buying. And nowadays, when you are buying businesses which are a lot of digital assets into it, understanding the quality of the digital assets that you are going to acquire is very, very important and very, very critical. So the due diligence on how you would understand the quality of the digital assets.
It's tougher, right, to do a due diligence on, so would you all hire external forensics for this particular due diligence, or internally you all take care of it?
So it's mix of both, actually. There are experts in the field who would help you understand that. At the same time, you have your own expertise within the companies who would try and understand that. But that is the issue that will be very critical in understanding whether to go for something or not to go for something, is, I would say, the quality of asset that you are acquiring.
Right. Madhav,
in the contracts would be, apart from what was mentioned, I think you would love to see India as a seat or venue of arbitration. You would love to see the laws of India apply. I think that's a big pushback that would come, especially in cross-border transactions. India as a jurisdiction for settlement of disputes may not still come into the contract because people would prefer Singapore or London to go. I think that's one not a very happy sign when you negotiate contracts, and you therefore by default agree upon you work, say, London or Singapore. So going back to the point of India becoming that arbitration hub, you need a full ecosystem, as we were discussing earlier. We're still not getting Indian laws, Indian arbitration forums as dispute resolution centers yet.
Right. My final question is, and I mean, no, not final, sorry, is talent. Okay. We discussed the lacuna in judiciary. Corporate lawyers, I know the money is great, all that. A lot of people do join the business because of the financial aspect of it. Are there parts of being a lawyer which you see the youngsters not keen on becoming? I don't want to be this lawyer. I don't want to be that lawyer. I want to be this lawyer. Do you see that? Verghese really wants to answer this question. He has a big team.
So should I kick off?
No, please do.
Yeah. No, I think it's, we have a lot of talent. I think we produce more lawyers today than we've ever produced in the past. And, the number of applicants that we get all the time just tells you the depth of talent which is there. And you want to absorb all of them, but sadly, you can't. So today, to be very honest, it is a market which is more skewed in favor of the corporates and law firms, because there's so much availability of talent who are looking for opportunities. So that reluctance to say I will not do X and Y is probably a little less than the time than when I started, which it wasn't so skewed in favor of law firms and corporates. And then it becomes a flavor of the season, right? So for example, today capital markets are booming, correct? Right. So everybody has a rush there. Young lawyers want to be part of the of the flavor of the season, etc., etc. But then there will come a time when flat capital markets will be flat, and then you will have lawyers not wanting to go into that field because there's not enough opportunity. So I think if there's one area, it is of market driven. A lot of it depends on how the economy is doing, and accordingly the interest of lawyers go there. Then, of course, there are youngsters who say, you know what, I just want to litigate because I love the law, I love the constitutional law, I love going to court. So that's a constant. So, that doesn't really matter what the market is saying. So it's a mixed bag when it comes to this.
Deepak, what have you observed?
So, one key point that I want to share here with the audience here, I don't know how much would you be aware of the developments happening in the legal field particularly, but it started already in the developed markets, and it is coming, and it's coming in a big way in other markets as well, which is that use of AI in legal work. And what we have seen, and the generative AI which is now coming and has come and has changed the landscape in a big way, will have a huge impact on the way legal work is done. And you will see that lawyers will have to reskill themselves in terms of understanding the generative AI and how it works. And this is something which is likely to change the legal markets completely in next, not very long from now. My guess is that in next 3 years, you will see a huge impact of generative AI, Gen AI
How?
on in the market.
When you say huge impact, how?
So the way legal work is done today is basically done by the knowledge and understanding of the lawyer. Right. Now that knowledge and understanding...
No, that's a gong telling you that time's up.
So that confirms what I was saying. But that is about to undergo a huge change, because generative AI, the research and the analysis of information that is available can be done today in 20 seconds.
Right.
Which a normal traditional lawyer would take 3, 4, 5 days.
Right.
Can be done in seconds now. So that way, if you have the right technology with you, if you have the right tools in the organization with you, you can be far more efficient and far more effective in terms of doing your work, and particularly doing your work in a way that is needed by your clients, internal clients. So this is a space which is changing very fast. US has already seen this, and of course there are pitfalls and challenges that would come along with it, like hallucination is a real problem that we have seen in US, where AI system is actually generating its own case law which never existed.
Sorry, AI is generating its own?
Case law which never existed.
Oh.
Right, so so it's called hallucination, which is a real problem. In India, we have seen in the Income Tax Tribunal, a judgment was given to the bench which was never existing. Right, it was all created by the system, by the AI system itself. So there are challenges that will come, but I'm saying that keep that challenges aside, which has to be addressed. But a huge change is coming in the way legal work is done in the law firm, legal work is done in the companies. And one of the things that we all have to be ready as lawyers is to reskill ourselves. And lawyers are, most lawyers are traditional, and they resist changes. in the way they work. So I think it's a big challenge that we will see in coming few years.
Madhav, on a very different note, and final one quick point. Madhav, I'll start with you. Right now, what is that one thing you love the fact that you are a lawyer? Like, I am so happy I was a lawyer today. And one thing that you detest, why did I become one?
I'll talk about the detest part. Detest is on, I'll start with that. The detest part is, practicing in the courts at a very early stage when you're a lawyer, especially if you're a first generation lawyer, there's no support. There's literally no support. And I think whether it's the authorities concerned, Bar Council, or whether the government, etc., should do something on that area. So many of the lawyers who passed out of law school, they all start off with this, I'm a part of a noble profession and I would like to change the game, constitution, etc., all of that. But the sustenance there is literally zero. And therefore many of them fall out, either move into corporate practice or in-house, etc. Don't go on to pursue their dream of becoming a litigating lawyer in that sense at some point of time that, so that's one part. But great time to be, because there is a ton of technology change, there's so much of disruption that's taking place in the legal domain, and therefore it's a great time to be a lawyer.
Right. Verghese, that's the last one. Best time and the worst times.
I think the high is always when you get a judgment or a ruling in your favor. There is that, even 25 years later, there is that dopamine
But that's
rush.
never really in your favor, right? It's still on.
So that's the rush. The downside, of course, is the frustrations, the delays. Sometimes you see a judgment and award which you feel, was it really on merit? Were there other factors which influenced it? Those are the frustrations of the system.
Deepak. Someone mentioned finances is such a great profession to be in right now.
No, of course, apart from what they've said already, I think one of the key reasons for me has been that legal is one area where people come to you with their problems.
Right.
And you get to solve their problems. So I think that is something that gives me a huge amount of satisfaction that, at the end of the day, I'm able to improve, or I'm able to give, or I'm able to support somebody in solving their problems. And that's where I get a huge amount of kick, as you rightly point out. But there are moments of disappointments, certainly, because in legal matters, most of the legal matters are adversarial. We know if somebody has to win, somebody has to lose. So there are moments when you lose out, and you therefore start thinking that did that strategy work, did it not work, and what we could have done better in order to do, make a difference. So, we have our own share of ups and downs in legal field as well.
Madhav, Deepak, Verghese, there's absolutely no dispute that this was a great conversation. And I am guessing nobody has any questions. They probably do. They'll probably catch you outside. Right. Thank you so very much. Thank you.
Devina, thank you so much for moderating that supremely interesting conversation. And please present a token of our appreciation to our power panelists. Let's have a warm round of applause for Deepak, Verghese, and Madhav. And Devina, of course. Before we move on to our next chat, I want to once again invite all of you to please help us take the conversations that are happening on this stage onto your online platforms. Share your thoughts, your takeaways, your insights. And when you do that, please don't forget to use hashtag MintIIS2025. I also want to remind all of you, and rather I hope that you're making the most of the intro bot, the networking app, the AI-driven app. You would have received it on a WhatsApp message. You can also scan the QR code that's placed at your tables. Make sure you click join now and explore opportunities of networking and collaboration that are certainly going to come handy in the next few hours of the evening. Now, if money never sleeps, geopolitics never hits snooze. From global supply chain to sanctions, trade wars, diplomatic dance-off, the macro chessboard shapes every micro investment call. Former diplomats and commerce experts, Anup Wadhwan and Rajiv Bhatia, decode what the world's shifting equations mean for India's economic playbook. Please join me in welcoming former Commerce Secretary, Government of India, Mr. Anup Wadhwan, who will be joined by Ambassador Rajiv Bhatia, Distinguished Fellow, Gateway House. And in conversation with these gentlemen is Ravi Krishnan, Editor-in-Chief, Mint. Welcome to the stage, sirs. Over to you, Ravi.
So, one of our panelists earlier in the day quite pithily put it. She said that, Devina Mehra, she said that Trump has taken a wrecking ball to all kinds of multilateral institutions, WTO, WHO, NATO. So, the world order as we know it since the Second World War, that seems to be changing. So I want to start by asking Ambassador Bhatia, what do you think will be the nature of this new global order which the Trump administration is trying to forge? Do you think it will be limited to global capital and mercantile alliances, or will it be more? Will it be sustainable, or should we all just hunker down for 4 years and wait for it to unravel?
So many questions in the first question, so I hope you'll give me 2-3 minutes to really answer it properly. Wrecking ball, Mr. Trump, all that is fine. Disruption, yes, there is no doubt on that. But I think, I come from the national capital to the business capital of India, so I should share the basic thinking that prevails at the national level. And it is that let us understand and interpret a new leader rather than demonize him for our own selfish reasons, pragmatic reasons, because we have to deal with the leader of that strategic partner of India. So disruption is happening. The global order, as we knew for the past 70 years, is changing radically, very rapidly. But the second question, which was there in your query, frankly, nobody knows what will be the shape of the new order. We all can speculate, we can analyze, we can also reach some tentative conclusions, but we don't yet know whether that new order will work out or not. And yet the fact is that on a day-to-day basis, our leadership has to manage the international affairs and within that our economy. And I think the message I bring to you from Delhi is that there is confidence, there is maturity, that we understand what is happening in the world, and we would try to deploy these changes and shifts in such a manner that India's interests, India's political interests, India's economic interests are not affected. So in short, I think people here who already are quite happy generally with the way in which our economy is being managed, can be assured that when it comes to international affairs, geopolitics, diplomacy, we are moving in a fairly positive direction. And Mr. Trump, in fact, if you would have seen Twitter today or X, he has just made a statement. He has once again praised Prime Minister Modi. He has just said that Mr. Modi and Donald Trump are good friends. And talking about the tariffs, on which, of course, my colleague would talk, Mr. Trump has just said that it will all work out.
Dr. Vadavan, will it all work out? This current protectionist stance which the US is taking, how is it going to play out for A, India, and B, also for countries which are export-oriented?
Yeah, so it's a very turbulent period, and, you know, in a sense, it's a continuum of sorts from President Trump's first term. And fortunately, in his first term, the lessons were learned fairly quickly, and he realized that the path he was professing, you know, putting tariffs and then inviting retaliatory tariffs from others was not a sustainable path, and it was not in the interest of any country to have that sort of an arrangement. So sense prevailed, and on the tariff front, foreign trade front, some calm was restored towards the end of his first term. And I see the same thing happening even today. And I think some lessons he has already learned. He put those duties on Canada, Mexico, then put them on hold. He put some duties on China, put them on hold. Now from April 2nd, he's threatening to put duties on a much larger scale across countries. So what it's going to do is disrupt the American industry. All these countries, their major trading partners, are major suppliers of inputs, major suppliers of critical intermediate goods, raw materials. So putting those duties will immediately impact US industry. I was seeing today, consumer confidence is down 20% in the US, and inflation, core inflation, is up by 20%. So inflation itself is not 20%, but whatever that level was, 2-3%, that is 20% higher today thanks to President Trump's action. So I think he will learn these lessons sooner rather than later. And as Ambassador Bhatia just mentioned, that Twitter message is encouraging. He realizes that he needs to sit down on the negotiating table. And I think with India, he's worked out a time path for reaching a kind of bilateral trade agreement. And he realizes that that bilateral trade negotiation in good faith cannot have reciprocal duties simultaneously applied. You can't expect India to accept that situation that you are experiencing duties imposed by the US on India, and at the same time we do nothing about them and negotiate a trade agreement. And if he insists on putting these duties on April 2nd, then India and other countries have no option but to retaliate. That's an accepted action, you know, in trade circles, trade parlance. If someone puts unjustified duties beyond their bound rates, these are all WTO violative, by the way, but of course no one is caring for the WTO right now. Then the natural response of any other country would be to put those retaliatory tariffs, and India will have no option but to put them. And then the trade negotiation can go on the side. So I am presuming that, you know, better sense is going to prevail sooner rather than later. And this sort of madness will not be, you know, sustainable for too long.
You want to add to that? No. Okay, but taking off from what he said, he appears very optimistic. Okay, but to give you one example, see, I'm not even talking about things like NATO where the agreement was implicit. Take the US-Mexico-Canada agreement, for example. Okay, it was a proper treaty which was signed between the three countries. Now his actions, you know, what the US is doing, it's not honoring that agreement, isn't it? How does one deal with such a situation?
No, I think it's important to appreciate that tariffs in certain cases are being used for larger political purposes. They are not only for commercial reasons. So especially when it comes to Mexico, Canada, China, and Europe, The larger political purpose is that the present administration feels that in one way or the other, either these countries are harming the American interests from the economic point of view, or from the migration point of view, or from the drugs point of view. And so the leadership has no hesitation in using a purely commercial instrument to secure the political objectives. In the case of India, if Mr. Vadhavan would agree, the approach is different. Here, the idea is that just forget about the WTO philosophy. There is no more this belief that developing countries of necessity must get some protection and developed countries must be always more generous. Mr. Trump says this is outdated philosophy. We are going to charge you the same tariff that you are charging us. And I entirely agree with the former Commerce Secretary. I think the message from Delhi to Washington has gone very clearly. We are ready for a mutually beneficial, mutually negotiated agreement. We are ready to take this trade level to 500 million, that is to $500 billion. But it has to be done in a proper way. And I think the team which has just finished probably has gone with much greater clarity, which must have been responsible for this rather positive sounding message by the president. So we should stay hopeful. But may I just add one more point, although tariffs is really not my domain. Two good things are happening. Tariffs are being seen by a large section of people in India as our one pressing opportunity to reform our economy. Just as we faced several important moments in the past, this is a moment for us to bring competitiveness to our products by lowering down duties somewhat to the same level as ASEAN countries. And now you notice that in this country, the pro-FTA environment was never as strong as it is today. The government is formally committed to produce 2 FTAs with EU and UK by the end of the year, and the bilateral trade agreement with the US by the fall. Other things are already happening. We already have some the FTAs signed. And on top of that, right now we are engaged also in negotiations for several bilateral investment agreements. So atmosphere is changing, and I think we must recognize that even before Mr. Trump came, all this has begun to happen. Now there is urgency. In fact, Jaishankar, External Affairs Minister, just 3 days back, said this in Delhi, that there is an urgency, and the government is totally conscious and willing to respect it.
So, Dr. Vadhavan, should we start writing obituaries for the WTO?
So you see, certainly the WTO is completely disrupted and essentially dysfunctional. Even, when the appellate body was functional, when Mr. Trump first came in, the appellate body was functional, and then at some point it became dysfunctional because the retiring members of the appellate body were not replaced. Even then, Mr. Trump went ahead and put those aluminum steel duties beyond his bound rates, on security ground. There is a security provision in the WTO rules that when you are in a situation like a state of war with another country, then you can violate your WTO commitments. But then he put those duties on his closest allies, EU, Canada, Mexico, India. So clearly he was violating the security provision, but then the WTO dispute resolution system and the courts have treated that provision with great flexibility. What is a state of war between countries is left to that particular state to decide. So even before the appellate body became non-functional, President Trump was quite willing to violate the law and exceed his bound rates. And then, of course, now there is no appellate body, so whatever disputes are decided by the panel, they are appealed into a void. The appellate stage is a void, and so it is pending in perpetuity. And so clearly the WTO, in terms of being able to enforce rules, is dysfunctional. But it remains important. It remains important even for the US. The US does not want the world in general to do to it what it is doing to the world. They want everyone else to follow the rules. In 90% of the trading scenario, they want the rules to be followed. They don't want others to indulge in the same madness. So the rules are still there for the weak to follow. If you're economically not very powerful, you violate the rule, your trading partners will retaliate against you. So for the weak, the rule is there to follow, and the very countries which are disrupting the WTO, they want the rule to be followed in general. So the WTO will remain important in that sense for others to follow. And the whole thing, I would like to say, President Trump's rhetoric is very misleading. It is founded on plain falsehood. He is looking at the goods trade deficit as the only measure of American success. So he looks at the goods trade deficit and says that the entire world is cheating us. But you need to look at the economic success of a country much beyond goods. The US economy has graduated beyond goods. They are a services economy. They are a tech economy. They are, the Microsofts, the Amazons, the Facebooks, the Googles. They are earning billions of dollars abroad. Who is going to count that? When you're counting just the trade deficit, you need to see the incomes on services. You need to see the incomes of your tech companies. And this whole rhetoric that, you can't have differential tariffs with developing countries having higher bound rates and the developed worlds having lower bound rates, that whole rhetoric is also misleading because it was part of a larger WTO negotiation where the developing countries conceded on things like intellectual property rights, things like services trade. So all these, pharma company profits are coming from those IPR concessions given by developing countries. The profits of the Amazons and the Googles and the Facebooks and the Microsofts are all coming from those concessions developing countries have given. So those higher bound rates were earned. Now President Trump just looks unilaterally at those bound rates and says it is not fair for our trading partners to have higher tariffs than us. But then you graduated away from goods, you're a services giant, and your people are earning huge profits. For instance, the Apple phone. Technically, the Apple phone is imported into the US and is contributing to the US trade deficit. But if you look at the value in an Apple phone, only 20% is non-American value. The material part of the Apple phone is 20% of the value. 80% is the intellectual property. That is all American. So what all this has done is created huge inequality in American society. America has done wonderfully well as an economy. It has been the most successful economy in the post-World War II world. Its per capita income is over $80,000, higher than Europe. It has done better than almost all other developed countries. So US cannot complain that the world has cheated us. This new economic order, especially with the strength of the dollar, has served the US very, very well. In the aggregate, they've produced a huge, economic surplus in the US. But in terms of sharing it, is where the problem is. There is a huge American underclass, which is the source of the problem. And when the last, Trump's first election happened, there were two options before the American people, and Trump's option was, I'll bring back the jobs of yesterday, and he's still promising the jobs of yesterday. His tariffs are supposed to bring back those steel jobs, and those auto jobs, and those textile jobs. And those are the days of the 60s when auto workers would get $60 an hour, lifelong pension, lifelong medical benefits. But those jobs are no longer there. Today, an auto plant is run by, say, 100 people. It's all robotics. The assembly lines are all robotics. A power plant is run by 5 people. So those jobs cannot come back. The other alternative was what Bernie Sanders offered, that I will prepare you for the jobs of tomorrow through access to education, access to public health. And he, of course, in the typical American fashion, was dismissed as a socialist. And America now, for a second time, has been deceived into believing that, those jobs of yesterday are going to come back. They are not going to come back. Ultimately, America will realize our problem is not exploitation by the world. Our problem is not that we have not done well as an economy because of our trading partners being unfair to us. they will realize that what is wrong with America is lack of equity, and ultimately they'll have to face this question, and better sense should prevail then.
Should prevail. But in the meantime, do you think the effect of this, Ambassador Bhatia, will it push India and China closer together? At the dialogue you were referring to, which Foreign Minister Jaishankar had, he did make a statement about, a thaw in relations between India and China. Because China doesn't seem to consider India as an equal. And right now, there is a silence on our borders, but is it temporary? And probably China is silent because it has bigger issues to resolve, like its economy, domestic consumption issues, etc. What is your reading?
Let me make some comments relating to what has been said by Mr. Vadhavan, and I'll also very much answer your question, and I'll try to be as concise as possible. I think from the viewpoint of international affairs and geopolitics, both the government and a large section of the strategic community is looking at the Trump administration not in a negative manner. I think Mr. Jaishankar himself has gone on record saying that there are many things about the Trump administration which are working for India, which are positive. The Prime Minister himself has said that there are certain common things, there are certain bonds between him and the American president. What exactly are we referring to? We are referring to the fact that Mr. Trump's rift with Europe has created greater space for multipolarity. And this is something which is very useful for India. Secondly, he has opened a new channel of communication and friendship and cooperation with Russia. This is a positive for India because India has been committed to Russia, and if our two strategic partners are going to talk to each other, it is good for New Delhi. And on top of that, I think there is this underlying idea of America to probably try to wean Russia away from China, do the reverse of what Nixon and Kissinger did back in 70s, which is again a positive thing for India. So in that light, your question about China and the Trump factor in it, I think let us be very clear and frank. There is an America factor in India-China relations, and there is a China factor in India-America relations. So as of now, India-China reset has started. It has not been completed yet. Serious efforts are being made to take the negotiations forward. And the hope is that things will move in a positive direction. And yet nobody is being unrealistic enough to say that India, China are going back to the Hindi, Chini bhai bhai days at all. 2025 or this decade, which I call turbulent 20s. There have been so many crises starting from 2020, COVID, Galvan, Ukraine, Gaza, and now this new situation. So we cannot be sure as to in what fashion the decade will end. But all that I'm saying is that yes, there is, obviously criticism in the world of the present American leader. But I think we can overall, at least from the diplomatic and IR point of view, take a somewhat more relaxed view.
Right. We'll open the floor for questions. Yes, please, the gentleman.
I think, my name is Harshit. I think you answered one of the questions, but I just wanted to understand India's role in, WTO negotiations with countries like Brazil, and how are they going to help us in terms of trade policies?
It was not clear. Can you give him a better mic, please?
Is it better now? Yeah. The question is mainly on the India's role in WTO's negotiation and how it is going to help us typically in emerging countries like China and Brazil?
I think he's asking about WTO negotiations, right?
Yeah, roles of India in WTO negotiations.
Role of India in WTO negotiations.
In WTO negotiation? Yeah, so you see, WTO was a major departure from all previous institutions which comprised the global economic order. WTO was conceived as a fully inclusive, member-driven organization with all decisions by consensus. So WTO basically, every member has a veto power. Any rules which have to be adopted, if even one country dissents, that rule is not adopted. So, and in spite of this very demanding sort of condition for rules to be adopted, WTO did quite well by adopting a lot of rules, including the trade facilitation agreement, which was the last WTO agreement. Of course, some of those rules have not been very fair to developing countries. Some of those rules did not have the outcomes that was envisaged. One major outcome was the bridging of the development differential between developed and developing countries. So all those things didn't happen. Then you reached a stage where the development agenda of the WTO was abandoned and those negotiations came to a halt. New issues came up, investment facilitation, e-commerce, all those issues were brought in by developed countries. And then, of course, you had all the non-trade issues coming into global trade, environment, labor, gender. All these were aimed at undermining the comparative advantage of developing countries. The West took 200 years to reach a certain labor standard. The West took 200 years to reach a certain environmental standard. But countries, at a different stage of their life cycle, like India, other developing countries, are expected now to reach that overnight. So comparative advantage which arises from different economies being at a different stage of their life cycle, that comparative advantage is being undone. So the WTO negotiation sort of mechanism is at a standstill. What happened was that these plurilaterals came up. Plurilaterals mean that you don't need the entire WTO membership to be part of it, but countries which are interested in a particular area, say investment facilitation, e-commerce, MSME facilitation, they came together, 70, 80, 90 countries in each of them. So they are now negotiating and they will come out with rules which will apply to them. It is left to be seen whether those rules will apply to those who are not part of it. To the extent those are concessions extended to that group by the members to each other, whether those concessions will apply to the others who are outside the group. So all those questions are up in the air. But right now, WTO negotiations are a non-starter. To the extent, things change, we have to wait for, 4 years down the road and later. To the extent things change and people want the WTO to be revived as an effective body governing world trade, then yes, certainly India will have a major role to play. But let's see what happens.
You want to add a point?
No, I just wanted to bring, looking at this very well-informed audience, and we have been hearing, I came at your invitation a day earlier to learn so much about the business discussions. I just wanted to mainly say that that in terms of opportunities which exist for India today, because there are challenges, there are customs, but opportunities are important. And so in that context, IMEC, India, Middle East, Europe Economic Corridor, especially for people living here in Mumbai, is of great relevance. And I think I wanted to raise this because in your own town, our think tank, Gateway House, and my colleagues are here, including the executive director, they have done a lot of work on IMEC. And they have recently made a detailed presentation on IMEC and what are the opportunities for Indian business. So in that sense, maybe if Mint is interested someday, we can do something together to put across the idea that there is life beyond Mr. Trump as well, although US is supporting and backing this project. So essentially, if we could look 6 months down the line, and if we are a bit positive, it is quite possible that some of these agreements which are under negotiation may actually be successful, and many more opportunities may open towards in the Western countries. In Russia, for example, Manjit Kriplani has just returned from Russia, and she's talking about how much of potential there is for Indian labor there. And then, of course, in Southeast Asia as well. So there are opportunities. Let us not be daunted only by the challenges.
May I ask
Thank you.
Can I ask a question?
Okay, one final question.
Yeah.
Yes.
In the changed scenario, what are the possibilities of SDR becoming an alternative global reserve currency? Special drawing rights.
Global reserve currencies. He's asking about global reserve currency.
There is something called SDR, special drawing rights.
Special drawing rights of the IMF.
Re-emerging as a global reserve currency since BRICS currency is out of the way.
Yeah, so SDRs are just, it's a bundle of currencies. So you see, what makes a currency strong? For instance, the dollar is generally the currency in which trade is denominated. But that is not what is making the dollar strong. What is making the dollar strong is people's willingness to buy and store dollar-denominated assets. They have faith in the dollar. Ironically, when the US causes a crisis, global financial crisis originated in New York, ironically, the money was rushing into the US as a safe haven, because the belief is that if someone is going to come out of this crisis, it is going to be the US, which will come out of it first. So the faith in the assets denominated in that currency is what keeps it strong. Let us say today you say that all trade in the world will be denominated in one of the BRICS currencies and trade will be settled in that currency. It is not still going to make that currency strong. People will trade notionally in that currency, but moment the trade is settled, when they have to decide their asset portfolio, they will hold assets of currencies they believe are strong. Like the Chinese currency, thanks to their huge trade surpluses, has acquired strength. So Chinese currency denominated assets are held in the West. So to the extent, President Trump is doing all these things, he's going to undermine faith in US denominated, dollar denominated assets. The Chinese are sitting on $4-5 trillion worth of US Treasury bills. If the Chinese get worried about the future of those US Treasury bills, they will quite logically and naturally want to get rid of them. And then you will suddenly discover that, the strength of the dollar is not that much there. So even if BRICS countries are going to trade in their own currencies, it is not going to undermine the dollar till people lose faith in dollar-denominated assets. And President Trump, by threatening BRICS and all that, is actually undermining faith in the US dollar. So by trying to achieve strength for the dollar, he's actually, undermining faith in the dollar. Similarly, for instance, there's India has wanted to trade in rupees, and we are trying to make rupee an international currency. That will come ultimately from India's underlying economic strength when people feel that the rupee is a stable currency and rupee-denominated assets can be, kept as a store of value, then, the rupee will also become strong. So SDRs are simply reflecting the strength of the currencies which are part of that basket. I hope I answer your question.
Well, I'm afraid that's all we have time for. So if you're worried about Trump's effect on the global economy, our panelists are hopeful. They are saying this too shall pass. Thank you, Ambassador Bhatia and Dr. Vadavan.
Thank you so much, Ambassador Rajiv. And Anup sir, Ravi requesting you to kindly present a token of our gratitude to our panelists. Thank you very much, gentlemen. Stay glued to your seats, everybody, because we are shortly going to move into our very next conversation. It's a panel discussion. You know, taking a company public is like raising a curtain on a show that never ends. You've got quarterly reviews, investor drama, and market mood swings, and yet the rewards can be legacy defining. It's time to hear from two leaders who've done it with flair and caution as they share what it really takes to scale after the IPO spotlight hits. Joining us for this conversation is Nitish Mittersen, CEO and Joint Managing Director, Nazara Technologies Limited, Alok Bajpai, Chairman Managing Director and Group CEO, Ixigo, and our moderator for this discussion, making a comeback, is Sneha Shah, Deputy Editor, Miis. Welcome, Sneha, and all yours.
Xenia. Welcome, Alok and Nitish. Thank you for agreeing to do this. The topic that we have been given is very, very interesting, you know, in the context where in the last 3 years, it has been a whirlwind ride for new age companies who have, you know, tried accessing the capital markets through the IPO route, where the outcome for some companies has not been so encouraging. Others like you have seen really successful IPOs. So, you know, who better than both of you to hear on how the journey has been? What do you do to get it right, and what are the pitfalls one should avoid? It will actually serve as a guiding light for a lot of founders who are on their path to an IPO. So first up, you know, Nitish, if you can talk about, you know, the journey up to the IPO, and back then in 2021, you were probably the first tech company to just list on the exchanges, followed by Zomato and other companies, you know, in that year. So, you know, how did you time the market? What was the thought back then?
Sure, happy to share that. So, you know, timing the IPO market is always difficult, and we made our first attempt in 2018 actually, right? And went all the way, did all the road shows. Actually, markets went bad. Our numbers were not so great, and we couldn't get one-time subscriptions. And then in the middle of COVID, I think it was October of 2020, we decided to make another attempt. That time we learned the lessons from the first time around. So I think we were able to pull it off within 6 months. This time oversubscribed 175 times. So I think it's, you just keep, you know, pushing ahead, and hopefully it all works out.
Right. And it has been a similar experience for Ixigo as well, where, you know, it was the second time around when you, you know, access the market. So, you know, Alok, can you talk about it on, you know, really getting it right in terms of timing?
No, I think it's very common for both of us, like in that sense. We actually made our first attempt by filing in 2021. This was a few months after Zomato went public, but the reason for our timing was very simple, that, you know, we looked at our FY21 numbers where lockdown was prevailing for almost half of that period, and we were actually the only OTA that had grown during a lockdown year and had made a couple of acquisitions. In fact, we were super confident about what the next year would look like in terms of profitability, and that was the reason why we actually filed. But by the time we got our approval, and then, you know, the market started to turn early 2022, we realized that we were swimming against the tide, because most of the new age IPOs, except perhaps yours, were actually trading below water, and the investor sentiment turned dramatically. So, I mean, my learning is you can only time markets in hindsight. I don't think we were trying to time it back then, but just got unlucky to be caught in that 2022, 2023, there were hardly any IPOs, right? And in fact, I said to myself at that point that, you know, we'll come back much stronger as a company with far better metrics to show, so that people don't believe that 1 year was just a fluke. And we actually, when we came back, we were 6 times our pre-COVID scale. And, we'd proven that we can get to double-digit EBITDA margin. So I think I think in hindsight, it was the best thing to happen to us because, and I'm sure you would have had a similar experience because we got to meet public market investors early. We converted into a public company, started following almost all the norms that apply to a public company, and we got 3 years of net practice essentially before we actually got to ring the bell. So in a sense, I think I mean, something I recommend everyone that, yes, don't need to do second attempt, but at least start meeting public market investors 2 years at least before you are thinking of a listing. You get so much good feedback about your story. And if you're able to then beat the numbers when you go 2 years later, it also gives more confidence. So yeah, we also thankfully did that. We beat all the growth expectations they had, got a 98x subscription. I just feel lucky to be sitting here.
Right. While timing is one of the biggest factor of getting it right, I think pricing also plays a very big role. And, especially for you, Alok, your IPO came at a time when there was a lot of backlash for companies, new age companies that went public and then, did not really do well. So how did you take that feedback into account and, try to price it? Because, it's definitely that you priced it so right that the IPO is trading above the listing price, right? I mean, the stock is trading above the listing price.
Yeah, so I mean, for our IPO, we got anchor bids at all sorts of levels, but we basically just optimized for quality of investors. We wanted long-term investors, and if that meant leaving more money on the table, that was okay because we just wanted to see a few names that we really wanted there on our anchor book, and all those, most of those guys are still around, on our cap table. So in that sense, I think it's important to think about whether, because at the end, the IPO day price matters to what extent, right? As a founder, if you're building for the long term and, you're going to hang around for a few decades, or till you retire, then, is it that price that's going to matter, or will it matter that you actually left enough on the table for everyone who subscribed to your IPO to actually make money and remember that? So I think we just, in hindsight, just went back and said, okay, we're fine leaving more money on the table if needed, and but let's make sure these 5 investors we really want to see are in there. That's how we thought about it.
Right. To Alok's point about, doing the net practice before they really, went on the field, Nitish, how did you prepare for the IPO internally? And, because you said that, it also took you, 2 attempts to access the market. How has life really changed? Because, from being private to, driving a lot of decisions in-house, now, you are in public scrutiny. It does change life. So how has life really changed as, someone who's running the show?
Sure. No, we complete 4 years. I think, what's today, 29th, right? I think because in the next 2 days, I think 30th we listed tomorrow. So 4 years we complete tomorrow. It's been a very interesting journey. I think markets have been up and down. As you said, Nazara's stock has done fairly well, even in the difficult periods. I think I'll just answer a bit on the question he answered earlier. I think as a management, as a founder, as a CEO of a company, you have to stand your position when it comes to what you want to do with the IPO, because a lot of different stakeholders will have different views. During our IPO in 21, I do remember, because the demand was so high, there was a lot of push to increase the IPO price, right? And we fought back a lot because the whole idea was to price it right, not only for institutional investors, but also for retail investors. And I think that is one of the very important reasons Nazara has done well over the last 3-4 years. Because had we overpriced it, and once your stock falls 50%, then it becomes a very challenging situation because you lose the public trust.
It then becomes more psychological also for investors,
you tend to
right?
lose the public trust. I've enjoyed the last 4 years a lot, I would say. A lot of people scare you saying going public has so many issues, right? I think one is people are always scared of quarterly, all the hygiene when it comes to all the compliances, etc. But I think if you're having fairly good corporate governance, more importantly, as long as your intent is positive, I think public markets are okay, right? as a business, you will always make mistakes. You will have tough quarters. You will have good quarters. I think positive intent, right, and transparency. I think these two things are very important. And I'll give you one example. A couple of years back when the bank in US went bankrupt, a big one, we had, one of our subsidiaries had some 60, 70 crores stuck over there. And this happened on a Friday night. I was advised to wait till Monday morning because it was expected that US will intervene and solve for it. But we actually went and made an market intimation on Sunday morning. We were the first company in India to make that, public company to make that intimation, and obviously we became the poster boy, everybody carried it. But I think when I met investors later, they actually appreciated it, right? That we were quick to make those intimations. So I think as long as you're doing the basics right, there's no stress to that extent. Of course, public markets are much more scrutiny, but it's also positive because you're not a cowboy anymore. And there's a right age and a right time to do everything, right? What you can do in college, you can't do after you're married. Same way, I think as a public company, there are certain responsibilities, but they are positive. I don't think they're negative.
Right. When you say that, there are a lot of responsibilities, at the same time, when you're a private company, there are a lot of decisions that you can take, on your own and, just go by your conviction. And one such thing is inorganic growth plans, where, you can plan inorganic growth, better and you can execute them faster. Here, as a public company, has anything changed? Because Nazara has acquired a lot of companies and so has Exico. So I would want to hear it from both of you on how, inorganic plans can be executed in public. Does anything change?
No, I haven't found any change as such. In fact, I found it to be easier because as a public company, the management and its board, right, takes the decisions. You don't have to go to individual investors for approvals, etc. Compared to a private company which may have raised money from VCs and institutional investors, where a lot of them have, rights which you have to get it approved. Of course, for material decisions, you have to go to the public shareholders in large.
But there's always a worry that it might impact, how the investors are going to perceive that move, right? And whether it would impact the stock price.
I think you can't run a public company if you can't run a public company well if you're worried about the short-term stock price, right? You have to take the right decisions, what you think are the right decisions, what your board thinks is the right decision from a medium to long-term approach. And you will make mistakes, but you have to be transparent in accepting those mistakes and still do the right thing, what you think. Because the investors have invested in you, your company, your management, your board, because they believe that you have the experience in that particular business to take the right decisions for them. If we start doing what, a lot of different investors will have different views, right? So it's very difficult to start tweaking your business model or your strategy based on what individual sets of investors will want you to do. That's again my personal opinion. Alok may have a different opinion.
Yeah. Alok?
I think when it comes to M&A, right, communication is very important. It's important to communicate why you're doing it and what that brings to the table. But then again, there will always be some people who do not understand it. And one advice I always have for people going public is that you have to be willing to be misunderstood for a very long time. This is something Jeff Bezos said when he was launching AWS, and for many years, people did not understand what he was doing. But it's very true, right? So in a sense, it's sort of self-selection, right? So if you're a company that's optimizing for building for the long term, in the short term, some of your decisions may not make sense to the wider public. But there's a small subset of long-term shareholders that you want to attract on your cap table who will understand what you're doing and support you because they've seen your track record, right? And, public markets tend to shortchange track records and only focus on the next quarter. But if you're building for the long term, it shouldn't matter to you. And I think one has to become, in that sense, of course you have to do it in a measured way and communicate it right, but then you have to become a little thick-skinned in that sense. And there's so many examples of great acquisitions which at the time they were announced was not understood by anyone. As long as the track record of the founders on extracting the synergies, keeping the team, etc., incentivized to grow with them is there, I think there's no reason why. The best, name any large at least in tech, consumer internet, name any one large consumer internet company who does not, I mean, if you think of fundamentally, why they exist today, if they didn't make those acquisitions, they would not exist. If it's Google, Meta, you just go back and look at their history. Some of the game-changing acquisitions they did have become their raison d'etre today, right? And I think so it's very important actually to, keep on the lookout for great teams and great acquisitions, especially as a public company when you have the currency, you have the ability to raise more money. It's actually a great strategy if you're able to get the DNA and cultural fitment right.
Right. Nitish spoke about, being, making mistakes and, being transparent about it. Do you think that scope of making mistakes just, reduces when you are a public company?
I think there are two things. One is obviously what is the magnitude of the mistake, right? If it's a magnitude that severely damages the company, then of course it's a problem, right? And there are a large number of shareholders part of this. So it impacts a very large number of stakeholders in the company. So as a company and its management, you obviously have to be very mindful of that what is the magnitude of making mistakes. At the same time, especially in fast-moving technology businesses like ourselves, if you will not experiment a lot of things, you will get obsolete in any case, right? Because I think one of the biggest things in technology is the march of time and the march of technology. It's evolved so fast that you can either lead from the front or you can become obsolete over a period of time. So I think smaller, well thought out, well contained risks are worth taking a shot at. And if, like Alok said, communicated properly in all transparency, and it's evident that it's all done in good faith and with the right positive intent and effort, then I think all shareholders are quite forgiving,
Right.
is what I've seen.
Right. You both make it look like it's a cakewalk to be going public, but I'm sure there are challenges as well. If you can just talk about the biggest challenge of being a publicly listed company, one each, that would be great.
I would say one, you have to be very transparent, and you have to understand that even one person with one share in your company has a right to question you and accept that, right? I'm quite happy with even saying what I ate for breakfast. It doesn't really matter, right? So I think that's very important thing to accept and understand and actually follow through.
Right. Alok?
I think it's important to sort of, set the right expectations because, the mistake I've seen people make is sort of overcommit and underdeliver, especially at the time of IPO. And so you just can't miss your first 4-6 quarters. I mean, it's just hygiene not to miss your first 4-6 quarters, right? Like, if you don't have the confidence, don't come and list, right? And I think in that sense, it's tough because it's nerve-wracking for the team because, like, you have basically the rigor that is needed there to meet whatever you're projecting every quarter. As a private company, there's more tolerance for misses because you have a couple of investors on your cap table, who are sort of okay if you miss the plan by 10-20% because they're still going to make a crazy return anyway. But I think as a public company, the scope for those misses become, sort of, it's not there, right? The market punishes very heavily. And so there's no room for hubris there. I mean, it's important to sort of undercommit and over-deliver. And I think the batting practice we got in those 3 years probably really helped in that sense because at least, for us, we were reporting our numbers every quarter internally to our board, which was an independent board, and sort of got that rigor of saying, okay, are we meeting whatever we are projecting for ourselves? And at the time you believe you can actually do that is when you should go and list, right? So it's important to, that's a critical test for are you ready?
Right. The conversation is so exciting that I can go on and on, but I would want to open the floor for some questions. If, someone from the audience wants to ask. Yeah, the gentleman over there.
Yeah, glad to listen to you guys. And so my question is, if you look at the corporate India, some of the observations as a banker we got, like when you tried for IPO in 2018, I guess few months back, DMart also got it listed. Industry was having average price earning of 70, 80. Mr. Damani positioned itself at price earning of 28, 30. It got a fairly amazing response. At the same time you tried, the IPO did not got successful. The same thing with when you tried for IPO, Tata Technologies. I mean, who does not want to put money on Tata being large conglomerate? Industry was at very interesting price earning at some 70, 80. A lot of guys like Keynes got listed, but they positioned themselves at a price earning of 25, 30. So my point is, do new age guys really mean that they wanted to leave something on table for investors, first thing? Or there are kind of some kind of imminent pressure from the private equity side to cash out on the opportunity? Because if we closely look, both the IPOs, opportunity got failed. But then at the same time, some great companies flourished like anything at that time, like Supriya, when you tried, PB Fintech. So how exactly?
So I won't comment on any specific company, but what I'll say is something what Nitish already pointed out, that you got to control that process as a founder. You can't let the banks or your private equity guys, etc., control that process, right? You have to call the shots at the end on, does this make sense for wider shareholder base that we're going after? And if there's even an iota of risk, you're better off pricing it even lower, which is exactly what we did, by the way, because the market was still kind of, the day we filed our RHP was the day the election results came. The market was down 6% and the banks were actually kind of jittery saying, are you sure you want to do this, Alok? And I was like, I know, I'm confident that my numbers are solid, right? Why would I wait, right? But the fact is, because of that, maybe we just went conservative on the price because we didn't want an iota of risk there, right? And in that sense, I'll not comment for the larger new age ecosystem, but I think it's sometimes there are constraints that companies may have. It's important as a founder to sort of push back those and just say, like, this is what makes sense at this point.
Any other question? Yeah. The lady over there.
My question is to Nitish, sir. Sir, so where will Nazara invest next that will drive its future?
Where will Nazara invest next and?
That will drive its future.
Yeah, and are you a shareholder?
Yes, I am.
Okay, then I have to answer it. I think for us, the gaming IP business, and we've made many acquisitions of gaming studios in recent times, including a studio we bought a few months back in the UK, is an extremely attractive opportunity at this point of time, and we'll continue to double down on that particular opportunity. We've also got about 10% allocation to experimenting on all new technologies in the gaming world. Right now in the gaming world is undergoing a lot of transformation. It usually is, but this is a particularly very fascinating period where you have multiple macro level technology changes happening. So I would say AI, of course, being a very important one, which is disrupting all industries, not just gaming, but definitely gaming. Virtual reality is coming at us fast. It's been coming for a long time. It's been on the horizon for a long time, but it's getting nearer and nearer, and I think it's a game changer for our world. And third is the Web3. Again, it's gone through its own cycles of hype and pessimism, but I think digital asset ownership will become something very big in gaming. So I think we're always experimenting with new technologies as well, so that again, like I was saying earlier, we don't get obsolete, right? So I think existing business, gaming studios is something going to go after. The largest acquisition we did earlier this year was of PokerBaazi, which is India's largest online poker platform. But core gaming studios is what we will go after in 2025.
Thank you.
Right. That would be the last question from that gentleman, and then we'll wrap up the session.
Thank you. So my question is to both of you. So how long, it took your respective companies to become IPO ready? Like how many years of, since you decided that we can become public, how many years it took? And as a founder, is it more like, I have to list in 3 years, so you start working backwards that I have to do all this every quarter to get it listed? Or is it more like a process when you're just focusing on building and then IPO is more of an outcome? It's not a thought out process that I have to list and then I work backwards. How do you go about it?
I think, good question. I think a lot of it should be outcome because it's much easier that way. So for example, in our case, Westbridge Capital invested in our company in 2005 when we were a very small company. And at that point of time, the partner there, Sandeep Singhal, who I worked very closely with, recommended that we bring in EY as our auditor. And we were like a few crores revenue company. And I was like wondering, why do we need a auditor like EY, right? Because I would personally spend 1 month before the year end just sitting with the auditor trying to get it sorted. But the lessons learned over a long period of time really came in a lot of use for us when we attempted to IPO in 2018 or finally IPO'd in 21. Small things like corporate governance, no related party transactions, etc. Right? So I think now what's happening is startups that are starting today, right? The IPO cycle is potentially much, much faster. It's not like 25 years, let's say what Nazara's story is. It's probably 3 years or 5 years out a company can easily IPO, which means the learning curve is going to be much shorter, everything is going to be much shorter. So I always suggest to all startups that from day one, if you can try and keep a basic governance, all of these in place, when you try to go IPO, it'll be much helpful. But also companies that are generally planning an IPO, I would say they need to start thinking at least a year, 2 years ahead of it. Start building quarterly numbers, start cleaning up a lot of their paperwork, ROC filings, etc. Right? There's a lot of minute details. You need to start working a year to 2 years in advance of actually listing the company.
No, I think very similar. It's important to, there are two parts, right? One is the governance and compliance parts, which I think even on day zero when you incorporate a company, right, it's not something you can push aside. I mean, essentially, governance is in the founder's head. The way the founder is comfortable running the company is what defines governance. And I think from day one, you should be like zero tolerance about some of those things, right? Because that culture is hard to change later on. I can promise you that. The other thing is that, you should only think of an IPO if you are actually sure that you are trying to build a company that lasts or a company that's generational in nature, right? Because it's not a path that is for everyone, because there are some companies where, the nature of the business is such that there is a high, let's say, disruption risk, or there is a high chance of pivoting over the next year or two in a much more dramatic manner. And I think some of those things, if you have too many moving parts at the time you go public, it's also not the best time. And then if the size is not big enough, you don't get coverage, or you won't get enough large FIIs coming in, or the large DIIs coming in, because they might have certain thresholds. So it's important to sort of make sure you take all those boxes, which are pretty hygiene, before you actually go ahead and start planning it. But like we discussed earlier, it's better to actually dipstick the market 2 years prior to when you think you want to list. It's great feedback, because you might believe a certain version of your story. Trust me, the public markets look at your story from scratch. It doesn't matter what track record you have as a private company. I think the public market needs to understand your story just like a public market investor needs to.
Right. It was great, getting the do's and don'ts about taking a private company public. Thank you so much, Alok and Nitish, for making time and speaking to us. It was really lovely talking.
Thank you, Alok and Nitish. What an amazing conversation, packed with loads of insights. Sneha, please present this to Nitish and Alok on behalf of all of us in the room. My dear friends, this is where we break for a quick cup of chai and coffee. And when I say quick, I mean we have a turnaround of 15 minutes. At 5:15 p.m. sharp, we will kick off with the final but the most awaited segment of the Mint India Investment Summit. And from start to finish, this is a segment you don't want to miss. So please be back in your seats at 5:15 p.m. Thank you.
the last few years?
Yeah, so first of all, thanks for having us. It's great to meet the panelists as well a little bit earlier. So I'll talk about this from two perspectives. One, of course, it's an oxymoron usually putting sort of cement and exciting in the same sentence. But we've had a fairly exciting 2 years. There's been tremendous amounts of consolidation, led largely by an acquisitive 2 larger players in the industry, which have then pulled the entire industry with them, right? And we've seen, again, flurry of acquisitions, not just in one specific pocket, but across the country, right? All shapes and sizes, colors of cement players for different reasons being pulled into this consolidation. I mean, personally, I see that as a really positive thing because it is a sign of maturity of the industry. And I think we're seeing this play out across the manufacturing sector where, traditionally, if you go and see a developed nation or developed country where the top 3-4 players would occupy 70% of the market share, that's happening now, at least across manufacturing, certainly in the cement space. So as JK Cement, of course, is a mid-sized player, what do? We certainly don't have the balance sheet and cash flow to be as rampant and aggressive on the M&A side, certainly not in size. So we've taken a slightly more holistic, a more sustained look. And I think that's sort of the message for, say, mid-cap players in this space, that you still will grow and you need to grow. Traditionally, we've grown through greenfield, brownfield, or M&A. We're seeing a lot more activity on the M&A side. Where we've got a fairly comprehensive look at our balance sheet and cash flow and said, whether it's for market expansion, whether it's for downstream investments in new businesses which create new revenue pools, or it's actually backward integration where we're creating a sustainable model looking at raw material acquisition, because that is also going to be sort of a name of the game in the coming, say, 50 years. We're in the long-term business. So we've taken a look across these multi-dimensions. We've done about 3 to 4 acquisitions over the last 2 years. We entered the paint industry through our white cement business, which is a natural next step. And the reason for going acquisition it was not just in the interest of adding capacity, it was also in the interest of adding know-how and innovation, something that we didn't have in that space, right? So as JK Cement, and I think most mid-sized players, take a look at your balance sheet, look at your cash flows, and you have to start creating new pools of revenue. And the M&A space is a very interesting one to be in to do that.
Yeah. I want to ask the 3 of you if, to react to that and kind of give some insights on whether there are enough drivers for consolidation within the domestic space over the next few years. Chandresh, if you can start.
So I think as far as the domestic M&A is concerned, the drivers are many. I mean, the first of all is that one is looking at India being still a bright spot relative to where the world stands today. The market is huge. There is a lot to be achieved. If you look at even efficiencies, for example, today the Indian industry spends close to 12-13% of its cost on logistics. The global standard is probably 5 to 7%. That is one efficiency that needs to be achieved. The size of the market itself is growing. The build-out that has to be done is significant. So the size of the opportunity itself is large. Now, if you want to look at capex coming in, and if you have multiplicity of players, then obviously this is a clear recipe for a consolidation to happen for the large players and really the market to be shared, by a few of them. Initially, the market is created, and then it is expanded and penetrated even deeper. So I think the drivers are huge, both on the cost side of things, on the demand side of things, as well as on the revenue side of things.
Arun, you want to touch upon the sectors where you see activity will heighten in inbound and domestic?
Yeah, from a domestic standpoint, I think consolidation has been a key driver for the last 18 to 24 months. I think just to add, I think corporate balance sheets are incredibly clean. There's a lot of dry powder and access to capital available, which is driving some of this activity. I think scale is also helpful in lowering cost of capital, navigating the ecosystem. So some of those drivers will continue. Sectorally, infrastructure, we're seeing consolidation in the energy space, you're seeing consolidation in the cement space. Healthcare is another area, both services as well as pharma, where you continue to see consolidation. And outside of that, you've seen a lot of consolidation in media and telecom. I think from our perspective, those are some of the top 3 sectors. So, places where there's capital intensity, we would expect to continue to see consolidation.
Right.
Just to add to what Chandresh said, from a domestic perspective and the consolidation we're clearly seeing, if you look at overseas as well, the outbound investments that you look at, from that perspective also the amount of ODI that has gone overseas and the way some of the Indian conglomerates are looking at overseas investments and then looking at conglomerate, consolidating, that has also considerably changed. We're seeing billions of dollars going up, whether through guarantees, loans, and equity. That investment is certainly high. One of the things which was mentioned was the fact that we're looking at market domestic infrastructure, which is direct. But if you look at ITES, that is also one sector which we're seeing a fair bit of consolidation in that, and we are looking at large conglomerates, whether there could be Indian conglomerates looking at, let's take Bharti looking at overseas acquisition, which was $1 billion deal. You can look at HCL looking at a large deal which they recently concluded in 24. And I'm only talking about the 2024 kind of picture. We're looking at Infosys buying out an R&D center. We've looked at Wipro buying out. We looked at L&T. So if you look at FY24 itself, we're seeing a fair bit of acquisition kind of mode. And then, of course, as Chandresh rightly said, there are clear factors why consolidation would happen in the market. There is no reason why it should not. Yeah.
Extending that thought, you mentioned outbound acquisitions. Is India Inc. sort of ambitious now with respect to outbound acquisitions? Has that come back into the market?
I mean, from an outbound standpoint, as Siddharth pointed out, volumes last year were double of what they were in 23. I think it's driven by, first of all, confidence in India Inc., that they have the capabilities, the products to compete on a global scale. So I think, when he spoke about Bharti's acquisition of a 25% stake in BT, that was a meaningful acquisition driven by their confidence around the fact that they could add value to BT, which historically one wouldn't have thought about. There's also the other drive, which is a need to acquire technology and then see how you could scale that up, because we have a large home market, and it's driven by differentiated valuations where international valuations are a lot lower. So it's possible for Indian companies to acquire these, to provide the capital, and then to bring them to the home market, either as a market or from a cost standpoint. So I do think this will continue, especially in the sectors, we're talking about Make in India. Some of those sectors you would continue to see a lot of overseas acquisitions.
Right. Do you expect the tariff conversation to also trigger outbound acquisitions?
That is one of the things, Rajani, which comes in. So if you look at pure data, and let's look at data, we've got around $13 billion, which has just gone till November of FY24 as ODI, which has happened, which exactly what Arun's saying. If you look at that data and further divide and break it down, we've got Singapore, we've got US, and then UAE is the highest intake of ODI from that perspective. But then you look at the Indian conglomerates, and I gave that example earlier. You look at some large deals only in FY24, a clear signal where there is capacity and there is clear intent of Indian conglomerates to invest. Now, we are not doing what you would see a US or a Chinese company be able to do, but the acquisition mode from an ODI perspective has been pretty aggressive, and I think it's just the start in my view.
If I may add a couple of things. I think, India has had its flirtation, let's not call it a flirtation, but probably it has had its experience of doing outbound. If you remember to 2007, 8, kind of melee, where you had the Chorus, you had Jaguar, you had a bunch of others, Hindalco, Novelis, a number of those acquisitions. Now, some of them, I think most importantly, it has resulted in a lot of learnings for the Indian corporates. What has changed after that? I think in 2007, India wasn't seen as an acquirer as such. Then you had an era where China was seen as the biggest acquirer. China is no longer on the radar now. And I think naturally, for an asset which is put out for sale, India is contacted. Now, is India ambitious? Is India willing to take that bet again? I think one, as rightly pointed out, the balance sheets are the strongest ever. I think there is a lot of cash sitting on Indian balance sheets today. Second, the size of the opportunity is huge. You look at, the Birlas, you look at, Adanis, you look at Tatas, everybody is outputting, greenfield plants now and diversifying. So the opportunity set and the returns that India has to offer are significant. Now, does that mean that foreign acquisitions are bad, and what happens on tariffs? I think things will stabilize. Things will stabilize to say that, what is the actual economic impact of the tariff, and does it make sense then to either supply from outside or to set up facilities outside or to buy facilities outside. So I think that will play out after a point in time. But my view is that the Indian corporate sector today is a little cautious today. I think it is aware where it stands, vis-a-vis global benchmarks. So India doesn't today, it doesn't benchmark itself to the competition within India. I mean, the Indian businessman today is so aware of what's happening globally and what are the developments that are happening globally. I think the only thing which is lacking is innovation, but otherwise we are all there.
Is the caution that you mentioned because they're trying to learn from previous mistakes? Is that, Amit, please.
Yeah, I mean, just from let's say from a corporate perspective, I think if you see the delta over the last, say, 10 to 15 years, I think there's, and you were talking about sort of early acquisitions that were done by India Inc., capability build that has actually taken place over the last 10, 15 years, and the confidence of being able to take systems, processes, procedures from India, from our company here, as opposed to just copying or replicating what was being done in the company that we're acquiring, is no longer the case. Mm-hmm. So we're actually taking practices from the way we work here. So if you take our industry, for example, where we're probably the most further advanced in terms of distribution, logistics, retail sales, probably amongst any cement, nation almost on the planet, which is retail oriented. So, we've got assets, for example, in Africa. And a lot of what we've learned here, we're now replicating and using that innovation that we've developed here over years, which was not the case 10 to 15 years ago. That gives us the confidence that, and we are looking at acquisitions in Africa as well. We've got something on our table, whether we close that or not, but that confidence wouldn't have been there 15 years ago. Right? So there's a tremendous amount of capability building that has happened. It's been obviously a learning. Therefore, talent acquisition, strategies to acquire the right talent has also happened. It's not that we're parachuting people, say, from our head office here. We've got the confidence to be able to hire locally, train them up on business practices that we've got here, and then also look at value addition and value creation with those acquisitions that happen on the ground.
Right. So essentially, post-M&A integration practices have improved traditionally, over the last few years. Is that something that...
Simply put, first of all Indian companies have a massive opportunity in India. So if you are choosing to go overseas, there has to be good reason to do it. One is technology, one is we have great business practices, great things we know can be replicated in those markets and create value. If those parameters are not met, Indian companies don't need to go overseas. So they're going to go there in a very targeted fashion, and that's what you're going to see in outbound M&A. I would continue to, whilst it will grow, because Indian companies are growing in size, scale, capabilities, I think domestic and inbound will still continue to dominate M&A activity.
Okay. I want to next come to the topic of valuation with respect to the IPO markets currently. some people say the volatility is expected to continue through the year. Do you anticipate that becoming a ripe market for acquisitions? And what kind of deals do you anticipate this year?
See, according to me, if you look at India as a whole, and let's look at the stock markets as the proxy for India, and if you were to look at what is the steady long-term, when I say long-term, 15, 20 years, price to earnings that one is looking at for India, it is 20 times. Now, is this something which is an indicator of future? Maybe not. If you want to look at India, you have to look at the growth. And when you look at growth, it is not a 5-year growth. You have to look at a 10, 15-year growth and a sustained growth at that. If you look at it from that perspective, then something like a 20 times is a decent multiple to look at. When you look at the foreign markets, and when people look at India outside in and they say that the Indian markets are overvalued, I think one thing which they do not reckon is the growth opportunity. So that is one side of the story. The other side of the story is also that within India is there a delta, between the public markets and the private markets? There definitely is. There was a larger delta, or probably the delta was similar even last year. It continues even today. 2024 was the year. That's the reason why you had so many IPOs. It was the year of the IPOs and the capital markets. Today, as we stand, the number of IPOs probably are a little more studied than they were, last year. Last year, anything could sell. Today, you have to have a story for it to sell. The delta continues. The opportunity continues. And the good IPOs will definitely go through. The valuation differential will continue, because I think relative to, like I mentioned, relative to how you look at India versus anything else, I think you have, if I were to say that look at India as a starting point, the India story as the starting point, the valuations today seem all right. Probably they seem to be a little volatile within a band, but I think on an overall sustained basis, it looks like a good growth market.
Right.
And also, we should keep in mind that COVID 2020, 21, you see a lot of investments that happened in certain sectors, and in particular in the life sciences space. Now, when you look at that and you look at the life cycle of a fund, you would see many of those funds either consolidating, which is to your first point, or looking at capital markets in some form or the other, or a secondary sale eventually to see an exit. That adds up to what Chandresh is saying, that you could look at the market volatile, but there's something which good companies will always find space in the CM. There was absolute mayhem last year, and we're seeing a little bit of relaxation for M&A guys like us to continue to do something. But from a firm perspective, it's exciting to see that the equity raise has been there, whether on the private equity side, consolidation, or the CM side. Yeah.
Right.
I mean, if you're talking about M&A, I think the last 2 years, actually, M&A volumes were down. And that was offset by robust equity market volumes. If you were to ask me going forward for the next 12 to 18 months, we would expect M&A volumes to be up, because equity markets are clearly a little more volatile. If you're a company looking to raise capital, looking to exit your investments, that volatility isn't necessarily helpful, and M&A does offer people certainty. The reason M&A volumes were low was because the valuation differentials had also expanded a lot between private markets and public markets, which made it very obvious for people to go down the public route. As those valuations have corrected, and of course there's still a differential, but not that meaningful, you would expect to see more M&A activity.
Right. Do you anticipate more inbound activity over the next few years if this valuation differential sort of corrects? Because that was a declining trend over the last few years.
Most definitely, actually. Inbound activity is down to $20 to $25 billion a year, which is a lot lower from the private equity. Sorry, actually close to $50 billion a year. Which is a lot lower than it was at its peak at close to 70 billion, and fundamentally being driven by high valuations. When you think about inbound as well, India trades expensive relative to their home markets. And of course, there's a growth premium, but it's difficult for companies to justify,
Correct.
or even investors to justify that differential when it gets excessive. So that correction is definitely going to help. You know, one thing is quite clear, that there is a lot of dry powder sitting on the sidelines wanting to invest in India. Outside of the US, India is probably the second place most investors want to put money to work. So as these valuations correct, you would definitely see inbound activity increase, chiefly from the financial investor community.
But it does appear that many of these MNCs are taking advantage of the high valuations. They're not buying, but they are probably divesting a lot more. Chandresh, I'm sure you have thoughts on that.
Yeah, I would say that, I mean, if I were to look at inbound, you know, on two vectors, one about, you know, the private equity activity, I think that continues, you know, as Arun is mentioning. If you were to look at, you know, global strategics looking at India, they're looking at India on two counts, and those conversations have increased. I think relative to probably 3 or 4 years where there was an absolute lull, those conversations are increasing. Is it a China plus one? I don't think necessarily so. Is it?
I don't think so necessarily.
Yeah, it's not necessarily. So I think there are a few aspects. One, I think like I mentioned, the fundamental thing is the size of the opportunity that India has to offer. The second thing, they realize that maybe a partnership for their existing business or a new business activity, or, you know, for some of the businesses that they own and, you know, want to introduce in India, getting a good Indian strategic partner is the right way to go and expand. So that is one conversation that one is having. And a third, another meaningful conversation one is having is regarding illuminating the value of their India business. If they have, you know, subsidiaries, or if they have businesses in India where an Indian stock market today is seen as a relatively more mature, resilient, attractive from a returns perspective. So it's something where a listing can also help them. So they are probably looking at listing their Indian subsidiaries, or probably Indian regional assets as such in India, if that is an opportunity.
And what you will see, and if you see the data, the joint ventures went up.
Correct.
The minority investments were up. The buyout was, of course, there are buyout deals, and we as JSA have been involved in many, but you saw joint ventures, which was in some ways things of a little bit of the past. And you saw minority investments. They wanted to make sure what they're putting in the money and then see if they can ratchet themselves up. That picked up in a way to say that, okay, it's a strategic investment, and then we will see. And maybe Amit can talk about it a bit, but we saw that kind of investment. The recent one which JK did is again strategic in some ways and then eventual. So that kind of adds up to what Chandresh just mentioned.
Right.
Yeah, I mean, just to add to what Sid said, one of the recent acquisitions that we're in the process of closing together with JSA is in Jammu Kashmir. It's probably the first acquisition of significance in the state. And I think, you know, again, going back to learnings, and whether it's on the domestic side or the international side, was the need that to succeed going forward, the need for a local partner, right? And considerable amount of time was taken to find the right principles across the table, find that meaningful understanding. You know, when we were talking about valuations is always a function of, obviously there's market value, and then there's expectation.
Correct.
And I think, you know, and then of course the reality of how you close that transaction. And I think, obviously, given what's happened, let's say on the equity market side, particularly over the last 6-8 months, those expectations have come in, right? When you're speaking to principal. So again, you know, what we've done, obviously, as JK Cement in the state is partner together on a joint venture basis on a 60-40, where we have majority control, management control. But we work with the local partner with the view of obviously market expansion, creating a new revenue pool, but also then being the only national cement player present in the state. So we've kind of, you know, we've kind of got a very slightly different strategy compared to the rest of the industry, where we're looking at, you know, uncharted waters, new revenue pools and pockets, which say the national players are not necessarily looking at.
Right.
But again, sort of bridging that valuation expectation to reality, which is considerable.
I want to pause here for a minute and see if we have any audience questions. Okay.
Hello. Hi. Thank you for the engaging discussions. I would love the panel's thoughts on a topic of CVC, which is the corporate venture capital investments. So globally, or specifically in the US, if you see close to or probably over 1/3 of the startup investments typically come in from CVC arms, the big techs, the big pharma. But if you contrast that to India, there have been very few startup investments being done from corporate books, not the family offices. If you leave the obvious names such as InfoEdge or large corporates such as an RIL or HUL or Marico, there would be very few investments there. I mean, Indian corporates as a category seems to be punching below their weight in the startup investments in the domestic startup space. So would love your thoughts on this. I mean, is it a value issue or valuation issue, an innovation issue? Would love to hear your thoughts on that. Thanks.
I'm not sure if y'all are, you...
Can give a sense? I think the biggest thing which comes in the way for corporates to take those bets is their governance.
Yeah, CVC.
Do you really have, the ability or, to really put capital of the corporate, at risk, for things which could probably be adventures, not even venture. Where, you will find instances where it makes strategic sense. You mentioned about Marico, for example, when they looked at the Bombay Shaving Company, they saw that there was a clear opportunity. So it is, after a point in time, it made sense, for them. They would go for it. It's only if it, one makes strategic sense and it's not something which is out of governance. I think when I'm saying governance, it is out of their ambit to really take that bolder call.
I was listening to the other panel at 3 o'clock, and Hari and the other gentleman, they were talking.
Ritesh.
Yes, and it was a very interesting panel, and he said, out of the 10 investments we do, 8 will fall. That's a loss, and they know that out of the 8, which is being, or let me put it, the 10, the 8 is not going to go through. So that's where it happens. But when we started this conversation, we did talk about corporates putting in money in the overseas market, for example, which is an unknown market in many ways, like the Bharti $4 billion investment, Infosys in the R&D space, and Wipro, L&D. So I think it's more focused, in my view, of the sectors that they are expertising themselves in rather than taking that risk capital. For risk capital, I think the family offices are now doing much more. And I think we've seen a lot of family offices doing that, exactly what they couldn't do it from the balance sheet. That's exactly what is happening now. That's my view. I don't know if...
No, and again, it's a good question. Is there a space for corporate venture? Yes. So I think that's really the point. Capabilities are an issue. I mean, we have the same conversation within, say, our organization. And the second is, of course, around governance and risk. How much capital are you willing to risk? Traditional promoters losing, investing in 10, losing 8, and then saying, I put minority investments, I'm used to having majority, I want to control that company. So there's obviously from a business plan corporate philosophy perspective, from a governance and risk perspective, we've still got that bridge to cross. Is there a space? Absolutely. And I think a lot more education needs to be provided in this space to corporates in terms of how do you actually derive value from this in your core business? How much risk can you take? How do you explain that to your existing investors to say, okay, I'm willing to put X amount into a pool and then build those capabilities in-house and the right investment committees and structures. So it's not just the promoter taking a call on a business that they want to invest in, but it's done in a professional manner. So I think there's still a little bit, a way to go in creating those governance structures internally, but is there a space for it? Absolutely. If that makes sense.
Any other questions? Okay, so I also wanted to ask you all about the trend of private equity firms becoming more and more active in the M&A segment. This is a trend. A lot of buyouts are coming up. A lot of firms are setting up platforms where they want to acquire a lot more. How do you see that playing out? And are there white spaces where PE has not touched and there is an opportunity for them to get into?
Actually, when you look at private equity investing in India, it's matured so much. From where they started minority investing to now really wanting to own, control, run companies. When you talk to private equity, the first thing they do before buying a company is have a management team in place. They are effectively India's largest promoters now. And if you look at it from a global perspective, private equity returned capital of close to $25 billion from India last year, which is probably the largest returning pool globally, where they struggled everywhere else. It's one of the bright spots for them globally. And I think every private equity firm is growing in presence here, opening offices here, those who are not, and frankly, will continue to invest. So we would expect that volume to continue to grow. However, they would continue to be disciplined. I think they're focused on the high cash generating sectors. But increasingly, you're seeing private equity, for example, in capital intensive places, infrastructure stands out.
Right.
Private equity investments there are now close to $12 billion a year. Just yesterday, TPG announced the purchase of Siemens Gamesa, which ties in with the MNC exiting theme, and we advise Siemens on that. But that theme will continue. And it's also got to do with increased comfort with India's governance, legal frameworks, contract. As people are getting more familiar, it just gives people much more confidence to keep investing in larger sizes here.
Right. I want to bring Siddharth in on, the legal framework. What is the scope to make it better? Where are the opportunities to make it better so as to, become a better place which attracts capital?
One of the things that always is looked at, whether you look at private equity or you look at foreign investment, even domestic, is corporate governance. The standards of corporate governance is something that even a banker, when they look at investment being, from a domestic company's perspective, raising capital, they will always say the corporate governance standards have to be absolutely top-notch. So that is something which continues to be seen. From when I started my career 25 years back to what I see today, the companies are far more mature. They do understand that they need to be at a certain level to be able to do what they have to do if they want to raise quality funds. The new things which are coming up is like the ESG. We're seeing environmental, social governance issues. Any foreign investor coming in, and when I say foreign investors of quality coming in from global funds, they will always look at ESG standards of Indian companies. What are they doing? Now, let's say they're putting money in mining companies or manufacturing companies. They will see the carbon footprints. They will see certain issues that could have an impact, and these are important factors to be done. Now, what could be done? Well, from an Indian law perspective, I think a lot is already being taken care of. From a point of view of governance, to me, stands as the most critical aspect when we go into a company to do a diligence or acquire a company. Some of those aspects do play an important aspect for us, for an investment point.
I think mostly investors look for consistency.
No retrospective.
Speed. That's it. If you give people consistency and speed, I think mostly people are okay.
One of the things that Blackstone mentioned was that they wanted take private regulations to become smoother or relaxed further. Are there other such hindrances in the framework, M&A framework, that you think if we took care of, it could kind of open new pools of capital? Yeah.
Well, yes, it would. It is, and interestingly, a close private equity friend did reach out, and of course, the team in JSA was quite. And the questions were quite straightforward in the sense of saying, should we do this? Is this something that will go through? And what is your recommendation? And our recommendation was that this will not go through the take private route. Now, there has been amendments, there has been liberalization, but to the extent that it can happen smoothly, the answer is no. Should it happen? Yes. And I'm sure the regulator is going to look at it, but it's not something that we've seen as forthcoming. today. But if the question is, yes, it should be liberalized in whatever way it can to take it private. There's a lot of things which funds want to do, but they can't do it, maybe because of factors like this.
Right. There is a question there. Yes, ma'am. Let's wait for the mic.
Hi, good evening. This is Kiran Srivastav. I'm from Avada Group. Hi, I just had a question to both of you. With all the visions and targets for 2030 and 2070, do you see renewable energy sector as one of the leading sectors to invest for, or M&A, whatever? What is your take on that?
Short answer, yes. I would say that, I mean, we've not even scratched the surface as far as renewables is concerned. And if you look at the foreign investment, probably the certainty of returns that one is looking at from a foreign investor perspective or any investor perspective, and the sheer requirement of, powering a lot of Indian industry on, sustainable energy as such. I think renewables is clearly a big buy in my view, and that will, that's the reason why you also see a number of sponsors actually having their own platforms. It is now going even, backward integrated to manufacturing, panels and wafers as well. So it is something where, the homegrown sector as such, homegrown, home supplied and home use. So it's a lot to be done with enough returns to be made.
Thank you.
You want to add to it, Arun?
No, renewables and broader infrastructure has probably been our most busiest sector and consistently for the last few years. And I think it's going to continue to be that. I think there is a drive in consolidation, and there continues to be also need for more capital. A combination of both of those will continue to drive activity.
Right. That's all we have time for, actually. We will conclude on that note. Thank you very much to the audience again for the lovely questions, and to our panelists, please give them a hand on such a wonderful, insightful conversation. So thanks a lot.
And thank you to Ranjini, and I request you to kindly present a token of our gratitude to all of our panelists. And ladies and gentlemen, stay glued to your seats, because very soon we are moving into a conversation that has been much awaited today. Let's have a big round of applause for our panelists on stage. Thank you for sharing your incredible insights and first-hand experiences. Thank you very much. Fads, they come and they go. But brands that stay, they need resilience, they need reinvention, and a founder who listens. If there's one man who embodies the spirit of Indian entrepreneurship, it is him. He didn't just build a business, he redefined an entire category. At a time where multinationals dominated the FMCG space, he carved out, literally, a homegrown giant with nothing but clarity of vision, relentless innovation, and an uncompromising eye for quality. What started with coconut oil has now become a portfolio that sits very proudly in almost every Indian household. He's not just a chairman of Marico, he is a champion of Indian enterprise. Through the Mariwala Innovation Foundation and his work with Ascent, he has spent the last decade mentoring, backing, and even scaling the next generation of Indian business leaders. Ladies and gentlemen, please join me in welcoming a true architect of enduring businesses, the visionary who turned blue bottles into gold standards, Mr. Harsh Mariwala. Talking to Mr. Mariwala is Sneha Shah, Deputy Editor, Mint.
Thank you, Xenia, for that wonderful introduction. Yeah. Thank you, Mr. Mariwala, for agreeing to do this. We're really privileged to have you here with us today. Who better than you to talk about entrepreneurship and leadership? You've built it through decades. Our audience will richly benefit from your experience and your insights into how lasting businesses are built. So to just dive in first, you've built Marico into a successful, enduring business. What are the core principles that have guided your leadership style?
Thank you, and thank you for calling me to this event. My pleasure. My overall belief in what we call our values, the kind of culture which is required for Marico to succeed, evolved over a period of time. I started at a very young age, and as I went on exploring my journey in meeting different people, I realized that I had a certain leadership style, which I thought was sound and which was required for us to succeed. So, prior to formation of Marico, we had tasted a lot of success whenever we innovated. So innovation was very much on top of my agenda in terms of creating a culture of innovation. So how do you create a culture of innovation was the big challenge. For innovation to happen, you need to have a very open organization where people can talk to each other directly without the organizational hierarchies and boundaries. You need to create trust. And most importantly, you need to have a very good talent, diverse talent, and empower them, because when you empower people, people think that the company belongs to them. So you need to inculcate an ownership mindset. And the biggest challenge for all the owners or entrepreneurs is how do you make each and every person within the organization think like an owner. And I wanted that to happen. So encourage people to move fast, agile. Agility was very important. To take risks, because normally many professionals are afraid of taking risks, because if they take a risk and all the risks are not going to succeed, so you will bound to have failures. And if managements punish those failures, then everybody will stop taking risks. You need to encourage people to take risks, to experiment. And when you do all that, hopefully you create a culture of innovation. And I think that's what I wanted to do. And our organization reflects all these values. Not to say that everything is hunky-dory, but I think we are there quite a lot compared to many other organizations.
Right. And how do you define businesses to last? What is your definition of, building a business that would last well beyond?
So I think first of all, let me say that each and every business is getting disrupted by geopolitical developments, by emergence of technologies, by changing consumer trends. I think the key thing for any business is to evaluate how sound is their business and what is disrupting them. Is that disruption an area of opportunity? Is it a threat? So you can look at it from both angles. So protect your side from the threat side, and also look at it from an opportunistic angle. For example, the D2C brands, which have emerged in the Indian environment in the last 5 years, is definitely a threat to FMCG industry. Because prior to that, all of us thought that we are the most defensive sector. It is very difficult for any new player to build an all-India distribution network. You need big advertising budgets to launch a new product. So again, for a new player, it will be difficult to spend that kind of money. But until the emergence of D2C brands came in, and you required a fraction in terms of marketing costs, you didn't have to go to all the retail outlets. You could do it through e-commerce, and of course the modern retail stores also emerged. So all of a sudden those entry barriers vanished. And we in Marico said that we have to look at it from an opportunity point of view. So if you look at, in the last 3 years, we have acquired 4 D2C brands. We also have our own D2C brands. And I think the way we are going, we would be one of the largest D2C players in the country. And more importantly, the D2C brands which have been funded by all the private equity players or any funds, they have been losing a lot of money. And we feel that we can actually get economies of scale when you combine those 4 brands. We have a definite task of turning around these D2C brands much faster than when they were owned by somebody else. So we see our D2C brands over a period of time giving similar returns as our FMCG brands. So I'm saying that we've turned that disruption into an opportunity and created a new growth engine. So again, going back, what makes a business sustainable, endurance? I would say you need to create strong moats where you need to go on differentiating, not just when you launch your business, but on a perpetual basis. It's a matter of time, others will copy you. So can you go on differentiating on a perpetual basis and stay 2 steps ahead of competition? Because it is very competitive. To launch a Me Too kind of a business, you will not succeed. So depending on the kind of business you are in, it could be pioneering something or innovative or leveraging some technology or something like a service which Domino's did it in terms of number of hours or number of minutes you are delivering pizzas. So I think you have to go on identifying what differentiates, and does that differentiation make sense to the consumer?
Right. Earlier you spoke about a risk-taking ability and allowing your team and the management to make mistakes. I'm sure as a founder, people are married to their ideas, and to see things fail is difficult. How does one really pivot, and how does one plug a leaky bucket?
No, I didn't understand your question. How do you deal with failures? Is that the question?
Yeah, and how soon do you realize that this is failing and
So I think you have to go on. It's a judgment. At some stage you need to decide whether you want to continue doing it or you want to discontinue doing it.
Has there been any such experience?
Yes, I'll give you one. But I think what I want to say is behind every failure there is a learning. And that learning is very important. You can use that learning from that failure to launch something new. And that's what we have done. I'll just give you one example. I can give you multiple examples, but I'll give you an example. We have this brand Saffola, which is good for the heart and good for health. About 10 years back, we saw an opportunity in launching Saffola through the baked snacks route, snacks which are baked. At that time, there were no baked snacks, and I think we were the first pioneers. So I think the idea was good. But I think where we went wrong was, I think with too much of inside-out thinking, where the brand thought that it is healthy, so health comes first and taste comes second. Now for an impulsive category like snacks, taste is the most important thing. So consumers rejected it. It was not that it was not that tasty, but it was not really that great in terms of taste. And people were just not buying because of health. So we had to withdraw that opportunity. It was a big opportunity. But since then, after that, about 5-6 years back, we realized that we can actually sell oats, which is again good for the heart. So we launched plain oats under Saffola brand name. And it got good traction, but we were struggling in terms of market share beyond a certain point. We had to fight competition from brands like Kellogg's, Quaker, and we didn't have any differentiation. So we believe that, and every business I think should believe that, they should do a lot of consumer insighting. You have to go deep into consumers' mind and find out what are the latent needs which the consumer themselves may not know. So in this case, we found out that Indians like savory breakfast. And we said that can we do what Maggie had done to noodles in terms of launching a range of savory oats. So that idea got conceived, and then, of course, that taste part was really haunting us. So we went overboard on taste. And in India, each state has a different taste profile. So we actually profiled the taste preferences for each state. And today also, then we launched the product. So in South, we have a pongal oats and things like that. So that launch has done extremely well. We've created a new category of masala oats. Within the last 5 years or so, it's become a 400 crore category. And we have an 80% market share in that. And because of that, our market share in plain oats also has gone up. So if you combine both these, we are now market leaders. So I'm saying that that failure of taste, we've been able to leverage very well in masala oats.
That's great to know. What is one insight for young entrepreneurs on building businesses that will stand the test of time and live through market ups and downs?
I think the first thing, as I mentioned earlier, was you have to create a very strong right to win. You have to be differentiated in a highly competitive business environment. And that differentiation can come depending on the kind of business you are in. Today, the biggest disruptor, as I said, is technology. So can you use technology to come to a new business model and launch new products? But I think the key thing is develop something different. And most importantly, test it with the consumers, because consumer insighting is very, very important. You can do market research, but market research has a lot of limitations. So I'm advised to all the entrepreneurs that there is no shortcut to actually launching that product in a marketplace. And what we try and advocate is that you prototype that product in a small market. You treat that as a live market research. And when you prototype, you define action standards, you see the response. In case of a consumer products, you look at the brand, packaging, pricing, the product itself, and go on fine-tuning that in your prototype phase, and go on changing if need be. And once you achieve that action standards, you can roll it out. So again, creating strong right to win the first. The second is talent and culture. For any organization to grow, you need to have good talent. You need to have the best of talent, actually. And I always have a principle that that person, and from the time I started, that person should be better than me in that particular functional area, Because if that person is good, then you are empowering that person, because he would do a better job than you. And to that extent, you have more free time. You have very good talent. They also feel good. But you have to attract talent and you have to retain talent. For retention of talent, you need to have very, very strong culture, which will help retain talent. People should enjoy working in the organization. And then finally, I think for any entrepreneur, irrespective of size, governance plays a very important role, because we've seen many lovely businesses getting destroyed because they have taken shortcuts in the area of governance. And if they start taking shortcuts, it will hit them at some stage and it will put them back by many, many years.
No, actually, that brings me to the next question on how does one maintain that fine balance between need to show short-term performance over the need to invest behind long-term ideas.
So I think this is more relevant for publicly listed companies, because your quarterly results are looked at by the analysts. And ideally speaking, you should be able to balance short-term and long-term. You need to identify the levers, which, if there is a pressure, say, on profitability in short-term, what are the levers you will use to show at least a decent short-term performance? But I am a strong believer in long-term. If you think that you have a long-term bet, which will require some sacrifice in the short term, it is better to pursue that, but after taking all the investors into confidence. You don't bring a negative surprise. You tell them this is something which we are looking at. It's a big bet we are pursuing, and the short term we may suffer, but long term, it will result in a far better future for the company. And if you take them into confidence, then I think they will accept it. So I would say that go for long term. Try to manage short term, and if you're not able to manage, please tell all your investors that this is what you're going through in advance, not spring a surprise after the results are announced.
All the incumbents, the first generation businesses, consumer businesses that got built, were very late to the D2C party, but Marico got onto it pretty early. You saw the emergence of the D2C. What was that one insight that, led to this?
No, we were very clear that we have to participate in this. This is a disruption which will continue. It will grow. And the only way we'll know about what will happen to D2C businesses is to actively be a part of that. At the same time, we saw a lot of opportunities in terms of acquisitions. And I think we are the most aggressive acquirer amongst FMCG companies. We acquired 4 brands. And today, I think our D2C business would be the largest amongst all the FMCG companies. And separately, I'm saying, apart from FMCG companies, some bigger D2C players, we see them competing and taking them on over a period of time. But that's been a good strategy. But the key learning was the culture required to manage a D2C business is very, very different than a traditional FMCG business. So you need to house that D2C business in a different environment, a different set of people, more younger, because they understand digital far better than all of us. And that's what we have done. You keep them separately, let them manage it at a different location, office location, and I think that's worked out wonderfully well.
You've been a champion of corporate governance. You've spoken enough on how, you have emphasized on the need for good corporate governance. If you can share, 3 key points which companies should adopt to ensure that good governance practices are in place.
I think it's very important that organizations look at governance. There is pressure from all the stakeholders. You see advisories, you see capital markets, you see even the board of directors. Even new employees, they are looking to join an organization which is high on governance. They don't want to join an organization which starts taking shortcuts and vulnerable to risks. So I think there has to be very, very high emphasis on governance. But to governance is beyond compliances. Compliance is a very basic part of governance. Yes, you have to be on the right side of laws in terms of whatever you're doing, but can you do much, much more? And these areas would be even things like code of conduct, posh areas. To me, these are all broader aspects of governance. What is the awareness you're creating within the organization to ensure that people behave in the right way? How do you create a culture where you accept minorities, diverse people, even communities like LGBTQ communities, accepted in the organization? Because many organizations, they don't treat them well and make a lot of fun, which is not good at all. So I think it's very important to create the right culture where you pay attention to all these. And the third point I want to say is that there is always a conflict between an organization's interest and any other stakeholder's interest. In my case, I stepped down much before I thought I would step down because we thought it is good for the organization. So the organization's interest comes first. I also had my son, and normally in the Indian hierarchy families, it is understood that your children will follow you. But in this case, I deviated from that. I put a professional. And I think that's worked out very well. And even in terms of employees, many entrepreneurs feel that some employee who has been very good in terms of their performance to the organization, very loyal, we should reward loyalty. But my answer has always been that if that person is not performing, especially at the senior levels, it's better to ask that person to go because it is not in the organization's interest to reward loyalty, especially at senior levels.
Right. So what are the metrics or indicators do you use to measure the success of sustainability?
So I think different metrics I think basically you're saying we have financial metrics, which is normal. I'm not getting into the basics like ROC, growth, EBITDA and whatnot. And then you have market metrics, which is the market share, penetration levels, consumer views, engagement levels and things like that. And then you have people metrics in terms of the engagement level of your employees, attrition, regrettable attrition. And finally on sustainability, what are the metrics? So I think on that sustainability, depending on the kind of business you are in our case, we have to look at what is the emissions you are giving in terms of environment, and are you water neutral? So in terms of packaging also, to what extent is your packaging recyclable? So we have identified these 3-4 things, and we go on measuring them.
How do you think about legacy? And, generally business leaders like you have an opinion on how one would leave a legacy behind. So how do you think about legacy and the impact you want to leave on the society and the business?
So I think legacy depends a lot on the mindset of promoters, There are promoters who would say that, okay, I want to encash because after me there is nobody else, or my son or my children are not interested. So let me encash. So I think a lot depends on the mindset of the promoters. If the mindset of the promoter is to create a legacy, to create perpetuity within the organization, then one can take steps. Again, depending on the kind of business one is in. If you are in a defensive business like FMCG, and you've seen globally, not only in India, but globally, companies like Levers, Procter & Gamble, L'Oreal, these are all family managed companies, but they've survived over a period of 200-300 years because these are defensive businesses. But if your business is vulnerable to disruptions, then you may have that legacy in your mind, but unless you are able to manage those disruptions, you may just get wiped out. So I would say that if you decide to create perpetuity, and that's something which I believe that we should be doing, and we do it in Marico, you need to have a strong set of values and culture. You need to have a strategy document which is reviewed every year, and you have to have a purpose of the organization. And the board will play a very important role in monitoring these 3 things. So you need to have a very effective board, and then you need to have a very strong talent pool in terms of succession planning. And it is the role of the board to appoint capable successors, starting at the top and maybe 1 or 2 levels lower. But we've seen organizations in US especially where the board has appointed wrong CEOs. A company like HP, they had, I think, 3 or 4 CEOs, and the companies completely got destroyed. We also have seen at the same time Apple, which the board decided to bring back Steve Jobs after he left. And you saw the impact it created on the future of Apple, So I'm saying that the board will play a very, very important role.
Right. Through the Marico Innovation Foundation, you have been backing really innovative ideas. Which are the 3 sunrise sectors that Mr. Mariwala is really excited about?
I think innovation will, in my opinion, innovation is a great way to leapfrog India's challenges. India's challenges in education, in healthcare, and agriculture. So can we leapfrog through technology, through innovations? Because what happened in case of mobile or telephones, we were able to leapfrog completely, and I don't know what is the percentage of GDP added by the mobile sector, but it's substantially, I would say. But can we leapfrog through technology and innovation, especially in these 3 areas where there is a big need? And on top of that, I think ultimately it is the entrepreneurs who will drive India's growth story. No amount of government will give support, of course, in terms of creating infrastructure, education, healthcare, but I think ultimately a lot is dependent on the entrepreneurs to identify opportunities and drive economic growth.
Right. With that, we'll open the floor for some questions from the audience. I'm sure they would want to hear it from you first. And the gentleman over there, can we get a mic to him?
Sir, this is Prashant Fernandez. Thank you for a very insightful session. So I'd just like to understand a couple of things from you. So firstly, now we are seeing a lot of newer brands which are not as big a brand as maybe Marico. They are gaining a lot of traction in the FMCG space. So just to understand, how is it that they are gaining so much traction even though they are not such big brands, they don't advertise so much, but then we see them still getting a good market share. And secondly, how would you continuing differentiating your brand from these newer brands, especially the smaller brands, not so established brands?
So I don't know which brands you're looking, I think referring to, but especially in foods, I think we've seen a lot of them. I'm not talking of D2C brand now, I'm talking of traditional FMCG brand. I think that's what you're referring to. I think in food, there are a lot of regional brands which have come in. And a brand like Haldiram, which has become national player and valued at something like, I think, $10 billion is something else. But we've seen in foods, regional brands, whether it's snacks or wafers or whatever else, they've emerged. Luckily we have not got impacted, because if you look at our portfolio of products, in the segment we are in, we are dominating market share. And normally when you have dominant market share, and for all our brands, we have most cases more than 50% market share. If you have a strong market share, you are less vulnerable to competition. When the competition comes in, it will impact the weaker brands first and not a strong brand, because that's where the shift will happen. Not to say that we should completely ignore. But if you ask me, are there any brands which have threatened Marico in the last, newer brands which have threatened Marico in the last few years? I would say, I would find it very difficult to identify one or two, except in serums there are some brands like Streaks and one or two others, but nothing beyond that, because we have a strong market leadership position. And the new brands have emerged more in foods rather than in personal products.
Okay. Anyone else? Yeah.
Thank you so much, sir, for the insightful session. So you have already mentioned that you pioneered the baked food category, but it didn't work or survived. So you had to introduce different products based on the taste and flavors. But now there are a lot of D2C brands which are actually evolving and unjunking the entire category with the baked foods, with the healthy options. So why are you not entering or like thinking on that direction of like going or...
So we have acquired two food brands which are doing very well. One of them is Plix, which is more into nutraceuticals. It's doing extremely well. I think it will touch 1,000 crore turnover next year. I think so. I don't have the exact number, but... And then we have True Elements, which is also in healthy foods. So we have acquired two brands. In addition to that, we also have launched our own foods, which is apart from oats, we have launched our muesli. We have launched a whole range of, because under the brand name Saffola, it has to stand for health. We can't launch something which is unhealthy, because we are leveraging our brand, and the brand has a certain, it is associated with something else, which is like health. So it has to be healthy for us. To go into mass category of foods is very, very competitive, and again, the differentiation is not there. So we believe in going into categories where we can differentiate ourselves.
Thank you so much.
The last question before we wrap up.
I'm Naresh Thakwani, and sir, a very deep, insightful session. And I wanted to ask about, you talked about the values and the culture. I wanted to ask about the purpose. So I read about the history that you had a big, biggest oil refinery, and from there you pivoted to these D2C brands. So and you had this family business. So I wanted to ask, like, during that time, how did you reinvent yourself and found your purpose? Because I think that mindset, from there, I think the trajectory changed completely in your life. And what was going through during that period in mindset, and from there, things started changing.
So I think, in my opinion, every entrepreneur's journey evolves over a period of time. In the initial stages, you start a business thinking that, yes, you're on the right track. And then, because of changes in your environment, because of opportunities thrown to you, you have to go on pivoting to some other areas. I think if you ask me what am I going to do when I started Marico, will I do all this? I would not have thought so. Even the D2C brands, which came in 5 years back, nobody anticipated D2C brands to come in, and that we would be acquiring them and it would be a big growth engine for us. So I think all I'm saying is that broadly, I was very clear that we would be in consumer-facing businesses, in branded consumer-facing businesses, which were on the lap for health and wellness. So these are the two areas, health, wellness, and beauty. So our business has been more focused in this area, and whatever we saw an opportunity. So whether it is increasing market size or increased market share, or going into international markets, or going to related categories where we saw an opportunity, is I think it is evolved over a period of time. And I think many entrepreneurs, I don't think every entrepreneur, when they start a business, has a complete vision in terms of what they will do over the next 10 years. It is continuously evolving, and that's how it should be, because it's very difficult to anticipate what environmental will be there over the next 5 or 10 years.
I have actually a connected question. If you had to start all over again, what is that one thing you would do differently?
So I think each of us is born with a God-given gift, certain strengths, and most of us don't know what our strengths are. So my advice to most entrepreneurs is that please identify what you're good at and try and leverage or start a business which is based on your strength. Now, my strength, if you ask me, is to look at consumer trends. I'm very passionate about health. So if I had to start something, I would do something on those lines. And of course, in today's world, one would have to leverage technology. But I'm very bad at, for example, any regulatory issues. People get shocked when I tell them I have hardly been to Delhi in government offices. Because luckily our sector has been the most deregulated sector. And that suits me wonderfully well, because I cannot pamper and sit down with bureaucrats or ministers. So I think you have to choose. What I'm trying to say is you have to choose something which you're good at. And I think luckily I was able to identify what made sense for me. And I think it's worked out well.
And one failure that...
multiple failures. I can talk of not 10 failures, but I don't know how much... I talked about the failure of the baked snacks,
Learning from failures.
Yeah, so I just covered that,
Yeah. Any more questions? I think with that, I have one last question. There are founders who are struggling with the founder's journey is very lonely. Either it's spirituality that drives them, or there are people around them who help them as a sounding board. What was that one driving point for you?
No, I think I have a very good equation with all my people who work with me. So many times they say it's lonely at the top, but I discuss my innermost dilemmas with my team and get their views. Even when we were going through family separation, business separation, my team knew completely what was happening. So when you are able to share, and many times just sharing itself is a big relief, you get their views. And of course, I'm a part of some other groups where you can share your issues. So it's a real issue with most entrepreneurs. It's lonely at the top. But I think you find the right type of people you can talk to. Many times at home, your spouse may not understand. So you need to find the right type of people who will be able to put themselves into your shoes and say what are the issues and how would they have dealt with that issue if they were you. In spite of that, I think you need to know how to manage stress. So my way of managing stress is to exercise, but somebody else may want to listen to music, somebody else may want to walk, But I think that will differ with each individual.
And spirituality?
I think I believe in doing the right things. And I don't go to temples. I don't go to temples at all. I don't believe in going to temples. But I believe that there is a God. And I don't need to go to temples. The God is within me. I have to do the right things, the right principles, the right way of making an impact, making a difference to others. To me, that's spirituality.
Right. How important it is to mentor the next generation. You said that you made a conscious decision of separating the family from the business, and it was very early on that you brought in a professional management. But mentoring the next generation, how important that is.
So not necessarily next generation, but mentoring itself. I'm passionate about it. In a month, I must be doing at least 10 mentorship sessions a month. And these are entrepreneurs where I'm a part of some advisory funds. My son has invested in many companies, so I mentor those companies. I run a philanthropic organization by the name of Ascent, which has entrepreneurs part of it. So on an average, about 8 to 10 mentoring sessions I do. But I think most of them, there is a certain common pattern. And most of them are similar set of issues. Of course, there is domain knowledge complications, but issues are mainly to do with if your family manage, how to manage family. If you are a professionally managed, then how do you attract talent? How do you retain talent? And then how do you raise funds? How do you stay 2 steps ahead of competition? I think these are the normal set of questions which come to me through the mentoring.
And since we have you here, we can't but talk about family offices. We have seen family offices have emerged as a driving force when it comes to the...
I think you should ask that question to Uday Kotak. Yes. He's written an article on family offices, but maybe I'll give my views. I think it's very important for the family elders to create the right culture within the family. Culture amongst youngsters, to inculcate those values about business, which means that at dinner table conversations when they may not be that old, but they are listening to that. It means that taking youngsters to factories, to marketplaces, and I do that with my grandchildren, So just to inculcate and just bring that sense. I think the second thing is the family has to ensure that just because you are born in a business family, you don't have an entitlement mindset in terms of ensuring that you will automatically go into a leadership role in the business. That you will be allowed a certain lifestyle. Of course, a certain basic lifestyle is understandable, but I believe that simplicity is required for the youngsters to grow up. You can't give them everything on a platter. And they have to put in that hard work to make themselves succeed. And the third point I want to make is, I've seen many youngsters not joining their business. But family office to me is just not investing in capital markets. It's doing much more than that. It is investing in unlisted companies, helping them scale up. It could be tax management, it could be philanthropy. So depending on how you're handling family office is crucial.
Right. And what is that one advice for family offices? Because you've successfully built one. You've seen at least a couple of cycles of exit
clarity.
and money.
In our case, we were very clear that we will only be investing in consumer-facing businesses because that's what we understand. I can't invest in that. Those are the kind of companies we will go on supporting. We will mentor them. And that's what we understand. So we are very clear that we will, about 50% of investments go into unlisted companies, but most of them consumer facing.
Right. I think with that, we had a very exhaustive session. Mr. Mariwala is a textbook in building businesses that last, governing them with the best practices. So let's have a huge round of applause for Mr. Harsh Mariwala. Thank you so much, sir, for taking time and speaking to us.
Thank you so much, Sneha. Mr. Mariwala, so I'm going to request you to please stay with me on stage. And ladies and gentlemen, it is time to applaud the torchbearers, those who didn't just participate in the India growth story, but they wrote defining chapters in it. Mr. Mariwala, sir, I request you to kindly accept this as a token of our gratitude. Thank you so much for being here, for spending the last few minutes talking to us. And I'm going to request you to please stay with me on the dais as I invite Mr. Samir Singh, Group CEO, HD Media Limited. It's time for us to open the Mint India Investment Awards tonight, which look at a very wide variety of deals, including private equity, venture capital, and digital deals. We look at the biggest deals of the year, and we presented them to a very eminent jury, namely Pramod Kumar, CEO and Head of Investment Banking, Barclays India. On the jury, we also had Mr. Sanjeev Bigchandani, Promoter and Vice Chairman, Info Edge Limited, who was joined by Gopal Srinivasan, Chairman and Managing Director of TVS Capital. And tonight, we announce the winners of the Mint India Investment Awards. We begin with our first category of award, which is titled PE, Investment Deal of the Year. And ladies and gentlemen, I am expecting nothing but a thunderous round of applause. The award goes to Brookfield Investment in ATC. May I invite Pooja Agarwal, Managing Director, Head of Portfolio Management for India and Middle East, Brookfield. Round of applause for Brookfield Investment in ADC. Many congratulations, Pooja. And it's time to announce the next Mint India Investment Award, which is PE Exit Deal of the Year. Ladies and gentlemen, the award tonight goes to Kedara Capital Partners Group Part Exit from Vishal Megamart. From Kedara, we have Nishant Sharma, Sunish Sharma, Manish Kejriwal, Ashwit Mahajan, Anant Gupta, and from the Partners Group, we have Murli Krishna Nair and Shivam Tulsian. All the winners, please stay in the room. Pleasure. Congratulations, sir. And it's time to announce the next Mint India Investment Award, which is Digital Deal of the Year. Ladies and gentlemen, the award tonight goes to Zepto $1 billion capital raise. I'd like to invite Ajinkya Jadhav, Head of IR, Zepto. Let's hear it for our winners of the Digital Deal of the Year Award. Many congratulations, Ajinkya. If there were a Hall of Fame for India's financial visionaries, his name would be etched in gold. It would actually be the cornerstone as well. Tonight, we honor him with a Lifetime Achievement Award, and we don't just celebrate the years, we celebrate the impact. Let me show you who I'm talking about. Meet Uday Kotak, one of India's most successful bankers. An entrepreneur who bootstrapped a financial startup with an initial capital of just rupees 30 lakhs to build a financial empire worth around rupees 6 trillion. Born in 1959 in Mumbai, Uday Kotak grew up in a business family of cotton traders. On completing his college, Kotak was sure he didn't want to join the family business. In 1985, Kotak founded Kotak Capital Management Finance Limited, which started as a bill discounting and leasing business. In 1986, Mahindra invested rupees 1 lakh in Kotak's company, which was later renamed Kotak Mahindra Finance. Kotak sensed the needs of the consumer from the beginning. In 1991, he entered the investment banking business. Kotak Mahindra Finance became the first non-banking finance company to get a banking license. His past success with global financial firms laid the grounds for India's largest merger in the banking sector. In 2015, Kotak bought ING Vysya Bank and became the fourth largest bank with a pan-India presence. When Uday Kotak stepped down as CEO and Managing Director of Kotak Mahindra Bank, Anand Mahindra tweeted, Uday's simply starting a new chapter of impact on the Indian financial services industry. This chapter continues, with Kotak now taking on the role of an investor, mentor, and philanthropist. Kotak's achievements have earned him numerous awards, including the Padma Shri. Kotak's legacy extends beyond banking, inspiring future generations of entrepreneurs and leaders. Let's welcome on stage a true trailblazer, a nation builder, the founding force, founder and director, Kotak Mahindra Bank, Mr. Uday Kotak, recipient of the Mint India Investment Lifetime Achievement Award this year. Mr. Kotak, many congratulations. Sir, please stay with me on stage for a couple of more seconds. Mr. Mariwala, if you could please stay with me on stage for a few more seconds. Inviting all the winners quickly, if you could join us on stage for a group photograph. Let's capture this moment and freeze it in time. All winners, please join us on stage. At the winners of the Mint India Investment Awards tonight. Many, many, many congratulations to all of you and your incredible teams. Mr. Mariwala, Mr. Samir Singh, thank you so much for doing the honors. Thank you, sir. Well, we are inching to the grand finale. Actually, we are there because some build companies, others build categories. And so it's time for us to have a rare, intimate conversation with one of India's most visionary financial minds. In conversation with him will be Ravi Krishnan, Editor-in-Chief, Mint. In just a few seconds, we'll be inviting him on stage. I hope Ravi's saved some time for an audience Q&A. Ravi, is that going to happen? Maybe. Okay, thank you. All right. Almost there. Okay, let's prepare to welcome on stage once again winner of the Lifetime Achievement Award this evening, founder and director, Kotak Mahindra Bank. Please put your hands together for Mr. Uday Kotak and Ravi Krishnan, Editor-in-Chief, Mint.
So, Mr. Kotak, as I don't think our short video adequately captured the impact which you have had on the Indian banking system, let me start by asking you, what advice would you give to the young entrepreneurs and business leaders who are in the audience, people who are aspiring to be the next Uday Kotak?
Go for it.
And keep in mind that go with a positive approach. Also keep in mind for any entrepreneur, do not calculate the probability of success or failure. If you do that, you will never get into it. The probability is very low. But if you succeed, the upside is huge. And even if you don't, in today's world, the value of somebody who's had the courage and conviction to start something is very valuable for any company to consider as an outstanding resource for that company. Therefore, either ways, you will win, okay? So I really would advise that people should take their chances. This is an India which is far more confident, self-assured than the India we grew up. And that's the big difference today.
But wouldn't one say that the challenges are also more today, even though the opportunities have also multiplied?
Of course, but there are, yeah, of course. A lot of Indian businesses in the last 30 or 40 years essentially were built on arbitrage. I think the world of arbitrage is gone. We are now into a world where you really have to do defining stuff which anticipates consumer needs, customer needs, finds opportunities which on the face of it do not exist. And I compare it with my times. In our times, the differences were much more easy to observe. For example, if you had a world where banks used to take deposits at 6% and the lending rate was 17%, it was an obvious opportunity. Today's opportunities are not so easy, not so obvious. Therefore, I think it's clearly a tougher time. But the fact of the matter is that today capital is much more easily available. And today, a failure of a startup is not looked down upon. In our times, if you failed in your business, wow, it's over.
But on the flip side, right now, I mean, when you look at many startups, they expected to be rewarded even if they are not on the path to profitability.
They're expected
to be rewarded even if they are not on the path to profitability.
I think you really have to look at what is the visibility over time. And you have to look at unit economics very closely. Okay? Therefore, you may not be making money because you're expanding fast, but at every stage, please look at the unit economics. I think the answer is in unit economics, at least on a marginal basis. So look at that, and not necessarily on a full cost basis, and see how you will pan out over a period of time. And as you go down that path, you'll find new variations of opportunity, and you should be capturing that along the way.
How do you approach leadership, and what qualities you think are needed in today's fast-paced business world?
Be paranoid. And I don't know whether Harsh is around. Harsh, I agreed with everything you said. Maybe it's true for foods. But I just give you one example today. You just have to look at Nike and On. A year ago, there was no question about, maybe a year and a half ago, there was no question about Nike being the defensive play in sportswear. And there you see an On coming from nowhere. And Nike has lost, what, 30, 40, 50% market share in about a year to a newcomer. So you have to be clear, irrespective of whatever field you are, however comfortable you are as a player, there is someone out there wanting to eat your lunch. And make sure that you are on top of your game. And you are also innovating, not only to defend your lunch, but to eat somebody else's dinner.
When you reflect on your journey, setting up Kotak Bank, you have navigated numerous challenges. I mean, there were, regulatory changes, industry disruptions, economic downturns, etc. When you reflect upon those, what are the key lessons that you learned, and how have they shaped your approach to business now?
I think financial services, when we started, was a hugely fun business. There was a certain sense of joy. You could, build out things. There was room, there was leeway, there was ability to grow fast We were in an evolutionary phase of regulation as well. You had new industry starting, new banking licenses which came in, asset management opened up, insurance opened up. So the regulatory system was also very different. And then as we moved forward, the regulatory system evolved on the lines of the Western world. And Western world went through a series of crises, and that's why we just saw some of it actually get effectively imported into the Indian financial system. And of course, this consumer centricity was something which was needed, and that I think is right from a regulatory point of view to get a lot more customer focused. However, I do believe that one of the things about leadership and growth in a business is also depending on the industry structure. Financial services had a very different industry structure. We were also fortunate to have a very large presence of the public sector. So that made our lives relatively easier also. So whenever you look at success, you also got to look at things which worked for you, which may not be necessarily the cards each of you may have as you go into the future. So we were lucky about that. But at the end of the day, what worked for us is a deep commitment to trust, to make sure that every stage we earn the trust of stakeholders, customers, investors. And it has to be natural. And the most powerful way of earning trust is not by what others tell about you. It's about by you looking at yourself in the mirror. Because there's no better truth than you in front of your own mirror. Okay? Keep that in mind for each of the entrepreneurs, that governance and trust come not from what others say how good you are, but what you know is the truth.
So if I may ask, what has sucked the joy out of financial services? Is it excessive regulation?
No, I think, let me put it this way. It's become a game which requires more regulation, because I think we've also had bad actors. So we cannot rule out the fact that this industry continues to have bad actors. And as we speak today, we've had challenges even now. So we've had a whole series of challenges between 2011 and 2020. But in the last 3 months, we have had 3 incidents. One with a housing finance company, one with a cooperative bank, and one with a private bank. So the nature of the industry is also very susceptible. And it goes back to a very famous statement by one of the most famous robber barons in the US. He only used to rob banks. So he was asked, why do you rob only banks? So he answered, what a silly question. That's where the money is. So it is other people's money. It's not your own money. Very little of your own money. Therefore, enormous amount of responsibility. And one of the ways to succeed in financial services is also by keeping in mind that if you build a trust and ethicality and values, that actually pays you.
So as a major stakeholder in a large bank, what keeps you awake at night?
I think what keeps me awake at night is how do we ensure people's trust, investors, customers, stakeholders, how is it that the firm continues to govern itself well, follow what is right for all stakeholders, how is it that sharp practices do not evolve in any institution, and how do we keep on finding new ways of growth, because I don't think growth is a given. I think it's a challenging industry, financial sector, and you have to constantly think about it. And therefore, as a board member, my focus is much more on strategy and governance. And that is the 2 areas where I think I would be sort of very focused on.
Right. You mentioned just a little while earlier about how when you started, it was all about arbitrage, deposits at 6% and lending at 17%. Yesterday you tweeted that deposits at 8% and at 9% and lending at 8.5%. So what are your current thoughts on the state of the banking sector? How do you see it evolving?
See, what I'm beginning to find in the banking sector in general is much more short-termism. what the banking sector truly requires is a mindset of continuity and perpetuity. And here I think the challenge also is the leadership must have a sense of long-termism. And in many institutions, that is beginning to become a challenge. Therefore, there is an excessive focus of, for example, in banks, and I'm not naming any bank, in banks, how will my balance sheet look on 31st of March? How much lipstick should be there on that, okay? And if that is the mindset which is excessively short-term, partly driven by the marketplace as well, which I don't agree, and I really liked Harsh Mariwala's statement that go out and build trust of investors, tell the truth. If there's an issue, share it in advance rather than package it. And that is extremely important. And one of the things which worries me about financial services is excessive short-termism in leadership at most institutions.
But isn't that the bane of a listed company CEO, that every quarter, you have to handle investors? I mean, how do you balance, those aspirations?
I think in the case of banking, it's a little more complicated. Yes, of course, it's also clearly about listed companies, but it's also about the fact that the whole-time directors have tenures of 3 years, and then they have to be renewed and approved by the board and the regulators. So there is always a concern in the minds of the leadership. Am I going to get a next term? Am I going to get the full next term? Is it going to be part of the term? And rightly so, the regulator also has a point of view, that because it's a highly leveraged industry, therefore I don't disagree with it, but it does bring in a mindset which is more short-term.
How do you think, policies and regulations will impact the banking industry? Because if you looked at the economic survey, you looked at the budget, there is this whole talk of deregulation which is in the air. And from a banking industry point of view, what are your thoughts?
I think banking industry needs a mix of entrepreneurship and regulation. And entrepreneurship does not mean giving away professionalism. I genuinely believe the most powerful phrase in banking, finance, and management is professional entrepreneurship. Any entrepreneur who cannot embrace professionalism will have trouble. And any professional who does not embrace entrepreneurship will find a limit to his or her growth. Therefore, a professional entrepreneur is the way for the future.
In terms of deregulation?
I think in terms of deregulation, I think we can do with some of it, with checks and balances and guardrails. And the way probably we need to do is, how do we encourage innovation? One of the challenges is, if you look at the financial services landscape, it is banking, it's capital markets, it's insurance, it's NBFCs, it's asset management, a whole range of financial intermediation processes. You have the process which is the borrower and saver, that is a saver-borrower process. You have a process which is investor and issuer. The way we are regulated today, we are compartmentalized. And the way the saver looks at it, the saver looks at it horizontally. You may be putting money in a deposit, but you're also a mutual fund investor, you're buying insurance. But the regulator is looking at his or her respective vertical. How do we get a holistic view of financial intermediation from the lens of a customer?
So do you think there is a need for a super regulator, maybe like the Monetary Authority of Singapore?
No, I think we already have a mechanism that can sort of be made better, and that's what the finance minister alluded to, which is the Financial Sector Development Council. That should be made more cohesive, powerful, and really focusing on how do we look at the financial sector across the curve. So we already have a mechanism of FSDC. How do you give teeth to it?
How do you see your role evolving as a non-executive director at Kotak Mahindra Bank, and what is the guidance that you will offer to the new leadership team?
So as I mentioned, my view on my role is pretty clear. I'm very focused on governance and strategy. And I'm extremely focused on ensuring that at every stage, we, the bank and the financial institution continues to build trust of investors, savers, stakeholders. That, I think, is a role for me. And the fact of the matter is, one is I'm on the board. Second is we continue to be 26% shareholders. And third is we see our name on the board, and that matters the most to us.
Right. Mr. Kotak, roughly 3 months ago, when the Mint team last had a chat with you, that time you had mentioned that, you were pretty confident about India's prospects, and the only thing you were kind of concerned about was a global scenario on the external front. Now, looking at the events that have transpired, in the last 90 days or so, has your view changed?
I think we have seen the change happen in the US in the interim, and we have seen the US play out over the last 2 months, and we're going to see some big announcements on April 2. The thing which I think, first of all, India continues, I think India seems to be able to navigate the change, and I hope reasonably. We have a trade surplus with the US, which is $46 billion trade surplus. We should be able to navigate something. Even if we lose some of it, we will substitute it with some other country, and maybe some net trade loss which may happen in this trade war. Second, I think on investment flows. However, if I was sitting in the US and thinking about it from a US point of view, the US should be very worried about the unintended consequences of its actions. And if you take an aggressive position with the rest of the world, which US has, and probably it will be more acquisitive, including on geography, you also have to be clear, back to the first principle, the country which is the most trusted for your savings across the world is the United States of America. Every sovereign nation in the world puts their surplus significantly in US treasuries. What happens if there is a little wrinkle in that confidence? What happens if some of the monies of the sovereigns move away from the United States to a Eurozone or gold or something else? What is the implication for the United States, including the funding of its treasury? What I call as the rule of unintended consequence. So that is one thing I would certainly watch closely. The second thing is, which is coming out very strongly, is each country to itself. And Europe is realizing it. They've got to spend a lot of more money on defense. I think India has to recognize it. And on defense, there are two issues. One is, of course, you have to increase the spend as a percentage of GDP. Therefore, India will have to spend a lot more. The second is, if you're buying it from a third country rather than making it yourself, that third country may be your ally today, but may not be an ally tomorrow. They may switch sides. How are you safe on your defense in an electronic digital world with a third country where the relationship is becoming a lot more transactional? Therefore, true Atmanirbharta has to be for India to spend more on defense and build it in India. And I would love to see a lot more. That is getting pretty clear. I think we are moving into a world which is significantly more transactional.
Do you think there are also opportunities for India in such a world?
The biggest opportunities and risks are at turning points in history. I think we are getting to one such turning point. But it's both ways. Many businesses which don't exist may become huge. Many stable businesses may get shaken as well. And on one of these discontinuities, we are all seeing the discontinuity of AI. Okay? And I think that is going to play out over the next 3 to 5 years pretty dramatically. And what does it do? We don't even understand all the consequences today. But it's going to change the way we live. And what are the things which will change? What are the things which may not change? And people who can be a good judge of that can really flourish in the future.
So if you want to bet on businesses which will make it big at this turning point, what would those be?
I think businesses which, first, I believe businesses which continue to have the human aspect. Therefore, I think things like music, things like, you may say that, okay, music can be made on AI, but people will still want to watch a music performance in person. Or actual sport of human beings participating. Like chess has proved that the machine is better than man or humans. But people still like to see human chess. So there is some areas which will be protected. But there are lots of areas which will be wiped out.
Such as?
So, say for example, why do you need bookkeeping? Design. I mean, there are so many design studios. You can make a full movie through AI. So how that will play out? On the other hand, think about a big movie star. You can change and make him look young. Therefore, the life of a movie star may actually go up. His screen life may go up. So things will dramatically change and people may accept a Shah Rukh Khan at 30. Therefore, if somebody bought lifetime rights to a movie star and does a significant amount of playing around with that, it may be something which the audience may accept. I'm not saying the audience will or not, but I'm just throwing ideas of what can happen. Suddenly he looks younger. The whole area of health, these anti-obesity medication is dramatically changing life, behavior. How are you going to look? How are you going to be? What will it change our approach? So lots of changes happening. You've got to be laser focused on where the opportunity is and make the change. I also believe one thing will happen, which is a very big risk. And that risk, which I believe is, I think we are moving to a world where more and more the chances of moving towards universal basic income is a very strong possibility. Every citizen will expect a minimum right to live. And the state will have to ensure that at some point of time. And you can already see that happen in front of our lives. The challenges which you face, or the political parties face at election time, promising something after they come back, before and after. These are all signs that you need to ensure minimum level for each person. I think it will become a part of the fisc. But if it does become a part of the fisc, how do you fund it? How do you finance it? How do you ensure your priorities? How do you tax? How do you collect your revenues? At a time when also you're going to spend a lot more on defense. So the whole game is changing. I think we are at a turning point of history. Okay? And this is the time, this is a time almost like post-World War II we are coming to.
But can a country at this stage of development, like India is, and given all the other problems we have, even if you were to have something like universal basic income, I mean, how far away do you think it is?
I think India can't afford it today fiscally. But you will find no choice. You know, each of the economists keep on complaining, oh, you're giving too many doles, you're becoming very populist. But a politician has to win elections. Therefore, if we want democracy to sustain, directly or indirectly, this will happen.
Shifting tack slightly now, you had earlier, lamented the fact that there is a lack of Indian global brands. What do you think is holding back Indian companies?
I think you had a speaker before me who could have given you an answer better to that. But I would love to see Parachute coconut oil thriving in the United States of America. I would love to see a Saffola be the brand in Europe. But we are some way away. Therefore, if you ask yourself a very honest question, where are we on, give me one global Indian consumer brand. That you go to any corner of the world, from Boston to Paris to Bolivia to China to Sydney, where the global consumer recognizes an Indian consumer brand for what it is. Frankly, I have struggled to find one. There are small pockets where progress has been made, but a global Indian consumer brand, and the comparisons I'll give: Apple, Meta, Google, Coke, Pepsi, P&G brands, Lever brands, a Chanel in Europe, BMW, Audi cars, Italian brands, Samsung, LG, Hyundai, Sony, Panasonic, Toyota, BYD, Lenovo, TikTok. India? I wish. But we have to ask that very important question.
But what is actually holding them back?
I think we've got a very protected country. And people are very comfortable in the comfort of our 1.4 billion people. Home market is there, protectionism there. Why should I really try to become a global brand? I'm making enough money.
So now, with globalization in retreat, don't you think this trend will be accentuated, as in people will not care so much about competition? In many industries, we are moving towards an duopoly kind of a structure.
But you will still keep in mind, for a firm to be truly world-class, you'll have to get there. The global consumer is your test of quality, your excellence. And it's not about price. If you have a strong brand, you can actually command a much higher price. But it means intense competitive ability. And I see reports of BYD coming into India, and you guys in media seem to be more worried about Indian auto companies than they are.
Okay, we will open the floor for audience questions. Yes, please, the gentleman in the front.
Hi, Shekhar from Fed Bank. Good evening once again. My question is split in two parts. One, since you talked about the advent of AI, right? I've also written an article before. Now, you have been a veteran banker, you've been a promoter, entrepreneur, everything. Now, one is, how do you see AI impacting banking, whether it's credit underwriting or whether it's wholesale banking, just more customized, or retail, collections, what have you? And second is, that given that AI is going to be here, right, it's not going to go away anytime sooner, it's going to get more and more, whatever, productive and everything disruptive. Given this disruption, would you still advise a budding entrepreneur today, he or she, if they want to, let's say, start a NBFC or a banking, given all this turmoil?
You know, AI so far has done a lot of the feel-good kind of things which can change, okay? I think the way AI will evolve is it'll start completely changing we should work towards making AI change some of the very mundane stuff. And I don't think enough has been done on that so far, where you basically say that these things just come out from the machine, okay? How do we make AI from good to be to have to be? And the more we do it in every sector of our business, it will work. And in the short run, it is dramatically going to increase the need for engineers to be building AI. That requirement will go away. So it's like a surge, and then it will sort of move down. But to get to a level where you are able to implement AI in your system, you need to be at such a level of technology that it's pretty easy to move AI into your core system. So you really need to up your technology spend in the short run, and then AI enabled, which will lead to dramatic efficiency gains, and of course, done by fewer number of people. The bigger question is, for a country like India, what are we going to do with the people? And how are we going to handle that as one of the big challenges?
So still a good time for the budding entrepreneur, for anybody to get into the banking business or NBFC lending, even today?
I think we need to have a discussion on that. I think NBFCs, and this is my honest view, I have lived through an era of NBFCs. When we started after 85, by 94, 95, there was a huge proliferation of NBFCs. By 97, 98, there was 4,000 NBFCs in the system. And by 2004, we were down to 20. So I will not hazard a guess, because I don't want to be unfair to any NBFC. Make sure you have a business model, you have a reason to exist. And today, one of the challenges for NBFCs is your cost of funds is low only if you are AAA. Moment you are AA or lower, your cost of funds disadvantage is significant. Therefore, how are you going to climb up to a higher rating basis to be competitive as an NBFC?
And regulatory arbitrage is vanishing for NBFCs.
Yeah.
Thank you.
Yes. Neil.
Sean Fernandez. And so as everyone knows, your journey has been phenomenal, nothing short of spectacular. So what I'd like to understand is that...
Where are you?
So,
hi.
Yeah, yes, sir. As I was saying, your journey has been nothing short of spectacular. And in a country like India, where especially recovery continues to be a challenge, and going, about your bread and butter business, did you have any overarching philosophy in lending and recovery that, helped you to navigate through this, where so many others have stumbled, if not totally failed? So how did you navigate through this very challenging process of lending and recovering?
I think two very simple common sense principles. That in a finance business or a banking business, say you start with 100 rupees of your capital. You start with 100 rupees of your capital. And you borrow 900 rupees. So you have a total amount of 1,000 rupees. I'm not getting into complexities like CRR, SLR and all that. I'm keeping it out. Therefore, you've got 100 rupees of your equity. You've raised 900 rupees of deposits or borrowings, so you got 1,000 rupees. For the moment, you have lent out 1,000 rupees. If you lose more than 50 rupees out of 1,000 rupees, more than 50 rupees out of 1,000 rupees, you're out of business. Because you will not have the capital to continue being in the business. So principle number one, you don't own 1,000 rupees. You own 100 rupees. But you're taking responsibility for 1,000 rupees. And if you lose 50 out of 1,000, you're out of business. And the paranoia has worked for us so far. And I believe every entrepreneur in a leverage business must keep in mind that the room for error is extremely small. So that's principle number one. Principle number two, whenever we had to get into any area of lending, the first principle you ask is, can you collect? If you cannot collect, don't lend. So as long as you follow this, and you don't worry about your neighbor's growth being better than you, you're okay.
Neil. So this is Neil Borati. I'm the personal finance editor at Mint. What is your view on the huge commissions in life insurance and the mis-selling of life insurance that goes on in banks? How can this be fixed?
I think on insurance, I think the key issue is that there is a very strange behavior in India. I don't know whether it's customer-oriented or the insurance-oriented or over ages because of the tax benefits. 30% of the insurance business happens in the month of March. Okay? And this is historic. Maybe at LIC ke zamane mein you used to get the tax benefit, means everybody did insurance in March. And then for all the system, huge pressure comes to achieve their targets in March because of the nature. Therefore, one of the things which I keep on telling people is, how do you change the seasonality of insurance so that it becomes a more mature, round-the-year business? Rather than first 3 months of the year is aram. People don't do anything. Then they wake up. Then they have coffee. Then they have breakfast. And then they realize that they've got to get their business in the last quarter. So most insurance companies, if you look at sales, it's 10, 20, 30, 40. Or actually 10, 20, 25, 45. I think this level of seasonality just brings huge pressure on the industry. And I would strongly advocate the Life Insurance Council to think about how you get this seasonality away, especially now that the tax benefits are gone away. Okay, and you move to the new tax regime. Therefore, the old seasonality of the LIC days moves to a more mature insurance industry month after month.
So do you believe that commissions should be equalized between insurance and other investment products, especially the kind of life insurance policies that have investment?
Finally, what you have to be clear is, I think you have to benchmark against the rest of the world. The fact of the matter is, in an asset management product, you think your commission is low because it is, say, 0.5, 0.7 or 1%. But it's a short-term product. An insurance product is a 15-year product. So there's an element of front-ending for the 15-year period. One possibility, it could be amortized over time. That is a possibility. But compared to other financial products, what I understand from the insurance industry, that it is a much more push product than others. So you've got to find an appropriate equilibrium on this. Therefore, there is a case for looking at the life of the insurance product versus an asset management product. So therefore, a higher commission compared to just a 6 months or a 1 year product. But should we be giving some sort of spreading over, say, first, second, third, fourth year, something like that. But I think insurance industry is doing something on that after some new surrender value guidelines, which the IRD has brought in October, which actually gets to distribution industry having to claw back in case there is a policy which gets lapsed after 1 year and things like that. So there is some checks and balances which the IRD has got recently.
One final question.
So this is Sumit Doshi here, over here. So great insights. So your view on GIFT City and its impact on financial industry and banking in particular?
I'm a great believer that India needs a strong offshore financial center. But of offshore financial center, we have to be clear about what our purpose is. What are we trying to build? Are we trying to make a Hong Kong? Are we trying to make a Dubai? Or are we trying to have an adjunct with all the regulations and laws of India? The best example I have by far is Hong Kong. One of the smartest things the Chinese did was to give Hong Kong to the British for 100 years and ran it like an independent country. And 100 years later, they said, okay, this is ours. And Hong Kong became a huge adjunct for China. Now, what it means, if you want to build a Hong Kong-like offshore center, it means its own jurisdiction, its own laws, its own regulation, its own taxation, like a foreign country within the country. Now, to what extent is our democracy ready for something like that? Or are we always going to have a situation where, no, we can't make it so independent? And I think it's a fundamental issue about the structure of a country.
So you're saying it is not just about financial regulation, but political independence?
No. let's clear, after 97, politically the Chinese control Hong Kong. I'm not saying political independence at all. But how independent, like if you go back to 1997, China made a statement, one country, two systems. That was the wording of China in 1997 when they took over Hong Kong back. So they own Hong Kong.
Fair enough. One final question from that lady, then we are closing. Time's up.
Thank you. Good evening, sir. My name is Lalita. What I want to understand from you is any advice that you want to give to Generation Alpha, Generation Beta, and one word of caution that you think stays for all of us.
I just feel you're lucky. You're very lucky that you have the opportunity. You have the confidence as a country, as an Indian, much more than our generation had when we were growing up. Just keep in mind that whenever you go boldly and constructively forward, always ask a question, what if? And ask inconvenient questions to yourself, that if I took this step, what if this happened? So at least you have answered to yourself. Most likely things will go right for you, but you should be ready for consequences. And there are three kinds of unknowns. Okay, one is, let me make it simple. Known knowns, known unknowns, unknown knowns, unknown unknowns. So ask yourself you will never know unknown unknowns. Okay? So ask yourself, what is your scenario as you think about the future? And somebody gave me a wonderful comparison recently. The difference between risk and uncertainty. Risk is you can evaluate risk. Uncertainty gets into the era of unknown unknowns. So that is the area which is something you must constantly dream. And I believe risk is one of the most powerful dreaming areas for each of us to keep in mind. Just as you dream for good things, when you're taking a big step in your life, dream about what ifs and factor it into your decision making as you go forward. And that will work for you. Okay? So be bold, take big strides, but ask the tough questions to yourself.
On that positive note, we are closing the session. Ladies and gentlemen, Mr. Uday Kotak.
Mr. Kodak, please accept this token of gratitude on behalf of us all, and thank you so much for being here and giving us a lot of food for thought and action. Thank you very much, sir. Well, ladies and gentlemen, from moonshots to M&As, from billion-dollar exits to behavioral finance, we've discussed and delivered it all at the 2 days of the Mint India Investment Summit and Awards 2025. Thank you so much for joining us. It is now time for us to switch gears. Please join us for cocktails and for dinner. I'm Zina Fernandez signing off. Have a phenomenal night ahead. Thank you.